Yesterday had a sell-off on the open, a climactic sell-off, and then the second leg, and the market reversed up. And the pullbacks were small, so it was a small pullback bull trend. It continued higher for several hours, but it was mostly sideways. And then at the end of the day, we had a surge in buying. This dotted line is this line. This is the 60-minute chart. Let me change my pointer. So this little dotted line here is the 20-bar exponential moving average on the 60-minute chart. So the market was at the moving average all day and then surged above it at the end of the day. And a pink line like that is a gap, either the top or bottom of a gap. And we gapped above yesterday's high, but fairly climactic. We have a breakout here, a pullback here, and prominent tails. And tails mean the market went two directions. Here went up and down, here up and down, here down and up. So you're starting to get more two-sided trading. The market often has a breakout and then pullbacks in a channel. That's a very common combination. And when it does, the market usually comes back down to the start of the two-sided trading, the area around the bottom of the channel. So what do you do up here? Here's the average price. This is one measure of the average price. It's the 20-bar exponential moving average. And we're far above the average price. And if you're going to be paying far above an average price, you want bars that look like this. You want bars that look like they are far above average. If you get a bar that is not far above average bullishness, more traders are going to sell than buy. So if we get a bear bar closing near its low, traders are going to sell the close of the bar and below the low of the bar, betting that will go at least a little bit lower. We might test yesterday's high. The bulls want to keep the gap open. We might test yesterday's close, and we might test back down to the moving average if we go down. Now, sometimes the market will gap up. Sometimes the market will gap up, a big gap up, and have a bear bar. Whether or not it has a bear bar, sometimes it'll gap up, and it'll rally. Here it rallied for 3 or 4 hours. So when do you buy? Well, you don't want to buy the close of the bear bar. You buy above the first bull bar. Some traders would. Look how far above the average price it is. A lot of traders wait to see if there is sustained buying. They wait to see if there are 2 consecutive big bull bars closing near their highs, and then they buy. So some traders would buy above that bar or buy the close of that bar. Most traders, if you have a big gap up, you want some evidence of sustained buying. It's usually better to wait for a couple consecutive big bull bars closing near their highs and then buy. The market is deciding, is the first bar going to be a bull bar or a bear bar? If it's a bear bar, is it going to close near its low? If it's a bear bar closing near its low, will the next bar go below? If it's a bear bar closing near its low, it's a sell signal bar. And if the market goes below it, one tick below it, a lot of traders will sell, betting that they can make money. How much money? Well, at least a scalp. These lines here right now are 10 points apart. A scalp is typically about the size of an average recent bar, maybe a little bit smaller. And right now this bar is about 20 points tall. A person selling below 1 would therefore be looking to make about 20 points, which means he would be betting that we would come down and test yesterday's close. On the Globex chart, this is the 15-minute Globex chart. 90% of days will either go below the Globex low or above the Globex high. And we've been trending down for several hours. We have a big bear bar. At this moment, it's more likely that we'll go below the Globex low than it is that we'll go above the Globex high. But that could change in a single bar. If we get a reversal bar on this bar when it closes or on the next bar, then it could become more likely that we'll go up there. About twice a month, the market does not break out of the Globex range. Here's yesterday. It broke below the Globex low. This is the end of this is the Globex low, and it broke above the Globex high. So 90% chance we're either going at least one tick below that line or one tick above that line. And we've been going down, but not straight down. We're getting bear bars and bull bars, bear and bull, bear, and then big reversal up and big tail. So it's a bear channel, but it's not strongly bearish. This is strongly bearish. A series of bear bars. The bodies are getting bigger. That is a strong bear bar, a strong bear breakout, breaking below a bull trend line. Strong bear breakout, chances are we're going lower. A lot of times when you get a climactic sell-off, in fact, 60 to 70% of the time, if you get a very strong sell-off, there will be a second leg down. And the second leg down could continue a lot lower, but at a minimum, you're expecting a second leg down. Strong rally. 70% chance the first reversal down will be minor, and you'll get a second leg sideways to up. This is a second leg up, and this is a bigger second leg up. So you can see bar one, a big bear bar closing near its low. Two went below one. It's reasonable to be short now. Is it a high probability bet? No. On the open, always assume that any move up or down has a 50% chance of being the wrong way. So there's a 50% chance that there would be more buyers than sellers below one. So if two goes above one, do you buy above one or above two, either one? As I said, I just gave an example of that where there was a big gap up, a bear bar, and then two bull bars. Most traders are better off waiting for a second consecutive bull bar before buying. I got to fix that line. That line is wrong. We are now in a new month. Okay, so at the start of every month, I put a line at the open of the month. At the start of every week, I put a line at the open of the week because those prices are magnets. And the market often comes back later in the month to test the open of the month. And that's why I have up here lines for the open of the year and for the close of last year. You don't see them on the 5-minute chart, or if I put up the 60-minute chart, you can see them. This is now a 60-minute chart. So those are magnets above. So right now, the market is down on the year, and the bulls wanted to go back up on the year. Still on the short, one tick below one. So can you sell at the market? Yeah, it's still on a sell signal. So you could sell at the market and put a stop one tick above one. If you do that, if you sell at the market, put a stop above one, you're risking 10 or 15 points. The probability is not very high. Remember, I said 50% chance any strong move up or down on the open will be the wrong way. Yesterday, very strong move down on the open. It was the wrong way. They bought it. So right now, it's on a sell below one. Whenever the bars are big, your stop is far away. It's good to trade a smaller size position. And I always recommend trading 20% of your normal size. If you normally trade one E-mini is the equivalent of 10 micro E-minis. So 20% would be 2 micro E-minis. So if you normally trade one E-mini, you could sell 2 micro E-minis at the market, put a stop up here. And if the market goes down the size of a scalp and then has another sell signal, for example, another big bear bar closing near its low, you could sell another 2 micro E-minis below that. And if it's the opposite here, if you traded small and bought 2 micro E-minis here, if the market goes up the size of a scalp and gets another buy signal bar, you buy 2 more. It goes up the size of a scalp, you buy 2 more. And you'll soon have a full-size position plus you'll have a pretty good profit. 3 sideways bars. And we have a bear bar, we have a bull bar, but a big tail on top. So we went down on 1, we went up on 2, and down on 2. We're going up on 3. So that looks like this. Trading range market looks like this. There's no conviction that the market is at the wrong price. Traders are deciding, are we going to come down and test the support? Or is this going to be the low of the day? And will we rally? Will we start to do this? Usually the day after a very strong bull day, like yesterday, the market has a 50% chance of some resumption of buying in the first couple of hours. So a 50% chance you'll get some strong rally starting the first couple of hours. But there's a 75% chance for a strong bull day that you're going to have at least 2 hours of sideways to down trading that starts by the end of the second hour. So by the end of bar 24 today, we should have at least a couple of hours of sideways to down trading. At the end of every day, I create charts and to highlight different features that happen during the day. And then I have a bunch of PowerPoints with categories. And then I file the charts in the appropriate category. So this dashed line, this is today, this is yesterday. Very strong bull day yesterday. 50% chance you're going to get some kind of a strong rally on the open, but 75% chance you'll have at least a couple hours of sideways trading. And we went up strongly, we went down strongly, we went up weakly. So we had a couple hours of trading range trading here, and then we had 4 or 5 hours of trading range trading later. This is yesterday. Here's the dividing line. This is today. 25% chance you're going to get strong follow-through buying in the first couple of hours. And very strong bull trend day. Next day, a couple hours of trading range trading, so sideways trading, and ultimately we reversed more than what we gained in the prior day. Very strong rally yesterday, and trading range for the entire day, not just for at least a couple hours. 3 sideways bars. There are many signs that the market is in a trading range. If you start to get bars with prominent tails, that's trading range behavior and increases the chances that you'll go sideways. If you start to alternate bull bars and bear bars, bull bars and bear bars, trading range behavior. If you start to see bears making money selling with limit orders at prior highs, so if a bear placed an order to sell at that high, he got filled here, he made a scalp. If he placed a limit order to sell at that high, he made a scalp. So that's another sign that the bull trend is transitioning into a trading range. Another thing is if signal bars start to become bad. So, for example, you have bull bars but prominent tails, so not great for buying. And then you have a bull reversal bar, not great for selling. So that's another sign of trading range trading. Bad looking signal bars. For the bulls, 2 is a pullback. 1 and 2 formed a pullback from a gap up on the open. And therefore, 2 is a buy signal bar, but it has a prominent tail on top. So I would not buy above 2. Now 3, it's a bull inside bar. Can you buy above 3? I would not. Even though we have consecutive bull bars and a bull trend. And the reason I would not buy above 3 is what I said a few minutes ago. This is the average price. We are far above the average price. If you're going to be paying far above the average price, you want bars that look far above average. These are not far above average bullish bars. We may get far above average bullish bars with 4 and 5, so you wait to see a couple big bull bars closing near their highs, and then it becomes a buy the close rally. And right now the market is deciding, is this going to be a big bull trend, or are we going to get some kind of a double top with 1 and 4 and then a sell-off? The bigger a gap up on the open is, the more likely it'll stay open. The smaller a gap on the open is, the more likely it'll close. Now, this gap is about the size of an average bar, so it's about the size of a scalp. That is a small gap. So at the moment, it's likely that the gap is going to close, that we're going to go down below yesterday's high. However, if we start to do this, if we start to get bigger bull bars closing near the highs, then it becomes unlikely that we're going to come down and close the gap. Right now, we're in the middle of the Globex range. Traders know we're either going above the Globex high or below the Globex low, and they're deciding which it will be. We've been in a bull trend for many, many hours on 15-minute Globex chart, and the bulls are trying to get a buy signal bar, a bull bar closing near its high. Small wedge, 3 reversals, 1, 2, and 3, but they don't have a good buy signal bar yet. The bears are hoping that the wedge continues down. The wedge is a bear channel. They want it to continue down here. So what's the probability that we go here or here? Now, it's about the same distance either way, and the probability changes with each bar. We get a bull bar, we're closer to the top of the Globex range, so it's becoming more likely we'll go above the Globex high. If we start to get bear bars closing near their lows, and we get closer to the low of the Globex range, it becomes more likely we'll go below the Globex low. If you're a bear and you're sold below 1, do you exit above 3? You know, I don't think most traders should be in a position right now. But if you did sell below 1, I would keep the stop above 1. Chances are we're going to hit that stop. Chances are we're going to go above 1. And that's because we have a lot of trading range behavior, and trading ranges have reversals, and they have a lot of breakouts, and the breakouts fail. So if we go above 1, you're going to be thinking probably 50% chance the breakout above 1 will fail, but it will run the stops of the bears who sold 1 tick below 1. Sometimes you'll go above a place where there are stops, and the market will rally very strongly, like here. So we have consecutive inside bars here, that blue dot, consecutive inside bars. We sold off. A lot of bears would put their stop 1 tick above that, and when we went above it, we went far above it. So it's possible that there are so many bears looking to buy back shorts 1 tick above 1 that if we go 1 tick above 1, we could do that. The bulls are trying to get up there, and the bears are selling because they know a lot of bears will exit 1 tick above 1. So the closer we get to the high of 1, the more important it is for bears to sell. So the bear computers are selling, the bull computers are buying, and at this moment we do not know which computers have more orders. Are there more buy orders trying to break above 1, run the stops of the bears, and then begin a bull trend, or are there more sell orders so that the market does not go above 1 and reverses down from a double top? Right now we have a double top, 1 and 4, but 4 is a terrible sell signal bar, so traders are not going to sell below 4. The lowest price between the 2 highs is the low of 2. So the low of 2 is the neckline of this double top. 4 is a bad sell signal bar, but if we collapse on 5, a lot of traders will sell 1 tick below 2. We have a report at 7 o'clock today, which is bar 7. And very often the bar 6 will change its appearance in the final seconds. So it could suddenly become bigger, It could suddenly change directions. So when there's a report at 7 o'clock, it's often difficult to enter with a stop above or below 6 because 6 often changes its size and appearance in the final second or two. We are above the high of 1. Now, will there be a lot of bears buying back shorts, thinking, oh my gosh, this is a bull trend? Or will there be a lot of bears selling with limit orders at the high of 1, thinking, this looks like a trading range, and a breakout above the trading range should fail, so let's sell more with a limit order at the high of 1. So right now there is not a lot of buying. It's not like this yesterday when we broke above that high. There's tremendous buying, and we don't have that yet. It could happen, but we don't have it yet. If you don't get big bull bars, but you do get bull bars, that is also a sign of relentless buying. So, if you get 4 or 5 small bull bars, that means the bulls have been in control for 4 or 5 bars, and it increases the chances that will go higher. Yesterday was the end of April, and there was a huge reversal bar. It went down and it reversed up, but it was not a bull reversal bar. A bull reversal bar is a bar that goes down and then goes up and has a bull body. So this is a reversal bar, but not a bull reversal bar. This is a bull reversal bar. It went down and went up, and it closed above the open, creating a bull body. And if it has a bear body, it's a weaker buy signal bar. So for the bulls, we've been in a bull trend for over a decade. This is the monthly chart, and this is a pullback. So it's a high 1 buy signal bar, but it's a bad buy signal bar, and it's a surprisingly big sell-off from here to here. And usually, if you have a big move up and a big move down, you have a lot of confusion. Big confusion, big up, big down, creates big confusion. And when traders are confused, they're unwilling to hold positions for very long. And they don't want to buy too high because they expect a reversal. So when the market's sideways, when the market goes up, you'll get more sellers than buyers. When it goes down, you get more buyers than sellers. So big up, big down creates big confusion, and it usually results in a trading range. And I've been saying that I think we'll be sideways for at least a few months, and possibly for the rest of the year. Top of the range right now is here, bottom of the range is here, but we could easily go below this low, we could easily go above that high. Look at this trading range. We have a new high, a new low, a new high, a new low. Right? This is the pandemic crash. And we could do something like that here. This lasted a couple of years, and I think this is the start of a trading range. This is a really strong rally on the monthly chart, and this is another strong rally. And this was strong enough up to expect at least a strong second leg up. This was strong enough up to expect a second leg up. But the sell-off is so deep that instead of the market continuing up in a bull channel, possibly forming a wedge, now it looks more like it's forming a trading range. So I think we're going to be sideways for several months. The top of the range might be to a new high. I don't know, but I don't think it'll be much above the high. The bottom of the range might be this low, maybe lower, maybe down here. I don't know. But I do think we're going to be sideways probably for the rest of the year. All right, so now this is a second reversal down from above yesterday's high. Even though it's a weak sell signal bar, some bears will sell the second reversal down. But there are 2 problems with this. Do you see what the problems are? First of all, 5 is a bad sell signal bar. So in general, you should not sell below a bear doji, a bear bar, very small body. So that's a weak sell signal bar. And then it follows 3 consecutive bull bars. So it's following sustained buying. So there may be more buyers than sellers below 5. And now we're on bar 6. And we have a report at 7 o'clock. It doesn't matter what the report is, but because it's a report, there's a potential for the computers to make very big trades. The computers get reports in digital format. The trading firms pay the exchanges and the information services money to get digital copies of the reports as soon as the reports come out. And the computers are programmed to look for words, bearish words or bullish words. And they also look for numbers. And they place trades instantly based upon the report. And even though you have a real-time data, it's delayed. It could be delayed half a second, but you are getting your data. What I'm seeing right now, it's like looking at the sun. The light that you're getting, when you look at the sun, you're not seeing the sun as it is right now. It took 8 minutes for that light to reach your eye. So what you see on the sun right now is actually how the sun looked 8 minutes ago. It's possible that the sun blew up 2 minutes ago, and you won't know that until 6 minutes from now. And with your data, you think it's real time, but it's actually slightly delayed. And the worse your internet connection is, the further you are from New York, the greater the delay. Some trading firms pay incredible rent to be as close to the node in New York City where the internet enters the city. And because they want to get the data microseconds sooner than their competitors who might be in an office a block or two away. And a lot of those computers will place one or more trades in a fraction of a second. They'll be in and out. They might trade for a 1 tick profit, a 5 tick profit. But the high frequency trading firms are placing trades, and you're not seeing the trades take place. You're seeing what your delay of a half a second or whatever delay you have. A lot of computers have made a lot of trades in that time. So when you finally see something on your chart and you say, now's the time to trade, well, guess what? A lot of computers have already entered and exited before you're looking to enter. Now, we still have a double top here, a higher high double top, 5 and 1. The lowest price in between is the neckline. A lot of traders will sell below the neckline of a double top. And I said 5 was not a reliable sell signal. I would not sell below 5. However, you will get traders selling with a stop 1 tick below 2, betting that we're going to close the gap above yesterday's high. We're going to test yesterday's close, and we'll test the moving average. 15-minute Globex chart. Now we have 6 bars that overlap one another by at least 50%. So that means we're going up and down and up and down and up and down, repeated reversals. A couple minutes ago, it looked more likely that we'd go above the Globex high, and now it looks more likely we'll go below the Globex low. But 6 consecutive sideways bars in a very tight range like that, it's better to wait, because it's likely that we'll keep reversing. Okay, we just broke below this bar. This 15-minute bar was an outside bar. Okay, we just got the 7 o'clock report. Okay, you see what just happened? 6 broke below 2, triggering a sell signal, and then the report came out, and the report totally undid the sell. Now we have a double bottom, 2 and 6. The highest price in between is 5, so there will be computers buying 1 tick above 5. The bear computers are selling. They're trying to prevent 7 from going above 5. They're on their sell signal below 2. We have magnets below, and they're trying to force it down. And the bulls are hoping that 6 is a bear trap, trapping bears into a bad short, and that we reverse up. What should you do right now? Wait. The market's moving too fast for you to make appropriate decisions. You know, do you buy, do you sell? Do you put up a 10-second chart every bar, 10 seconds, a 1-minute chart? The things are happening too fast for you to make good decisions, and even to click to place your orders. It's just too fast. The computers can do things in milliseconds. So, you can see the market went up and down. So a lot of computers bought, a lot of computers sell. You cannot compete when speed is a factor. And right now, speed is a factor. And the computers have speed in making decisions, speed in placing orders. You do not have speed. And you should never enter a fight unless you've already won the fight in your head. And, if the other side if you go to a fight and you have a knife and the other guy has a gun, you've already lost the fight before the fight started, right? So if you're competing against the computers, and they're trying to take your money, you're trying to take their money, and they have a big advantage of speed. And when speed is important, as it is right now, you're going to lose. You might win some of the time, but if you consistently trade in this kind of an environment, you're going to lose. So breakout bar, we have a double top 1 and 5. We have a double bottom 2 and 6. Another reversal. Look at the 15-minute chart. So 7 bars where each bar overlaps at least half of the prior bar. So we're getting reversals repeatedly. Markets deciding, is it going to go below the Globex low or above the Globex high? And the probabilities keep changing. It looks bullish, it looks bearish, it looks bullish again. Better to wait. Now, if 7 closes on its high, it's a buy signal bar for the double bottom 2-6. However, you're buying at the top of a tight trading range, so that's a low probability bet. Trading ranges are more likely to reverse than break out. And if you're buying above 7, your stop is far below. So you have low probability and high risk. And that's a terrible combination. Can you buy above 7 for a scalp? No. If you're scalping, that means your reward is small relative to your risk. In general, when you scalp, your reward is less than your risk. So if you're going to be a scalper, you have to be right 70 or 80% of the time. If you take any trade where the probability is less than 70 or 80%, you're going to lose money. So you could win 60 or 70% of the time as a scalper, and you will lose money because in general, the risk is going to be greater than the reward. The profit target will be less than the size of the distance to the stop. Okay, so now we got a double bottom 2-6, but a bad buy signal bar 7, big tail on top and the top of a trading range. So not a very good buy above 7. Can you buy above 5? The neckline of the double bottom. I would not buy above 7. I do think it's okay to buy above 5, but if you buy above 5, you're risking 30 points. So if you buy above 5, you have to trade small. What's the alternative? Well, you wait to see what the breakout bar looks like. If it's a big bull bar closing near its high and far above the breakout point, chances are we're going to go higher. So if you buy the close of that bar or above it, your stop is far below, you have to trade small. Okay, some bulls bought above 7. Some bears are selling at the 7 high, betting that we're not going to go above the high of the day, and that this will reverse down from the lower high double top after this higher high double top. Bulls trying to get a breakout. The bears had a breakout on 6. A bear breakout is a bear bar closing near its low and closing below the low of the prior bar. And it's higher probability of lower prices if it also closes below some other prior bar. And 6 was a big bear breakout bar. But when you're in a trading range, it's usually better not to just trade the breakout. It's usually better to wait to see if you get consecutive breakout bars and then trade. And the opposite's true up here. If 8 closes above 7 and closes near its high, then it's a bull breakout bar. If it closes above 5, then it's a bull breakout bar that also broke above a double top and the neckline of a double bottom. However, it's higher probability if you wait to see if the next bar also is a breakout bar. So if you get consecutive bull bars closing near their highs, consecutive bull bars closing near their highs, breaking above this is a double bottom, that's the neckline. We broke above it, we broke above it more, so more traders would buy above that. This closed above that bar, so this is a breakout bar, a bull breakout bar. Some traders would buy above its high. Some traders like to see consecutive bull breakout bars. A big bull bar closing near its high, closing above the high of the prior bar. A second bull bar, a second bull breakout bar. So now the breakout is 3 bars long, and 2 of the bars were bull breakout bars. So a lot of traders will buy. Stop order traders are losing money. Big bear bar 1, if they sold below 1, they lost money. If they sold below 2, the neckline of the double top, they lost money. If they sold the close of 6, they lost money. If they bought above 1, they lost money. If they bought above 7, they're losing money. This is a limit order market. The market's in a trading range, especially a tight range. Traders will bet against successful breakouts. So anything that looks bullish, they'll sell. 4, a big bull bar closing near its high, they sell. 6, a big bear bar closing near its low, they buy. So in a trading range, traders bet on reversals. Anything that looks bullish is a buy, anything that looks bearish is a sell. Break to a new high of the day, bar 5, it's a sell. Break to a new low of the day, 6, it's a buy. You should not be trading when the market is doing this. Experienced traders will trade it. But the problem with beginners is if you bought the low of 2 and then 6 kept coming down here, at some point you'll say, I can't take the pain, I'm losing too much money. And you'll do the opposite of what you should do. What you should do is, if you still think it's a trading range environment, the correct thing to do is buy more. And if the market is down here, you will not be able to buy more. You'll feel like, oh my gosh, I'm losing so much money, I can't buy more. And that's because you're trading too big, right? If an experienced trader knows that if they're trading a limit order environment and they have to use a very wide stop and they have to scale in, they're going to trade a very small position size. If you look at time and sales of the E-mini, you'll notice that the most common position size is 1 contract. And that's because high-frequency trading firms, a lot of them are trading, 1 contract. It goes down a tick, they buy 1 contract. It goes down 1 more tick, they buy more. It goes down 1 more tick, they buy more. And if it starts to go up, they start to sell 1 contract, 1 contract, 1 contract. That's true with stocks as well. You'll notice that a lot of trades are for 100 shares. And most of the volume being traded is traded by computers and by high-frequency trading firms. In other words, firms that take a lot of trades. And some of the high-frequency trading firms will take 10 or 20 million trades a day. And if they're trading stock, if they're buying or selling Apple, they're probably just trading 100 shares, but they're doing it, 1,000 times during the day. If you have a high-frequency trading firm trading the E-mini, a lot of them are probably just trading 1 contract at a time. But if you do it 1,000 times during the day, and you make 1 tick on average, then you made 1,000 ticks, so you made a lot of money. So that's what they do. They have a high frequency of trading, but they're trading very small position sizes. So if you're looking at the spider, the SPY, and you see most of the trades are only 100 shares, that is high frequency trading firm. If you look at Tesla, and you see most of the trades are 100 shares, that's mostly high frequency trading firms. It's not Robin Hood traders. There are not enough of them, and they can't make decisions that fast. If you look at how fast the trades are taking place, it's all computers. Individual traders like you and me, I don't have any data on this, but I bet we make up less than 5% of all the volume. And 95% of all the volume is institutional. And most of the institutional volume is being traded by computers. Now, look at this over here. I want to make a point. That's really strongly bullish, right? So the computers were buying. But who are they buying from? Right? If they're buying, somebody has to be selling. So who's selling? Well, there are lots of reasons to sell. Some of the computers selling are computers that bought earlier and they're taking profits. And some of them are selling firms that will use why stop and scale in. So they sell, and then the market comes down to, if the market is really strongly bullish and they have a big short position, they'll try to get out around break even. So a lot of times the market will come down to around 50%, which might be the average price, and the selling firms will buy back their shorts, and then you get another leg up. Here we got a breakout, and very often if you get a breakout, there'll be a pullback to the breakout point. Sometimes it goes below the breakout point, sometimes it stays above it. But if you ever see a strong breakout and then a sell-off and then a resumption of the trend, always look to the left. There's often a breakout point. And if there is, the rally will often continue for a measured move up. So if there's a start, okay, and there's the breakout point, the market is telling you, the bottom of the move is important, right? And the breakout point, we broke above this, is important. You can see we tested it and they bought again. They bought here as it went above that. We came down to that price and they bought again. So this is clearly an important price. If you have two important prices, they often create a third important price. So the bottom of the bull trend and the breakout point, and you often get a measured move up. And the high of the day was around the measured move up. That happened again earlier yesterday as well. We broke out for a new high of the day, and then we sold off strongly, but they bought right around where they bought over here at the breakout point. And it tested it again. So we got a second test of that, and we rallied from there. Often will lead to a measured move up. So the bottom of the bull trend is here, the breakout point is there, the measured move up is there. Did not get there until the end of the day yesterday, but we did get to a measured move up from the bottom of the bull trend to the breakout point. We tested it again. So clearly this is important. This is clearly important, and it often creates a third important price, and the market often gets up to that price. Bulls trying again to break through high of the day. 9 is a better buy signal bar. It's a second buy. The first buy was above 7, a bad buy signal bar. So you'll get more traders willing to buy here above 9, some traders will buy above 8. It's the neckline of this small double bottom, and others will buy above 5. And their minimum target would be a measured move up. If they buy above 5, they'll probably put their stop below 6. That's how much they're risking. And traders like to make at least the size of their risk. And therefore, if you break out above a trading range, the market often rallies for a measured move. So if we do go above 5, that is the target. Bears, when we're at this price in the open, what did we do? We went down. We were at this price again. What did we do? We went down. We were at this price again. We went down. We're at this price again. Are we going to go down or are we going to break above it? The more times the market hammers at the same price, the more likely it's going to ultimately break above it. So right now, it looks like we're probably going higher. How certain is it? It's probably better than 50-50, but it's not 60 or 70%. Until you get a clear breakout with follow through, the probability is never much higher than 50%. So right now it's a little bit better than 50%. We have a second buy, and we have a better buy signal bar. And we have the Globex high as a target above. So maybe 55% chance this is going to be successful. But the bulls need a good entry bar on 10. They'd like to get a big bull bar closing near its high, but they're not. But it's not a terrible bar. For the bears, you get a micro double top 8 and 10, but a bad sell signal bar 10. So most bears are not going to sell below 10. And we never really triggered a very good sell signal. You know, maybe below 8 for a double top 5 and 8, but the reversal up on 7 was strong enough to make a second leg up likely, and therefore 8 was not a good sell. So we've never really had a good sell signal today. 1 was a good sell signal, but we went above 1, and those bears covered. So right now there is no reasonable sell signal, and there is a reasonable buy signal. So if you had to be long or short at this moment, you would be long because we went above 9. And other traders will wait, buy one tick above 10. And others will wait to see if we get a strong bull breakout and then buy. And the bears, there's something wrong with the bears today. We had a good sell signal bar 1, and then we went above the 1 high. And 8, a fairly prominent tail, almost as big as the body, and the second leg up was likely. So 8 was really not a very good sell signal. So right now it's slightly more bullish. If you're trading, I would be trading small. I think most traders should not be trading, although buying above 9 is, I think, a reasonable thing. As the market goes up, more and more bulls will buy, and more bears will buy back their shorts. We just broke above 4. Excuse me, we just broke the new high of the day. And 6 broke the new low, and we reversed up. So 6 was a bear trap. And now we're triggering more buying. So reasonable to buy here at the market if you did not buy one tick above 5, and if you did not buy one tick above 9. And your stop right now is below 6, maybe below 9. And you want to see sustained buying. You want to see more bull bars, big bull bars closing near their highs. You want to see bars closing far above prior highs. So the bulls want 11 to close far above 5. Very close to the Globex high. So chances are, we know 90% chance we're either going above that or below this. And right now, there's probably an 80% chance we're going above that. So 80% chance we're going higher. If this suddenly reverses, then the odds would start to favor that. But right now, it looks like we're going above the Globex high. This is bar 11. The first hour ends with bar 12. Here's the 60-minute chart. And we're breaking out. Yesterday's close was above this. So we're trying to resume the bull trend. We had a lot of sideways trading through here. The bulls were hoping that we're going to get something much more bullish. And they want to get all the way up here. I want to go to the daily chart, make a point. Okay, very good bar for the bulls. It could have been bigger, but it's still a good bar for the bulls. Can you sell the market? I would not. Remember, in here, traders were selling bullish things like bull bars and buying bearish things like 1 and 6. We have room to the Globex high. It's very close to where we are. Probably go a little bit higher. To short, what do the bears need 12 to look like? It would have to be a pretty big bear bar closing near its low. The bulls are hoping this is the start of a bull trend. So they like to see big bull bars closing into their highs, consecutive big bull bars, several bull bars closing into their highs. So the bulls need this if we're going a lot higher. And so far, they do not have it. They have one really good bar. At a minimum, they're hoping we go up for a measured move. The bulls who bought above 5 theoretically have a stop below 5. So they want the market to go at least as far up as the stop is down. So there's a magnet up here. Bulls, high frequency trading firms will be buying, trying to get it up there. Bar 12, the final bar of the hour. The bulls want the hour to close near its high. They want the bar to look like that or become even a bigger bull bar. And the bears want it to be less bullish. So very often, bar 12 or any multiple of 12, bar 24, bar 36, will do something that will alter the appearance of the 60-minute bar. If the 60-minute bar closes near its high, we'll probably go at least one tick above its high. Bull breakout 11. Big bull bar closing near its high, closing above the high of the prior bar. It also closed above a breakout point. The minimum the bulls want is for the next bar not to have the bear body. 12 had a bull body. It's a small bull body, but it's a bull body. So that is bull follow through. So 70% chance we're going to get at least a small second leg sideways 2 up, which means there probably are more buyers at the 12 low and below. Is there any reason to sell below 12? I think not a good reason. You could say it's a failed breakout above the 1-5 double top. You could say it's an expanding triangle with 1 and 5, so up and down, more down, more up. But we have 4 consecutive bull bars. That is a low probability sell. We did break above the Globex high. The bears want a double top. They want a reversal down below the neckline and then a measured move down. And the bulls are hoping this reversal is simply a pullback and that we'll get another leg up. This happens all the time, where you get a breakout and then a reversal, and you have to decide, is the reversal an actual reversal of the trend and the start of a bear trend, or is it simply some profit taking? And then the bulls will come back and you'll get a resumption of the bull trend. So is 13 the start of a bear trend, or is it a small pullback in a bull trend? At the moment, 70% chance it's a pullback in the bull trend. But if you get a bear bar closing near its low and then another bear bar closing near its low, the more bear bars you get, the more likely it's the start of a bear trend and not a pullback in the bull trend. and more bulls will give up, the lower we go and the more bear bars we get. Very strong bull breakout. Is this a pullback in the bull trend, or is it the start of a bear trend? Well, initially, it's more likely a pullback. But at some point, traders decide that it's a reversal. And this is when everyone agreed that it was a reversal. The bulls had a small wedge bull flag, a breakout, a weak buy signal bar, and then it collapsed below the bottom of the wedge. And everybody, the bulls gave up and the bears sold aggressively. Still more likely that 13 is the pullback in a bull trend and not the start of a bear trend. But if we get 2 bear bars, 3 bear bars, big bear bars closing near their lows, consecutive big bear bars, then it will become more likely that this is the start of a bear trend. Right now, more likely we're going higher. So traders who bought for any reason above 9, above 5, above 11, the close of 12, at the low of 12, they're still long, stop below 6. And now, who's buying here? When you have a bull trend like this, who's buying here? Is bar 12 mostly institutions that did not buy earlier, and they're now saying, oh yeah, I think it's going up, I'm going to buy? No, most of the buying here is institutions who bought here, and they bought more here, they bought more here, they bought more here. So when you get these relentless, strong bull trends, it's not like the buying is being done by firms that are not in a position and they're finally deciding it's bullish. It's mostly those high-frequency trading firms who are long, and they're buying more, they're buying more, they're buying more. So this is mostly firms adding to their position and not new firms coming in. Now, I used to do eye surgery. I never worked on Wall Street. So how do I know this? Because that's how I trade, and it makes sense. So that's why I believe it's true. Breaking above the high of the first hour, the bears want a reversal. Remember, I said at the close of 12, 70% chance we would have at least a small second leg up. Well, 14 is at least a small second leg up. So you did not have many traders willing to sell below 12. If we reverse down on 14 or 15, you'll get more traders willing to sell. Now, why is that not going to happen? The reason it's probably not going to happen is because the market usually doesn't reverse on bars 14, 15, 13, 14, 15. Usually it waits for 16, 17, or 18 if it's going to reverse. So chances are the best the bears can get here is sideways and not a reversal. Why is that? I don't know. I could just tell you that if you're going to get a reversal sometime after bar 13 or so, it usually does not come until at least 16. Remember, the minimum objective after 12 was a second leg up. But traders are really looking at that price. So a lot of bulls are buying and buying more, trying to get up there. And once we get there, we might get some profit takers. What happens if we get a reversal on 15? Traders are willing to sell because this is a second leg up after 11, 12. That was the minimum expectation, so a lot of traders got what they expected, and they're willing to take profits. And it's also a third leg up on 7, and then down on 8, up to 12, down on 13, and now up here. So it's a little bit of a wedge. And when a wedge is in a tight channel like that, it's a parabolic wedge. And if you get a decent sell signal bar, at a minimum, bulls will exit longs and you'll start to get some bears selling. But when you get a reversal from a parabolic wedge and you get a very tight bull channel, usually the reversal is minor. It's not going to lead to a bear trend. Really strong bull trends constantly form parabolic wedge tops. You know, traders keep looking, they keep seeing wedges. So 1, 2, 3, so that's a possible wedge. And then you get another wedge here. 1, 2, 3 reversals. And, you know, strong bull trends constantly form wedge tops. Here you got a nested wedge over here. That's a possible wedge. And then you get another wedge here. 1, 2, 3 reversals. And, you know, strong bull trends constantly form wedge tops. Here you got a nested wedge over here. So 1, 2, 3, and that's within a bigger wedge. 1, 2, 3. So a smaller wedge nested within a bigger wedge. Some traders are hesitant to buy the third leg up because I know some computers will take profits on the third leg up. But right now, this is a buy the close rally. And look at the, I'm going to put up a line chart to make a point. Okay, look at this low and that high. There's a space between them. So there's a gap between that low and this high. But on the bar chart, that low, that it overlaps. This low overlaps that breakout point. On the line chart, there's a gap between the bodies. The highest close, it's a line chart, so it's based on closes. The highest body, the highest close is here, and then the lowest close is here. So there's a gap between the bodies. That's still a sign of strong bulls. You know, a lot of institutions trade line charts, and gaps are signs of strong trends. And we have a gap between that low and this high. Right? So that's a gap. It increases the chances of higher prices. But on the bar chart, on the candlestick chart, the gap is closed, but there's still a gap between the bodies. So it's a body gap. And if you get 2 or more gaps or body gaps in the first couple hours or so of a trend, the trend is probably going to last all day or mostly all day. And we have one right now. The bears are trying to get a parabolic wedge. They want a good sell signal bar of 15. If 15 closes near its low, it's reasonable to exit longs below 15. Is it also reasonable to short? It's low probability, because if you're selling in a tight bull channel, the probability is low that you're going to get a trend. So if you're taking a low probability trade, you have to trade small and plan to add on. So anybody selling below 15, trade small. And if you get 2 or 3 bear bars, you sell more, sell more, sell more, add to your position. If it goes sideways and then you get a double top, okay, you'll get more traders willing to sell. Bulls, I would get out of longs below a bear bar closing near its low. So I would exit longs below 15. Some bears will sell below 15, but if you do, I would trade small. I think it's probably better to wait to sell. Wait for more evidence that we're going down. There may be more buyers than sellers below 15. The bull trend today is not very strong. 9, 10, not very big bars, 10 big tail on top. Good bull bar, 11. but small bar on 12, bear bar on 13, good bull bar 14, not especially big, but bad follow through 15. So when you get a bull trend that looks like this, it'll often last a couple hours, but it usually will not last all day. So it's still a small pullback bull trend. We have a small pullback here, a small pullback here, and so far a small pullback, 16 below 15. So it's a bull trend with small pullbacks. So it's a small pullback bull trend, which in general is the strongest type of trend. Small pullback bull trends can last all day. But before traders will conclude that it is going to last all day, they want at least one more gap or body gap. I'm turning the screen off for a moment. I'm going to open up a PowerPoint. Small pullback bull trend. It's a bull trend where the pullbacks are small. And traders like to see at least two gaps or body gaps. We have a pullback. It stayed above a breakout point. We have a breakout. So we have a gap between that low and this high. We have another breakout to new high. And this low fell below that high, but the bodies do not overlap. So there's a body gap. And if you get two or more body gaps in the first couple of hours or so, chances are the bull trend is going to last all day, or it might convert into a trading range late in the day, but chances are it's not going to become bearish. Early on, a lot of bear bars, broke out and pulled back, look to the left. This low did not fall below that high, so we have a gap. Here's a breakout to a new high, a reversal down, but the reversal down resumed back up. That low, it overlapped that high, but the bodies do not overlap, so there's a body gap. So now we have two gaps or body gaps, and chances are the trend is going to last all day. There was some profit taking at the end. And right now we have one gap. It's a body gap here. Very often, if you have a small pullback bull trend, the market will have times when it goes sideways for 10 bars or more. Small pullback bull trend. Even though the market was sideways here for 20 bars, the pullback was still small, and the market was still in a small pullback bull trend. Here, basically sideways for 10 bars, yet the market kept trending up. Sideways for 10 bars, sideways for 5 or 10 bars, yet the pullbacks were all small, so it remained in a small pullback bull trend, and it can go very, very far. Gap, that low, this high, body gaps. That close did not overlap the highest close of the breakout point. So we've got a couple of body gaps. We have an actual gap. Bull trend lasted all day. What did I say about reversals? I said 15 probably would not lead to reversal because reversals typically do not come at bar 15. I said if you're going to get a reversal, it probably would be 16 or later. No, I said I would not short below 15. Well, what happens if 17 looks like 15? Then you will get more bears willing to sell. However, a lot of bears will still not sell unless we reverse down strongly, because we're still in a small pullback bull trend. Odds favor higher prices. Bulls, if they exit like below 15, and the trend could last a long, long time, they have to get long again. And there are two ways to get long again. One is you put a stop one tick above the high of the day and you get long. In this case, one tick above 15, so you're long here on 16. Or you wait for a bull bar closing near its high, like 16, and you buy above 16. It looks like we're getting trading range type of behavior. Bull, bear, bull, bear, bull, bear. Right. So we may pull back here. But still a small pullback bull trend and no reason to short. Suppose 16 is a bear bar closing near its low. Okay, it's not. But let's say 18. Suppose 18 is a bear bar closing near its low. Can you short below it? If you're selling in a small pullback bull trend, you shouldn't do it. Wait for a strong bear reversal down. Wait for it to start to go sideways and form some kind of a double top. But when the market's in a small pullback bull trend, that's one of the strongest types of bull trends. You can only buy. Can you place a limit order to sell out of longs at that measured move? I think it's reasonable to take at least partial profits there. So you could place a limit order at it or a tick below it, or you could wait for it to get there and see if there's a reversal and then exit. Can you short there, betting there'll be so much profit taking that we'll get a trend reversal? No, as long as it's in a tight bull channel, you can only buy. It's a losing strategy to short. Remember, the pullbacks are small. So if you sell below 15, at a minimum, you're looking for a scalp, which is 5 or 10 points. And if you're already selling, 6 or 7 points down from the high, and you need 10 more points, that's not a small pullback. Yet the market's in a small pullback bull trend, and therefore you're not going to get big pullbacks, and therefore you're not going to make money selling. You only buy. And you buy for any reason. You buy something bullish. You buy 11 breaking above 5. You buy the close of 11. You buy the high of 11. You bet the reversal down below 12 will fail, so you buy the low of 12. You buy above a high 1 bicycle bar. 13, it's a bear bar. Better to buy it above 12, a bull bar. Possible small wedge here, 3 legs up. We got a breakout, a second leg, and now a third leg. And we're also in that window when the market often reverses, 16, 17, 18, 19, 20. So you get a parabolic wedge, 3 legs up, 1, pull back 2, pull back 3. And if you get a reversal, you still should not sell because we're in a small pullback bull trend. Small pullback bull trends are constantly reversing. But how much money are the bears making? They're not making anything. You should only buy. You see in here, I have only green arrows. Only buy in a small pullback bull trend. Sometimes later in the day, there'll be some profit taking and you can sell. Here, a possible failed breakout. But if you did sell, I would buy back above a bull bar closing near its high, like above that bull bar there. Or you could wait for a second buy and buy above that. But look at this trend. How many potential sells do you see? 1. And how many potential buys do you see? 20. Right, small pullback bull trend. The pullback is small. It's a bear bar closing near its low. Doesn't matter. You're in a strong bull trend. There'll be more buyers than sellers at the low of the bar. Anything bearish, you buy. A bear reversal, you buy. A bear bar, you buy. Break below the moving average, you buy. Or you buy the reversal up, the bull bar that followed. I said some traders would sell below 18 if it reversed down because of the wedge. But look what's happening. Instead of reversing down, it's accelerating up. Traders are more confident that we're going to reach that target. So nobody wants to sell. Where with every support or resistance level is a magnet. And like a magnet, the closer you get to it, the stronger the pull, and the more likely you'll get there. a bull breakout? Could it fail? Could it be an exhaustion gap? There's a gap between the close of that bar and the high of the prior bar. Could be. Well, as I said, I'm not looking to sell until we stop going up, start to go sideways, and then possibly sell. Or if we, my mic was off, I'm sorry about that. We have a gap between the close of that bar and the high of that bar. If we reverse down, then that gap becomes an exhaustion gap. So you could call it an exhaustive buy climax, a parabolic wedge, 1 pullback, 2 pullback, 3. But it's still a small pullback bull trend. So yeah, you can sell out of longs, but I would not sell into shorts. If we get a couple big bear bars closing near their lows, some traders will start to sell betting on a trading range. So the couple big bear bars, you're hoping it goes down and you can make a profit, but you're confident that if you get a pretty strong sell-off and it goes up, it will not go far above this. It'll go down again. So traders will sell and sell more higher, betting that it'll come back down and form a trading range. Can you buy the low of 18? You probably can. It's a small pullback bull trend. The problem you have is it's a third leg up. So that increases the chances we may have a couple legs sideways to down. Whenever you get profit taking in a strong bull trend, you often get, if there's some kind of a wedge top, the market will often go sideways to down for a couple legs. That's why I talked about here, right? So a really strong bull trend, down for a couple legs, 3 legs. So if you get a strong sell-off and a small pullback bull trend, a lot of times you get a couple legs down. But I still would not sell. You sell out of longs, maybe, but I would not get short. Also, we have an obvious target. So right now, I would say 70% chance we're going to reach this pink line at some point in the next hour or so. We could start to go sideways at any point, but right now the odds are we're going to go higher. Something else, you see this is the daily chart. You see this dotted line? This is the 200-day moving average. And we got very, very far below it. Unusually far below it. So we only get that far below it every couple of years or so. And traders buy, betting that we'll get back to it. We're back to it. When we had this sell-off, I said that, and especially after this reversal up, I said at a minimum we should get back to test this high. And I said I thought we would come back to test this high. A strong bear trend, and then some buying, and then another leg down. A lot of times the market, well, not a lot of times, usually the market tries to get back to that price. The bulls have bought here. Some of them use very wide stops. They bought more lower, and they'll buy more trying to get back there. Once it gets there, they'll take some profits. So a lot of times if you get to a prior high, you'll get profit taking. Here, a strong bull trend, got to the prior high, got profit taking. Got to a prior high, got profit taking, and here we ultimately get a reversal. So if you're in a bear trend and you have a lower high and then another leg down, the market tends to try to come back to the most recent major lower high. So it looks like we're probably going to go higher over the next couple of weeks. Most of you have heard the expression sell in May and go away. About 20 years ago, there were a lot of articles written about how most of the gain in the stock market comes between October and May. And if you bought every October and exited every May, you would make more money than if you simply bought and held forever. And I don't know if that's true, and I don't even know if it was true back then. One of the problems with that strategy is if you buy in October and sell in May, your taxes you're not getting long-term capital gains taxes. So, you're paying more in taxes. So that reduces the profitability of that strategy. But there still are a lot of traders who look to take profits in May. So a lot of times the market rallies into May and then sideways in the summer, and then traders look for a sell-off in October and buy again. I never trade calendar tendencies because they're really not reliable. For example, here's the monthly chart. You got January, February, March, April. If you look at any pair of consecutive months, the most bullish pair is March, April. Okay, and this is March, and that's April. So this is the most bullish consecutive months on average, and from that high to this low, the market probably was down 15%. So, calendar trades, I think, are not reliable. There are far more reliable ways to trade. So calendar trades are entertaining, right? But they're not reliable. So I never place a trade based upon the calendar. However, if we do get a sell-off in October, like this, I'm always, this is the monthly chart again. The market's in a bull trend. I'm always looking to buy sell-offs, and there tend to be sell-offs. There's an increased tendency of a sell-off into October. If you get it and the market starts to reverse, it's usually worth buying. So is that buying because it's a calendar trade? I guess in part it is, but for me it's more buying because the market's in a bull trend and you're pulling back, and the pullback is now ending and the market's resuming up. So I'm buying a pullback in a bull trend. I just am aware that those pullbacks tend to occur more often in October, and they tend to be deeper in October. So they tend to be better buys. So now we have an inside bar. So it's a high one buy signal and a small pullback bull trend. Now, if you buy above 20, do you put your stop down here? No, nobody is going to, well, nobody. Most traders are not going to put their stop down here. So where would they get up? Well, they'd get out below a bear bar closing near its low. But there are no bear bars closing near their lows, right? So they need another way to get out. Well, one way to get out is the market's in a small pullback bull trend. If it stops being in a small pullback bull trend, then if you're wrong based upon it being in a small pullback bull trend, and it's no longer in a small pullback bull trend, it's reasonable to get out because it's no longer doing what you thought it was doing. And a small pullback bull trend means the pullbacks are small. If you have a big pullback, then you're no longer in a small pullback bull trend. How big a pullback do you need to see to conclude that the market's no longer in a small pullback bull trend? One reasonable guide is if the market falls far enough below the low of the prior bar for a bear scalper to make money if he sold on a stop below that bar. And average bar is about the size of a scalp. Now the bars are closer to 5 points tall. So if a bear sold one tick below 20, it had to fall 21 more ticks for him to make 20 ticks profit. So if he sold one tick below 20, it has to fall 22 ticks for him to scalp out with 20 ticks. And therefore, it's reasonable to exit 22 ticks below the low of the prior bar. Because then that's a pullback that's big enough for stop order bears to make money. And stop order bears only rarely can make money in a small pullback bull trend. If a stop order bear is making money in a small pullback bull trend, the market may no longer be in a small pullback bull trend, and therefore it's reasonable to get out. If it goes down far enough for a stop order bear to make money, and then you get another buy signal bar, you buy again, betting that the small pullback bull trend will resume. Here, That's a big pullback. A bear who sold below that bar or below this bar made money, but then you got another bull bar. So the pullback is no longer small, but it's still in a bull channel. So it's reasonable to buy a reversal up from a sell-off. Very strong bull trends, small pullbacks, and then a bigger pullback. Reasonable to exit the size of a scalp below the low of any bar. Reasonable to exit below a bear bar closing near its low, especially when there's a double top. Got a couple legs down, one pullback, two, a bull bar, pulling back to the moving average. And buy again. It's no longer a small pullback bull trend, but it's still a bull trend. It's a bull channel. We have a high, a higher high. We have a low, a higher low. So reasonable to get long again. I said that stop order bears are not making money. What about limit order bears? I would not sell. You see what just happened? We went one tick above, maybe one tick above that measured move, and what happened? A lot of sell orders. So the high frequency trading firms concluded we were going to get there. Once you get close to a magnet, you cannot escape the magnetic pull, and the market often gets vacuumed up there. So there was a sudden rush of high frequency trading firm orders buying until we got there. They took their profits once we got there. And then there were other bulls who wanted to take profits around a measured move, and they had limit orders to sell around that measured move. And that's why the market went just a little bit above, maybe a tick above, and then reversed down. The bears are hoping that the profit taking will be so big, will reverse into a bear trend. Unlikely. Usually, if you get a reversal in a small pullback bull trend, the market will have to go sideways for 10 or more bars before you have a reasonable chance at a bear trend. The market does not have to stop here. It could go a lot higher. You know, we have other magnets up here. One of the problems the bulls have today is, I'll throw up a 60-minute chart. Okay. One of the problems the bulls have is the next magnet is 100 points above where we are. And that's too far above to have much magnetic effect on today. And therefore, we're probably not going to go up a lot more. What about what I said about gaps and body gaps? We have a body gap 13 and 5, and we have a little body gap here. We reversed at 15 after a breakout 14. The breakout point is 12, and 16 tested that. And same here, small body gap. We have a breakout 18, and 19 tested the 15 high, the 16 high. So we're getting gaps and body gaps, a sign of a very strong bull trend. Traders are still buying. There are still more buyers than sellers. But you saw how quickly it reversed down at the measured move. So some bulls took profits. Everything is still a buy. Traders are buying at the market. They're buying the close of bull bars. They're buying above bull bars. They're buying bear bars. They're buying at and below the low of the prior bar. They'll even buy below a bear bar closing near its low. Nothing to sell. Bears are not making money, not even with limit orders. The pullbacks are so small, it's really hard to make money. Well, theoretically, if a bear sold the 15 high and sold more 5 points higher and placed a limit order to get out at his first buy, he made money. But I would not be shorting a trend that looks like this. I would wait for it to change into something else, like a trading range. The market is deciding, is there going to be enough profit taking around that measured move to stop the bull trend? As I said, if it does, it probably will just result in the market going sideways for 10 bars or so. Until the bears get a trading range and a credible sell signal, most bears are not going to sell. Or if the bears get a bar that looks like 6, especially if you get 2 bars like that, then traders will conclude that the bull trend has ended. But until it clearly has ended, most traders are not going to short. I suspect we're going to start to go sideways here for 10 bars. Where's the bottom of the sideways? Is it the 19 low? Is it the 16 low? I don't know. But we're pretty far above the average price. We've been above the average price now for 22 bars. Actually, more than that. If you go back to yesterday, it's about almost 30 bars above the average price. While the market never has to touch the average price, it always does. You know, if you think about the math, the average is based upon the most recent 20 bars, and if the market is going up in a type gold channel, it'll always be above the average price. So theoretically, it could stay above the moving average forever. But what are the chances that we're going to touch the moving average today? 99.99% chance we're going to touch the moving average today. I'm going to turn the screen off for a moment. I want to open another PowerPoint because I want to make a point. Whenever the market has been above the 20-bar exponential moving average for a long time, that means traders have been paying an above average price. Okay, we're above the moving average, the market's going up, traders are willing to pay above the average price, right? This is a very unusual day, okay? Look at this low. It looks like it touched the moving average, but it did not. It missed the moving average by one tick. And no bar today touched the moving average. Okay? This is the first time I've ever seen a day that did not touch the moving average all day. Okay, so that's a really unusual day. Here, we got a dip just below the moving average, and then we had 3 more bars with lows below the moving average. As I said, there's a 99.9% chance that every day is going to have at least 1 bar going at least a little bit below the moving average. And there's a 99.5% chance that you're going to have at least 3 bars that go below the moving average. Here we got 3, plus there was 1 more here, so that's 4. Here, above the moving average a long time, but we had 1 bar below the moving average here. We had another one here. Very strong gold trend, only 2 bars with lows below the moving average. That happens only every couple of years. Here, early in the day, we had several bars below the moving average. Very strong gold trend here, and at the end of the day, below the moving average. Huge bull trend, but 99.9% chance we'll have at least 1 bar with a low below the moving average, and 99.5% chance we're going to have at least 3 bars with lows below the moving average. So we can get to the moving average by going down, or we can get to the moving average by going sideways. And usually it's a combination of both. Usually the momentum up starts to stall, the market starts to go sideways, and the average gets pulled up to the low of bars. Still might get some profit taking here. As I said, I think we're probably going to go sideways to down for 5 or 10 bars. If we start to go down strongly with a series of big bear bars, then it could be the start of a bear trend. But right now, 20% chance of that. But if you get 2 bear bars, then it could be 30%. If you get 3 bear bars, it could be 40 or 50% chance that we're going to switch over into a bear trend. I want to open up another PowerPoint to a bear trend. I want to open up another PowerPoint. So we had a gap up, and we're in a tight bull channel, so if you have any kind of a wedge, it's a parabolic wedge. And it was the high of the day. But as I said, if it is going to be the high of the day, the market typically will have to go sideways for 10 or more bars and get some kind of a double top before you get a trend reversal. So the first reversal down from a tight bull channel, even if it's a parabolic wedge, is usually minor. If the bears are going to get a bear trend, typically the market will have to go sideways for 10 or more bars. Parabolic wedge, basically sideways for a few hours, and then the reversal. Very strong bull trend, a reversal, minor, but about 10 bars later, we have a double top. Still basically sideways. This is where the bulls gave up. If you start to see 2 or 3 consecutive bear bars closing near the lows and closing below some breakout point, then traders have decided that the market is in a bear trend. Right now, we're at this point, right? So we have at least 10 or 20 bars before we can get to that point. Strong bull trend, sideways. So bull flag, bull flag, bull flag, and then a bear breakout. Once you get 2 or 3 big bear bars closing near their lows and below a breakout point, that means the bulls are giving up in a panic. The bears were selling aggressively, betting that the market is now in a bear trend, strong bear breakout. So we have a bear channel, bull flag, but we have a strong breakout below that bear channel. The market clearly became a bear trend there. So now we have a bear inside bar on 23. You can argue a parabolic wedge with 4 legs up, 1, 2, 3, 4, or you could call it a parabolic wedge, 1, 2, 3, and then a failed breakout above the parabolic wedge. Okay to exit longs below 23. You don't have to. You could wait for more evidence that the bears are in control, but I would not short below 23. If we go sideways for 10 bars and get some kind of a double top, then you might get a credible short. But right now, small pullback bull trend, better to not short, better only to look to buy. This is 24. It's the end of the second hour, and 2 minutes remaining. And currently, the 60-minute bar is a big bull bar closing near its high, like the first bar. No more resistance until way up here, about 100 points higher. I don't know that we go up 100 points, but there's no clear resistance or magnet until about 100 points higher. We're at minor resistance here, the measured move, based upon the trading range open, double top, double bottom, bull breakout. But not, I would not sell below a bar in a small pullback bull trend. Wait to see if it changes and becomes a trading range, and then possibly look to sell. Reasonable to exit longs here, but not good enough to sell. Can you sell small, put a stop above 22, and then if it keeps going down, sell more? You could, but I would prefer to wait for more evidence of a top. This is probably going to be minor, but as I said, if you get 2 big bear bars closing near their lows, and 3 or 4 bear bars, it could become major. But right now, we're probably minor, and we're probably in the early stages of a sideways to down move, lasting about 10 bars. All right, I'm going to step aside, and Tim is going to take over. I hope you have a good day.
All right, hi everyone. Big thanks to Al Brooks. Thanks for jumping on, and welcome to all our new traders who've just joined the stream for the first time. Welcome to the community. So today we had a gap up, not a huge gap up in the scheme of things, but 40 points, so probably medium-sized gap. And when you have a gap up, you're expecting a couple of things. One is you know that this empty space is a big breakout bar, and that you're not usually looking to sell immediately because it's a pullback in what's an always in long potential bull trend. And so it's good to be able to wait and see what the bears can do. Now, we just had the close of the second hour on the RTH chart. So you've got the 60-minute RTH here. This was a strong buy signal, and it got good follow through. Usually when you have two consecutive bull bars on the 60-minute chart, you've got pretty good probability of having a leg sideways to up. It doesn't have to be up. It can be sideways and then close up near the highs there. We've had small pullback trend for the past 90 minutes or so. A couple of reversals. We had, one attempt here, 2, 3, 4, 5. And if you think about Al's rule for inertia, 80% of reversals in trends fail. By the time we get that fifth and sixth reversals, the odds are that move has finished. So at the moment, you can see a lot of bulls getting out of their positions. Thought there was some reasonable targets up here. We had a breakout measured move. We had 20 points above 11, breaking out of a range, first decent buy signal. And you see I've got two opening range measured moves up here. There's a couple of different ways to draw it. And my exit was on 22. So I'm currently flat and just waiting to see what the next move is likely. As Al said, the highest probability after parabolic wedge, a tight channel, is a couple of legs sideways to down, and then the bulls will look to possibly buy again. Any questions? Welcome to tag me in the chat. We've got the whole team of presenters on the chat as well, so no doubt your questions are getting answered. I just want to talk through the open and some things I thought were interesting, and I'll cover everything on the chart as well. We've got this body gap between the bear bars here. If you have a gap like this in the middle of the trend, traders often wonder if that's going to be a measuring gap, so you then project that measured move up. So let's go back in time, which is pretty cool. So coming into the open, always good to look at the Globex chart, look at the overnight, what's the price action. We had 3 legs up, 1, 2, 3, and then after wedge you expect a couple of legs sideways to down to correct that wedge and then see what the next move is. Now, this was incredibly bullish, so you're not expecting this to be the start of a bear trend, but you need to see whether this whether this signal bar triggers. And what you can see is that first 15-minute bar here is a very small bear bar. Okay, you've got, see my numbers will be colored 3, 6, 9, 12. That bear bar gets triggered. It's not a very good sell signal. 6, you've got a bear outside bar, and we never trigger. Now, if you get a bar like that that doesn't trigger and we go above the high of that bar, often those traders will then sell above and sell one measured move higher, looking to break even on that trade. So once I saw the 15-minute bears were not in, I was looking to buy. We know with a gap up, we're expecting a bull swing in the first couple of hours, and we're just waiting for a reasonable setup. Now the bears have had 1 triggered, didn't work. 6 never triggered. 8 didn't triggered. 9's got a good signal bar. I didn't take 9. I actually took 10. I thought 10 was reasonable. If I was holding short and bulls have now got consecutive bull bars, I'd probably start to panic once we start going above my bar. And then we've got a strong breakout bar. So by the close, I thought was here, and I had some limit orders sitting at the midpoint and at these breakout points. So 12 didn't hit, and then 13 did. So once you have a strong breakout pullback, that often sets up an always in long breakout pullback high 1 trade. So I thought Walmart was above 11, 20 points above 11, 81.25. Also, you've got high 113 bear bar and then bull bar 14. So I thought, okay, to buy above 14. If you've got out 1 tick below 15, that's okay, but then you need to get long again. So 17 or 20 were your options, I thought. So 3 bear bars down. So probably needs a second leg sideways to down. Good looking signal bar on the 15-minute chart. Did that make sense on the Globex coming into the open? So on the 15-minute here, you can see it has more legs down, and it's not doing what it needs to do below that bar. That means there are no bears at that low. The only bears are going to be sitting at that high and somewhere in the sell zone, and that's the recipe for a good buy signal. Yeah, Gcash, so 11. 11 was the good Walmart, I thought, or breakout pullback 13. 4 bull bars up, selling below 12 or anywhere here. I thought bad idea. So we got the measured move there. 8 failed, projected up. So a couple of good reasons to be long. Hit the Walmart, that's gone. Get rid of those. So what's next? Well, now you've got a huge bull bar on the 60-minute overnight chart. A bit difficult, I think, to buy up there with a stop down there with so much sideways. So the next, what have we got? 4 bars are important to see whether this is going to be a bull bar, or maybe we drift down to the top of that bear bar there. Not a great looking buy signal, and just continue this channel. So no 2, stop below 6, and then buying on 11 and the pullback on 13. So my average was a little bit higher actually, but I had a smaller size here. So I want to get in case it doesn't pull back, but I've got a larger size sitting underneath, hoping for this. Sometimes it hits, sometimes it doesn't, you have to chase. One of, I think, the good things to look for, this is a shaved bar. You see how the moment that bar opened, everyone agreed we need to go higher. I did a little video on shaved bars. I think it's a really great exercise to help you learn price action. Look at repeating patterns and see where everyone agrees. Now, of course, this is really easy in hindsight because you can look at the chart at the end of the day. And that, I think, helps build your price action skill. So 3 bear bars down. I think a lot of these bulls got out. They either get out a scalp below one of these bars that's ousted, or you've got consecutive bear bars you can get out. I've got an average bar range. You can use ATR if you want, which is about 6 points, and that's basically where we are. I'm not sure if no 2 is in the chat because I answered it, but he didn't reply. So we'll see. Inside bar 26. So second leg down likely. "15-minute bears have got a reversal signal. It's still low probability, but we'll see what they get. Reversal signal. It's still low probability, but we'll see what they get. Yeah, the profit target was 1R from stop to entry, but I had 2 entries, so the average. Here's an inside bar 20. We went below it, so I've actually gone below a lower high, putting us into a trading range. There's actually a second lower high below 17. But this is a very tight channel. Usually we have a tight channel with a trend line that breaks. Usually have traders looking for a test back up. And it makes sense as well. So if you are selling above bars and you get a profitable entry, you exit that entry. Now you've broken that swing point. Now the probability has changed and you want to sell as high as you can back up into that range. So what do you do as a beginner? Well, you see 3 bear bars and you immediately try and sell below it. As soon as you take that entry, you get stopped out. So it's difficult to wait for, okay, now there's selling pressure. Now I'm looking for a pullback to see if it's still there again. Selling pressure here, and traders were selling a pullback, the second leg down. So if we close below these kind of micro high lows, can you short? The only problem I've got with shorting is we're right at the moving average. We've also broken out of a range. Maybe the range is here. We tested it. We tested the range here. So I don't think the maths is that good. The target's here, which means I need to sell up there. So I'm kind of trapped out at the moment. Black Shiv's saying, can bears get a trend? Bears can always get a trend. That's the great thing about trading. It can just change in a New York minute. So this pattern on the 60-minute is similar to what happened yesterday, and I'll bring that up in a second. We had an attempt at a wedge, tested the start of the channel, and then we got a new high. These expanding triangles usually just form larger trading ranges, but the stop is miles away on the 60-minute. Hi, Pavel. I'm going to assume you're in the room. Thanks for your question. Bar 1011. Is that an expanding triangle? Yes. Bar 1 to 5. Yeah, that's fair. So expanding, what Pavel's saying is you've got expanding triangle. You've got highs and higher highs, and you've got lows and lower lows. I had this line drawn because I thought we might form a wedge, get a third leg down to reverse. And then when this started to go back up, well, you need to get rid of that wedge. Why was I looking at long? Because when you've got a gap up, you've got a higher probability of a swing long in the first couple of hours. So you give that 5 or 10% to them. Consecutive good looking 15-minute bear bars. So now bear's probably going to get a second leg sideways to down on the 15-minute chart. This is 2 legs at the moving average, closing that body gap. So that was the target for bears at the moving average, closing that body gap. So that was the target for bears. I've got some targets on the chart. I've got 60 minutes, 1 hour if you buy this bar. This is also a measured move of yesterday's range. Not sure we'll go up there, but it could be fun. Daily chart was interesting. When you transition back across the moving average, you've got 1, 2, 3, 4, 5 or 6 bull bars. So the market often reverses around 5 or 6 bars in a row, or at least pulls back. And we've gone always in long, so you're expecting a pullback. So we pulled back to the moving average and then reversed up on the same day. I was not expecting it to do it as aggressively as it did, but that's the daily moving average. So we rocket past it, and bears are selling, 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 selling. Oh, they get stuck, and then we test before we go. Hi, Raphael. Raphael's saying I've got out 1 tick below 15. Yep. Yeah, that's what I was pointing out. Yeah, so I considered it as well because it was a good looking bull bar, and I thought because there's a gap below, so I thought, you know what, I'll just wait and see what happens. And if I, close at a scalp below 15, but then you look at the 14 low and you think, well, we've just gone always in long with a pullback and a buy signal. That's a high 1 buy. That's a really strong buy signal. I just don't want to get out on the next bar. So I think that might be one of the occasions to research having the stop a scalp below. And, sometimes you'll give back a little bit of extra profit, but the other times you get yourself an extra, 10, 15, 20 points. That's a really difficult skill to build, having an open profit and being able to remain calm. Very easy to push the button. So we broke below this second higher low. Could you argue there's a measured move down there for bears? Yeah, I think so. You've got a gap down here as well. So okay to be short, nothing to buy here. We're currently in a bear micro channel. This channel is pretty steep, so I'm not in a rush to buy anything. This open was very trading rangey. Good signals failed. Good signal doesn't trigger. So if this is going to form a trending trading range day, that's the right kind of start. bears that are going for that gap, where do they put their stop? Maybe they have a stop sitting above 23 and that test on 28 to go down there. That's one way they might trade it. That little beep's just telling me the bar's about to close. Someone's asking about the 12 high body gap. Yep, that's just closed. Okay, so consecutive bear bars. The bears really need this bar to be a bear bar as well, I think, to fit the probability. This 15-minute chart was very strong. 1, 2, 3, 4, 5 bull bars. Bull micro channel, probably buyers at this low and lower. You've got a gap on this chart here. Oh, the beeper. Yeah, so I've got this, I just found this website here, timer.fit/play, and it's really handy. It's also, I'll copy and paste it into the chat. It's really helpful on a stream as well, because you dig up the encyclopedia, answer questions, and then reminds me to manage the trade that I've got on. Med Guy, the reason I've got that beep is to make sure that I'm making decisions on the close. I don't have a very good like set and forget trading style. So 3 bear bars in a row, 2 bear bars in a row. We've come back in this breakout point from Globex chart, and if we've come back in that range, then the buy zone is now much lower. Yeah, it's my heart rate monitor. I'm such an athlete, I've got it down to incredibly low rate. Now, bears have a gap to the 26 high. I can turn these gaps on. I thought this trading range on the open was from the daily chart. There were some reasonable buy signals here, this bar that really messed it up for the bears, and then good looking bull bar closing near its high, going up from moving average, bit of an Albrook special, and so the 1R on that buy was here. I like to look at who's got a good signal bar coming into the open, and there were no good bear signal bars on the 60-minute chart. Still on the bears, can they get another bear bar below the moving average? I think if they do, they've got a much better chance of this whole piece having a second leg sideways to down. So the pullback still 27. So if you think this is a breakout pullback, 27 closes below those 2 higher lows, their target is 5644. But I'm currently not in it. So now 3 consecutive bear bars. Bears able to put a whole bar below moving average. Is this a moving average gap bar buy setup? I think this is just too tight at the moment. So you're either short or flat. Stop probably above 26. What happened to all the bulls? They all took profit. Okay, so bears got back to that gap. They've got their 1R just below. So stop above 23, selling 27. Huge move down from the bears. Someone saying tough to watch. The greatest short of the day. Man, it shouldn't be. I mean, if you didn't get a piece of the bull trend up, then you're ready to get short. But I never worry about not getting the second part of the swing. I'm really only looking for one good swing and then some scalps, and I'm done. So Yeah, NMC, that's great. I was going to say if you were just putting limit orders here, this is when you can take a really big loss. So we're back down into the opening range. Only the bears have got gaps. I think we're a little bit low to sell now, and that's just what happens when you get trapped out. 27 was the sell. Didn't want to take it because of the distance to the moving average. Saw the break, and then you just make the call. Now, if today's going to be a trading range and 6 is the low, we're in the lower third. I don't think that's necessarily the case because yesterday was a really good bull buy signal. So the close of that bar is, I think, important. So there's a chance we might see below 6. So we've got big up, big down on the overnight chart. Bull's probably looking for a second entry buy around here. Yeah, GCash, sometimes the second entry is just consecutive bars. So you have breakout pullbacks. So 27 is, I think, is a second entry. You can also sell 28 because now you've got 2 signals. Even if you didn't take the short, not hitting buy is already good, in my opinion. Today's a gap up, and we've had a bull trend for the first couple of hours. So the odds are this is not going to turn into a big bear day. That's lower probability to get down here. If we're not going to get down here, then we're probably going to be sideways. Sideways. So 30 big profit-taking bars for the bears. If they can get consecutive bars here, I think that's even, it's going to be even better. Can the bears get a bigger measured move? Yeah, they might be able to get 1, 2, 3, 4, 5 bull bars in a row, now 3 bear bars in a row. We've got consecutive micro channels. I think traders that bought the moving average, traders are probably going to scale in, betting they're going to get back up there. We've just had a close on the overnight. Yeah, so not great follow through on that bull bar. I think sometimes you can feel like you've missed out on a move. I don't think that way. I used to when I was learning trading. Now I just try not to do the low probability thing. So the lowest probability thing here to do is buying, therefore being flat or selling are the right options. That makes it, I think, easier to feel good when you're trading. And so for the end of the day, you're just trying to reduce those mistakes. Same here. So let's say you're short and now you get consecutive bull bars. Now you know there's a good chance we're going above that high. You also know if we go above that high, there's a chance we're going to close above that as well. So I think if you're short, that's a good place to get out. And if you're not, you say, well, I'll wait for one more bar. Okay, now we go above that bar, I've got to get out. The trouble is when you say, no, I'll just keep selling and we'll get back to that price, sometimes you don't get back there. So even if you didn't buy all the way up there, as long as you're not selling, small pullback, bull trend. I think in Al's encyclopedia, he says, if you are short and then you see a bull bar closing on its high, you need to switch to long above it, which is what traders did there. They sell, they see that, they switch to long. Inside bar is a pause. We're pausing at the 1R target for those bears. Will those bears get more than 1R? Their swing to our target would be basically a new low of the day. Their swing to our target would be basically a new low of the day. That potentially would be an even better buy. Then you've got swing bears buying back, low of a trading range. So we'll see. The inside bars are pullback as well, so you'd have a breakout pullbacks will be another low one on 32. But you're selling quite low in the range, so we'll see. Maybe they're feeling frisky and they want the measured move below 9 back into that channel. Yeah, Pavel, the entry is because you've got an inside bar 26. So if you zoom in on that inside bar, where's the inside bar here? So you've got to pull back and then a sell signal. Yeah, so technically it can be below 26 and you can say 27. For me, I would usually not do that. I don't like to take inside bars as my entry. I usually wait for the follow through. Inside bars have a habit of breaking away and coming back to test. So I think we're going back to the 26 low. All these inside bars on the way up, we broke out, came back to test, broke out, came back to test. So inside bar 31. What do you do if you're a bear? Well, bears are in the low of a trading range. So some might get out a scalp above any bar. 31 is not a great buy signal. Now that we're in a what I think is a trading range, if I get an inside bar, I'll usually just exit my trade. And that can be tricky if you're in a swing. So you're in a swing, you're also in a trading range, and then it's kind of just up to your feel, experience, style. It's great, we've got the full team on today. So let me just check the timing. Okay, so I'm on for another 40. Then you've got Tim Stout coming in. He'll be taking you through. He'll be followed by Rose and then Brad taking you through the close. Absolute trader mega mix today. It's pretty fun. Tim, could this be a deep pullback? Absolutely, Stone. Absolutely. So we're back in the lower third. If we got a bull bar on 32, would I buy above? No, but then I would consider buying below it. I prefer to have bulls in above me if I'm going to scale into something, but I'm not in a rush to buy above anything. And that means sometimes I'm going to miss the scalp. So coming back to test the 13 low, so it was a breakout point. I think better if the bulls can close back in. So bulls had a wide stop up here. You know, to buy up here on this time frame, the 15-minute, you need to stop down here. That's too far. Now the bears to sell, their stop's too far away. So we might have to go sideways to get some traders involved. So 32, good looking bull bar. So if I was short, I'd get out above a good looking bull bar. Our bears can sell again if it rolls over and they get a second leg down. They're going to argue spike down. They need a second leg. Bulls are arguing, well, they need a second leg. And so there's a chance we go sideways in this range. So did not get one tick above 32. That gap is still open. One of the most frustrating things about trading is you wait for a setup, it's about to set up, oh, it doesn't. And then you're waiting for a setup, it's about to set up, oh, it doesn't. And then you end up sitting there for a long time doing nothing. And then you feel like it's time for you to click a button. That's usually moments before doing something silly. Now, because all four gaps of these are open, I said I would buy below 32, but we didn't trigger that buy yet. So I'm not going to buy below anything. I'm open to selling if 33, 34 look good. NB, yeah, the setup comes with the signal bars too big. We've had a lot of those. You know, you're waiting for, you're waiting for a buy signal and you get 38. Like, man, I don't want to buy at the top of the range. You want something like this. But then if you wait for 49, now I'm buying a new high of the day. So timing is super important. Or you get 15, but it doesn't trigger. Yeah, just lots of them the last few days. One leg down, two legs down. The bears get one more leg down below 33. Inside bar, tricky. Plan scuppered, that's it. But it doesn't cost anything to sit and do nothing. If bears get another good-looking bear bar, they're going to argue another sell signal. So far, testing the 30 close, the 31 close. I'll usually only buy below bars bull bars that have triggered, or sell above bear bars that have triggered. By triggered, I mean it's gone one tick above that bull bar or one tick below that bear bar. Then there are other traders kind of in front of me. I mean, the trade can fail on all of us, but it just makes me feel better. Don, yeah, I was long 10, 11, 13 up to the measure move, the opening range target, 21, 22. And I've done nothing here. So currently a bear bar about to close on its low and inside bar. So I think some bears will sell below it. 2 bar reversal, there's a trigger. Bar reversal, there's a trigger. I'm going to see if I get a chance on 34. So bear's trying to get a good entry bar, 34, looking good so far for him. Their target's down here. You've got yesterday's high as well. High of yesterday. So we've got back down to the open, back down to the 9 low. Get rid of some of those other moves. So there's a chance to take 27, then a breakout of this range and a pullback, 33. And that entire range I've got down here, which is back into this channel. We probably did, in hindsight, what a swing of that whole channel. There you go. So 2R up of that whole channel. So traders that sold 8 and scaled in higher, they got out. 6 never triggered. If you sold 1, they were able to scale in and get out. I think if we get to the low of the day, there'll be buyers there under that bull bar. He says overconfidently. Bull's trying to get a high 2 bottom. So the ABR, the bar range was 10, then went to 5. Now it's come back up to 10. In MC, a retail trader selling 8, holding 40 points, knowing it's coming back. I mean, I don't trade that way, but I look at it, and sometimes I'll trade the second piece. So you trade back to those. Look where their break even is, look where they got stuck, and then take the second trade back to their entry. But I tried to trade that way, and it just didn't suit my personality. If you can sit in a losing trade for a long time, then I think it'll work out for you. But occasionally, so you actually have a really high hit rate, but then when you lose huge. So you actually have a really high hit rate, but then when you lose huge. Starting to get more tails on the bars. So still always in short, but low in trading range. So more bear bars. Bears have sold 33, they see 34. Until it comes back up to the entry, they might just hold. Matt's saying I'm the master of sitting and losing trades. Yeah, got to cut that habit. Got to cut that habit. Unless you've got the opposite habit, which is when you're in a winning trade here, 11, 12, you're constantly adding. Until you take a loss on your last position and profits on all the others. Something like that. But I used to scale in heavily on a losing trade, and then the moment I had 5 points on a winner, I'm out. So the maths is just the wrong way. Bulls might need to get 2 reversals here because 32 is a good-looking bull bar, didn't trigger. Probably need to start going sideways. How do you cure that? Oh, it's a long process. I think you got to see being flat as a good thing. I'm flat now. So before I think, oh no, I'm not in a trade. Oh, everyone else in the stream's in a trade and I'm not. Like I could have that self-talk. But I feel good because I can get long, I can get short, I can do anything. So it starts with self-talk and then yeah, you know that in the next 6 bars, the trade's going to set up. So I think when you start learning trading, you take a loss and you immediately want to get a win so you can feel good, you feel whole, you feel better about yourself. But usually a trade's not going to set up for another 4 to 6 bars, depending on what you trade. And that one might also be a loser, you know. And that one might also be a loser, you know. Trade a smaller size. Yeah, that's a good one to ask the other presenters as well. It's a good question. Thanks for that. So bears trying to get to low of the day. They've got a measured move. Starting to get tails, starting to go sideways. Matt's saying, yeah, been tightening the stops. Yeah, that's fine. Because the habit of taking huge losses is to constantly move your stop away. That's a bad one. You've got to get rid of that one. Get rid of that one. Bear's still short. They're trying to get a spike low 1 on the 15-minute chart. Bears had a couple of legs up. So bulls had a couple of legs up. Bears trying to get a couple of legs down. Legs up. Bears trying to get a couple of legs down. So bulls that are buying 5 points below these bars, they're able to do it in a way that if there's suddenly a big bear breakout, they know when to close that trade. Okay, so another inside bar. We've had 3 inside bars here, so that's the end of another leg down. So there are bulls that look at a trading range, they see a good-looking sell signal low in that range, and they immediately buy below it. If this was flatter, I'll often do that. It's a bit steep at the moment, so closing that gap to the 33 low. What are the odds of it going back to yesterday's close? Yeah, good question. I mean, because it's a gap up, and we've had a bull trend, the chance of this turning into a bear trend is very low. And you can see already, traders already starting to buy or scale into longs before we get there. Because yesterday's a good-looking buy signal, like if you look at the daily chart. I mean, it's an outside bar, you can argue, with a bear breakout. So traders might sell above it, but we've just gone across the moving average. We've had a pullback. It's a high one buy. So I thought there might be traders waiting to get back there. So 36 is a second attempt. It's a high two bottom. The signal bar is getting very large, isn't it? I said earlier, when you have days that start with 2 consecutive bull bars, puts a bit of a limit on how far it can go down. There's certainly days where that's the high and you crash down. But I think there'll be bulls buying below here. If 36 closes on its high, you'll have bulls who'll start to buy above. At the moment, it's pretty large. I wanted to buy something smaller. Testing the 33 close. So if the bulls can close above the entry on 33, some of those bears might decide to give up. If we're just going to test that entry, I think some of those bears will just still hold. The bears will just still hold. So they're managing it from their entry. We broke below, traders bought, they bought lower, they got out. Bulls need to do more. Pavel, I just showed you the lower time frame just as an example when you're talking about that inside bar, but I can tell from the inside bar on the 5 minute. So when you practice with the 2 time frames, then you don't have to go down there to see it. So I can see the 15-minute chart from this chart. But it just takes a bit of time to practice that with the 2 charts. Then you can do 3 charts, and then it kind of all just blurs in together, which is really handy. Before, if I had 2 charts on the same screen, I'd just get dizzy and confused and take nothing but losing trades. Can 36 close above 33? I'm not looking to buy above 36, but it might put an end to the move down. Limit order market, probably. It's at the same price, 44.25. Oh, 1 tick below. Interesting. So it's cool that you get to listen to a couple of different traders. So we all trade, we have similarities and differences. So for me, if I want to trade a reversal, I need bull bars to be triggered before I buy. So I didn't get it on 32 currently, so I'm flat. I didn't take the sell. Nice, so 37 goes above 36. I think more of those bears will start to scale back out of that trade. 36. I think more of those bears will start to scale back out of that trade. $35 is an inside bar, so it's the end of that leg. So technically the bulls just went above a lower high. I think 33 is a little bit more important. So 60-minute chart, good looking bear bar, small tail. Can the bears get below 34 to trigger that sell? Got Owl's Encyclopedia here, highly recommended. It's got a decade, sorry, 4 decades of his trading experience put into one very tight document. So we had a gap up in the gap up section. So looking at parabolic wedge up, sideways. Bears had a spike down. They would like to get this, and we end up back in the middle of the range. Here, this is the lowest probability, but still can happen. You know, if the bulls can't get any buyers, strong breakout and follow through, low one sell. We didn't quite do that. Didn't quite do that. Where's parabolic wedges? Sideways, couldn't get below the low. Test below the low. So you see how that puts the day into more of a trading range flavor. Okay, so lower high and then strong sell-off. A few legs down. Some ideas. Okay, so getting above 37. Okay, so I think some of those bears look to manage that trade based on 37. Oh, thanks, Rose. Nice. Yeah, we've got lots of gaps open. Thanks for putting that up. So bulls get a small second leg sideways to up. I think bears will still try and sell at the moving average if they get a decent signal bar. So on that slide Rose has put up, there's a basically second leg trap from the bulls. They get back up here and then we collapse down. So on that slide Rose has put up, there's a basically second leg trap from the bulls. They get back up here and then we collapse down. You can see on that chart, there's a bear bar here. That's terrible drawing, but you know what I mean. One problem the bulls have up here is that these gaps become targets. Some traders will be aiming for those targets as opposed to getting there and then holding. So that's in the top 50% of the range. On the open, when you have a gap up, often traders are waiting to see consecutive bars before they look to take a position. Bear bar, and then you get 3 bull bars. Because we've got 3 bull bars on the open and a gap up, traders will start looking to buy below. The buy above 7, not a good looking bar and at the top of the range. 9 small, but 9, 10 get follow through. We go above that bear signal bar. So it's just putting pressure on those sell signals. But okay to do nothing for the first hour. Wait till it gets clear. So it looks like bears are going to try and get the signal bar at the moving average again here. Looks like limit order trading. Bulls not in a rush to buy above. The buy was under 35. I wanted a small bull bar 36. Now I'm at the top of this range underneath the moving average. I think Tim's going to be joining us in about 5. Do a bit of a baton change or baton. Let's translate it like an Aussie. Okay, so bull doji, 3 bull bars. Bull doji, 3 bull bars. It's not a great buy above. Bears are going to try and get that sell signal. So I'm watching here to see the traders that sold there get out or do they stay in. Joff was saying, I've got a delay. Well, my clock and no, the delay's not on my side. It might be on the go-to meeting. So far, more bears on 39. Traders that sold below that 15-minute bar, we got back to their entry. Yeah, thanks, Tim. Yeah, we've got several thousand people in here today so that everyone can take a look at the webinar, but we don't usually have such a big delay. So big bar 39. So like we said, not a lot of bulls looking to buy above. They needed 37 to be bigger. Doji, more bulls buying back in the lows of the range. Can bears get a strong sell signal 39? On the way down here, bears sold a low one. They had a spike pullback low one, spike pullback low one. Are they going to sell a low two, two-legged pullback? Or can the bulls take it over with a second leg up? Looks like we've got a bit of breakout mode on the 15-minute chart. Traders looking for another signal bar. It's been limit order trading for the past four or so bars. Looks like we're going to get another doji here. Now, I think that'll bring me to the end of my session. You're going to have Tim Stout jumping on very shortly. He's going to take you through for the next couple of hours, followed by Rose. But thanks for having me on the stream. Hope you got some points on the way up or on the way down. Okay, so 39, bear bar under the moving average. Tim's ready to go. All right, I'll jump off. Thanks very much, everyone. Have a great trading day, and I'll catch you soon.
Good afternoon, everyone, or good evening, wherever you are. My name's Tim Stout, and we are around the midpoint of the day. Bar 40 is just printing now. And obviously, we had the big up, big down. That leads to confusion and usually a trading range. Let me just check if my sound is coming through okay. I think it does. So whenever there's a big breakout, and yesterday was a big breakout, everyone looks at the follow through. So, and that is on the daily chart, that is on the weekly chart, but also on the 5-minute chart, 15-minute chart, whichever time frame you have. Big breakout, for example, today, bar 11 or 9, 10, and 11, reaching above the range of the day, everybody's looking at the follow through bar, and the follow through bar was a bull bar. You can then see that 13 tested back the breakout point. The breakout point was the high of the day. And so it makes sense that the breakout target measured move up was the range of bars 5 and 6, or the range of the opening range. And that is exactly, like Al already explained, that led exactly to the high of the day. If I do it exactly, then you can see what I mean. So there we had the high of the day being a measured move up. Now, yesterday on the daily chart was a big bull bar as well, especially on the RTH chart. And so everybody is looking to see what the follow-through bar is going to look like. Is it going to be a big bull bar closing on its high? Is it going to have a bull body at least? Or is it going to fail and lead to probably a reversal? Well, the area here is pretty bad for the bulls. This was a big leg down. We went up all this way, and the bulls are hoping, of course, to break above the last lower high. But what you see here is that this bull bar had no follow through. This bull bar had bad follow through. This bull bar had bad follow through. This bull bar had good follow through, but went back down. And now you have this big bull bar. Do you think that there are a lot of bulls betting on a breakout to a new all-time high above this bar? if it didn't succeed above here or here, we also have 3 legs up. So one leg up from here, pullback, a second leg up here, that bear bar there is the pullback, and then yesterday went from a gap down to a new high, and that is the third leg. So we are forming a wedge in what is now a larger trading range, and we're high in the trading range. We have entered the sell zone on the daily chart. So today is going to be really important. Will today be a big bull bar follow through, or will it be a bear bar, or will it be something of a doji? Well, right now we're hovering around the open of the day. The open of the day, 56.45, and it's becoming a little bit of a magnet. It was a magnet in the first hour, and now it's a magnet in the third hour as well. We went a little bit below it. We stopped selling there. We went a little bit above it. We went a little bit below it again, and now the last 10 bars or so are all oscillating around the open of the day. That makes it likely that the open of the day is important. Is the day going to be a bull bar or a bear bar? The other thing that you have to notice right now is that the range of the day is still below average. Range of the day has been 80 points, 100 points, sometimes even 200 points. And right now, we haven't even covered 60 points. So that makes it likely that the daily range is going to expand. Is it going to expand on the upside or on the downside, or both? At the moment, we don't know. Market's still always in short. This is 3 legs down. 23, 24, 25 is one leg, 27, 28, all the way to 30 is a second leg, a little bit parabolic. And then you have a third leg, 33, 34. So 3 legs down, you would expect that that could potentially be a wedge, but this is a little bit too strong. This is much stronger than this. We reversed in way less bars than that we went up. And there was something wrong with this bull trend. It didn't look like a bull trend that was going to last all day. And Al was mentioning that at the time. After bar 14, again, what happened here, none of these bull bars got strong follow through. 14 should have had a bull bar 15. This should not have been an inside bar, but actually a new high. And then here, exactly at the measured move, we had no follow through. Several inside bars and gaps. That was a target for the bears. If you enter on 9, 10, or 11 and you trail your stop, I think you should have trailed your stop to below 20 so that you would have gotten out below 20. If you're betting on higher highs, higher lows, then somewhere below 20 or below 19, you should have gotten out because we were not making higher highs and higher lows anymore. Many times, the first time that we break a higher low, we don't immediately reverse to a bear trend. Often the market goes sideways and you might actually get a resumption of the bull trend. But in this case, we did get a bear trend, actually got a bear swing. So after three bear bars here, you could sell below 27, a bear bar closing on its low after taking out several higher lows. And the swing was below 27. So the Walmart swing below 27, that would be 61.50 if you entered one tick below 27. And then 20 points down is 41.50. That is about where the market paused. So a lot of bears taking profits 20 points below their entry. Some bears will bet on 40 points below their entry, and we haven't reached that yet. That is 21.50, and that is right there. Bears are hoping that they can get a 40-point swing, 40 points below 27. Now, what is the market at the moment? Well, the pullbacks are getting deep, right? So whenever I see a trend, I'm always looking at the depth of the pullbacks. So you had a bear breakout, but it pulled back 75, 80%. That is probably not a bear trend. You had a good looking bull trend, not pullbacks not too deep, small pullback bull trend. And it failed when we started breaking higher lows. This bear trend, well, we had almost no pullback at all until we had 31 and 32, but that's a small pullback relative to this leg down. This is a leg down, and it had a deep pullback, almost 80%, 70%, call it what you will. That is a signal that the bear trend is losing its momentum. We can still go down further, but bulls will scale in below prior lows. So bulls will buy the low of 36, they will buy more at the low of 6, they will buy more at the bear target 2150, and they know that they can scalp and probably make money if they manage their trades correctly. The market is at the moment still always in short, but we are getting dangerously low to support, right? Support low of the day, yesterday's close, and then probably here yesterday's bar 82 high as well, that little inside bar that we have there. So will the bears reach 40 points, 2150? Well, the bears that are short, they have been shorting all the way down, so they are comfortably short. They have taken partial profits and they'll let their remaining position run to 2150. If you're flat and deciding what to do now, then you're looking at this thinking, well, we're at the lows of the trading range, but maybe we'll go lower. Flat is probably the best option right now because it's not strongly bullish enough yet, right? This should have gotten more momentum and it's not strongly bearish. The pullbacks are getting too deep and we're entering a level of support. I do think there's a chance that we'll go back to 55 and 60. This would form a high 2, the high 1 above 36, and the high 2 above 41. If this would be a very strong looking bull bar, bulls would buy, but at the moment it's still weak. 13 seconds to go. Some bulls will start buying, but those are the bulls that will start scaling in lower and lower. At the moment, it's either short or flat. And you can see what the bears are doing. Towards the close of the bar, they put the bar down and the bar doesn't close very bullish. Some bears will see 41 and exit because it has a bull body and it's at support. Other bears will hold, trying to get to 2150 and yesterday's low. They also know that the range is still small and that we're probably going to go below the day or above the day today. And when we're low, it's more likely that we'll go below the low of the day than above the high. What do I have there as 89.50 breakout measured move target? Well, yesterday had a huge breakout. We suddenly had an acceleration up. And if you were in the trading room yesterday before the open, I already mentioned that if you see something that's strong at the end of the day, no matter bearish or bullish, that is end of the month shenanigans. And so if you see big bull bars, don't fight that, actually hold it. Chances are that the day is going to close at the day's extreme. So if I would have seen big bear bars, I would have sold and I would have held into the close. But we had big bull bars and I held into yesterday's close at around 56.20. But there was a breakout. So we had this whole daily range and then we have a number of very large bull bars. We have a bar 79 that tests the breakout point, and the breakout point was yesterday's high until bar 75. So this low, that high, measured move up is 89.50. That is the target for the bulls, and they want to get there over the next few days. Can they get there today? Well, if the day range still has to expand, then yes, they can get there today and even go a little bit above it. If that breakout is going to fail, it means that we'll go lower than 72.50 and go back into yesterday's range. That is what the bears are hoping. Bears that are still short right now, they're hoping that we're going to break below 6 and that we're actually going to go down a measured move, the size of the range of the day so far. And that would bring us, exactly to 72.50. The fact that it leads to exactly that target, is that making it more likely? No, that's many times just coincidence or things that you want to see. The fact that today's range and measured move down is exactly to the breakout point doesn't make it more or less likely that we're going to do it. Actually, right now you would say that the bears are stalling. They are unable to break the low of 6. Can you be long? No, I don't think we've seen enough bullishness to be long yet. You can't really buy above 41. You can see more bears are scalping short above 41 than that bulls are buying, and we immediately go up. The high of 5, I think, is important today. We broke above it once and we came back, bulls will probably try to break above it twice, and then hopefully what they are hoping for is that they can get a measured move up. This is now a sideways trading range that they can get a measured move up back to the close of bar 21. Right now, sideways, right? We had a big up, we have a big down. Sideways is probably for the next hour or so what is going to happen. Sideways between where? Well, probably between where we are now, the 6 low and 2150, and the high of 32, the high of 5, and that's where the bears will be selling and scalping. So that is for now the trading range. I can draw that on the chart here. So I think the sideways is probably a little bit above here and a little bit below here. That's probably for the next hour or so what we're going to do. Again, daily chart here, big breakout, and the follow through is important, right? Whenever you have a big breakout, traders will always look to see what the follow through looks like. So you have an attempt of a breakout attempt, bull bar, not really strong, but then when you have another breakout attempt and you get a bear bar follow through, that puts the market always in short, and we're probably going to go lower. But something like this, you have a big bull bar, but the next bar is going to be a bear bar. That's not going to find a lot of bulls wanting to hold. Bulls that buy above a bull bar and see a big bear bar as the follow through bar, they're more likely to exit, break even where they enter, if they get the chance. And so after a big bull bar like yesterday, the follow through is going to be really important. And the follow through, the color of the bar is going to be determined by the close compared to the open. And that's why the open today is such a big magnet, right? We tested, most of the bars today have tested the open. Bar 40 and bar 40 to bar 50 is often the time for a reversal. It's the middle of the day, and the middle of the bar often in any time frame brings a reversal. 2.5 minutes into a 5-minute bar, you often see a move. 7.5 minutes into a 50-minute bar, you often see a change. And 6 bars in an hourly bar, look at this, this is bar 6, this is bar 12, so halfway into an hourly bar, you often see a reversal. And bar 40 to 45 is around the midpoint of the daily range. And so you could set and see a reversal around the next few bars. If we print continuous bull bars, and if 43 is another bull bar, we have 3 bull bars in a row, market becomes always a long, and more bulls will buy the close of 43. Whenever you see 3 bull bars, that has some weight. 3 bull bars or 3 bear bars. 3 bull bars, high chance of getting a second leg up. 3 bull bars, high chance of getting a second leg up. 3 bear bars, market is always in short, high chance of getting a second leg down. 3 bear bars, even a pullback will probably come down to the close of that final bear bar. 3 bull bars, disappointment, but market came down to the close of that final bull bar. And so 41 bull bar with the small body, probably a few ticks, but 42 closed higher, and 43 is another bull bar closing higher as well. More and more bulls will start buying, and more bears will exit. Bulls probably want to get to 55 or 54.75, as well as the Globex high. The Globex high was around 62 before we traded, and we broke above it. Bulls want to break above it again. I think that's in the area of 56.60. If you buy 43, where's your stop? Below 41, start of the leg up. You can see more and more bulls are buying. Slowly but surely, every time frame becomes more and more always along. The 1-minute chart is already always along, now the 2-minute chart. And in 2 minutes, if it closes like this, the 5-minute chart is always along. So surely more and more bulls are stepping into the market. Now we judge bars, of course, by their close. So again, we're 3.5 minutes into the bar. In 90 seconds, this bar can look totally different. Sometimes in the dying seconds of a bar, the bar changes its behavior. But I think 43 is going to remain a bull bar and it's going to get bulls buying the close. What's the first target for the bulls? The last and most recent higher low. That is the high of 32. So we had a pullback and then we had a new trend extreme, like bear trend, new low in the bear trend. So the last high of the pullback, the high of 32, is the most recent lower high. That's where the stops from the bears are that are trailing a bear trend. And so that's the first target for the bulls. If they want to break this sequence of lower highs and lower lows, then they have to get above 32. One tick is enough, because then officially you can't say that we're making lower lows and lower highs anymore. So 43 is probably going to find bulls that want to take it to above 32, and then 60 and higher is also targets. Can we still get to 89.50 today? Absolutely. We can do it in one bar these days, right? We've seen bars that are bigger than 40 points. If we don't reach it today, but come close to it today, then probably what you'll see is that tomorrow will open around and just above that measured move target. I think the breakout right now is strong enough that we're going to get there. All right, buy the close, 43. This can pull back, of course, all the way back to 42, 41. Stop is below 41. But you can see that not a lot of bears are selling. Well, they were selling 36, 37, and 38 because that was much weaker. 43 is a strong bull bar. Some bulls look at 43 and think that's too high in the range. What I'm going to do is I'm not going to buy the 43 close. I'm going to buy 5 points lower. And if the close is 51.25, I'm just going to buy 46.25, right? 5 points lower than that close. And then I'll buy more, 41.25, 10 points lower. Or I put a small position on, not to miss a big breakout, but then I put bigger positions on lower, and then see what the follow through on 44 looks like. The smaller this pullback is, the stronger and more bullish this new trend is going to be, because if a lot of bulls are not able to buy as low as they can, they need to get in higher than they were planning to. That fuels more energy into this bullish move. Close above the moving average, breaking this bear channel that was sort of in the making, and so always in long, but high in the range, it has to be said. But I do think we can go higher, probably the high of 5 and 56.60, and we'll see what more we can see. It's still a trading range, right? And so if you're trading this from the close of 44, you're expecting 70.25 to be a 1-to-1, and ta-da, you're expecting 89.50 to be 2-to-1 from buying the 43 close. But again, the fact that that just nicely aligns says nothing about the probability. But that is where bulls want to get to today. The stop is below 41. And if that's too far, for your risk to be taking the trade, you can only do two things. You can trade smaller, you can trade a micro, you can trade the SPY, but you can't negotiate with where the stop is, right? The stop is below 41. Just because that is too far from where you want to enter, you can negotiate a different stop location, because the bulls will only look at 41 as the stop location. And so taking a stop of like an arbitrary 10 points, that's not going to lead to a good trader's equation. Many times you'll get taken out exactly where other bulls will buy before the market kicks off. We reached the 5 high. That was the first target. We reached the 32 high. That is the second target, or vice versa. Can the bulls get all the way up to 60 and higher? Can they get a breakout from this range? There's a small range here, think I do it like this. There's basically a range here, this range, and the bulls are trying to break out above this range and get a measured move up. A measured move up from the 34 low to the 32 high is 75.75. And by the close 43, is 70.25 and 89.25. Well, it's officially 89.50, but 89.25 is a big target. Oh, don't do that. There we go. How big can 44 be? Can 44 be a strong breakout above 32? Can it convince the bulls, other bulls, breakout bulls, that they have to hold for a measured move up? Or will 44 be disappointing? If you think about 43 as yesterday's big bull bar, then again, bulls will want to see what is the follow through. If you buy 43, you know that you're buying high in the range. So if 44 is disappointing, you'll be very quick to exit. But if 44 looks good and then 45 looks good as well, increases the chances that will go higher. Now, strong close 44, close above 32, close above 33, close above 5, increases the chances that we're going to go at least a little bit higher. Now, it's still a trading range, and so pullbacks can be deep. Worst thing to do is take a good entry and then exit out of a panic because you see a good bear bar. After 4 bull bars, a bear bar will be bought by the bulls instead of lead to an immediate reversal, at least 70% probability that it will. So yes, there is a gap to 42 and we might actually go and close it, but that will be an area for bulls to buy more so that we'll return back to 44. This is a buy to close rally, much like 9, 10, 11, and 12. Is it going to fail at some point? Of course it will. But right now, some bulls will have been smart to buy the close of 42, but bulls are definitely buying the close of 43 and the close of 44. And if they can't scale in lower, they'll have to scale in higher. And that's how they add to their position. What you want to do is, of course, you want to exit the trade in profit with as big of a position as you can, and you want to have a loss if you have with as small as a position if you can. That's why these bulls are buying small on 42. They know that the probability is not very high. They're probably going to lose and will get a new low, and that's why they buy small. But now the probability is increasing, so they buy more. Now the probability is even increasing more, so they'll buy even more. And then by the time we're at 60 or 70, 56, 60, 56, 70, that's where they'll exit with a large position. However, the overall context is still that we're, of course, at the lower end of today's range. Important as well is that we have a gap. We have a gap between yesterday's high and today's low, and that is unusual. I think in the next few days somewhere we're going to close that gap. Look at all of the daily gaps from the last month or so. They've almost all closed except for this one and these ones, but now we're so high in the range that having gaps to that high is fairly unusual. Bulls see a breakout above this trading range, a pullback to the breakout point, and they're now hoping for continuation into the 75, 56, 75 range. Bears trying to make this a failed breakout. If we close inside the range and we have another bear close inside the range, they will consider this to be a failed breakout. Successful breakout breaks out, probably wants to test the breakout point and then immediately continues up, just like yesterday, the big breakout. This is not looking all that strong as a breakout with continuation. We're hesitating, and the bar is not a bull bar so far. Increases the chances that we'll pull back into this range and then going to try again to break out above 32. Good to be long, good to be flat, looking to enter lower, but good to be long as well, hoping for breakout continuation and at least a little bit higher to 60 and maybe 70. How about selling here? Well, selling against 4 bull bars with a bear bar that looks so weak is probably not gonna find bears anywhere selling below 45. Now, for a trader starting out, these days can be very confusing, especially an open like this. You have a big bear bar closing on its low. You think, bear trend from the open, I'm going to short below 1, and 10 seconds later, we're already 5 points higher. Then when we take out your stop, then the market races back to your entry, and you're sitting there like, I lost a heap of money, and now price is back to where I originally shorted. Always better to see this, first of all, as a gap up, and so the market is bullish. If you paint this gap here as a bar, you would paint a huge bull bar. You got a big bull bar, you got a big bear bar, and big up, big down, confusion, probably in the trading range, and you're selling at the low of what you then know is a trading range. So you want to see at least consecutive bear bars, probably 3, before you would be willing to sell. And then by the time we break a new high, well, then we're at the high of the trading range. And so probably better to look to sell than to buy. But these opens can be very confusing, especially during bar 6 when it happens, during bar 7, I mean, when it happens so quick. I was clicking like a madman to get in and out the positions that I wanted to, and ultimately did okay, but it was hectic, of course. But if you have a plan, then you just execute the plan at that moment and don't bother. But in general, opens like this, opens in general, I would always give it 3 bars and probably 6 bars to see what the day is like before I would start trading. Usually, there's a Walmart swing, and the Walmart swing is the type of swing trade that you put on, and you put your target in a normal day 20 points away, and you just let it run, right? You put your stop, you put your target, and you go do something else. Usually, the Walmart trade can be found by looking at when is the market clearly always in long, and when is the market clearly always in short. The first pullback after a clearly always in long or clearly always in short, that can be the Walmart trade. Well, the market was clearly always in long after 3 bull bars, but you didn't get a pullback that you could buy. The market wasn't all that clearly always in short here because 6 didn't get any follow through. So there was no Walmart trade here. The market was clearly always in long here, 9, 10, 11, 12, and the Walmart trade would have then be here, but it failed, right? Came back down. Market was always in short here, and the Walmart trade in this case was therefore after the first pullback, 27, a bear bar closing on its low, 20 points. And that was, I think, something to look at today. This bull trend never had a pullback like a high 2 or something that really set up the swing long. Every big bull bar didn't get follow through. Something was wrong here. And in the end, you would just say it's a spike and it's leg 1, leg 2, leg 3 was a wedge top and breakout from the trading range. Probably it's going to be closing the gaps to the downside. And now we're on our way to closing some of the gaps to the upside. Most recent gap, the low of 26. There's no gap here. There's no gap here. So the gap is here to the low of 26. Bulls still looking at this as a breakout above 32, a pullback to the 32 high, and continuation up from 46. 47 and 48 are going to be important. Can we get more follow through? Because we've reached my second target, 56.60. Well, technically my third target, because my first one was the 32 high, my second one was the 5 high, and 60 was my third one. There are more targets to the upside, but we don't necessarily have to reach them. There is a chance that this is a second leg trap. Leg 1, pause, second leg trap. Bulls are hoping it's a breakout above 32. Bears are hoping it's a second leg trap. 47, 48, and 49 will give a little bit more information as to what it's more likely is going to be. I do think that we're going to go a little bit higher, but 56.60 and the 12 close, those are important targets for me. Also, important 47 and 49. 49 will be the close on the 15-minute chart as well here on top of the screen. We have a huge bull bar, but again, what will the follow through look like? Will it be a follow through bull bar and more likely higher prices, or will all of these bulls start taking profits now that we're back at their original entry, and we will come back down for a second leg? Slightly higher probability that we go higher than that we'll fall down towards the open, but we'll have to see right now what 47, 48, and 49 will bring. Stop for the bulls, still below 41. The 60-minute chart has an even bigger target. So we had that sell-off yesterday right before the open. This is the 60-minute chart with Globex. We had that sell-off on the news event. I was presenting yesterday and I said this is a bull channel after a big bull spike. So spike and channel bull trend, usually a reversal will test the start of the bull channel. And we went a little bit lower than the bull channel and then strongly reversed up. I said at minimum you would see a reversal up of 25% the size of the bull channel. But we got way more than that. We actually trapped all of the bears that sold any of these strong closes. A breakout above this range actually points to 5,700, a little bit above 5,700. That is where the bulls on the hourly chart will want to go to. But bulls on the hourly chart, that can take many bars to get there. So that it can be tomorrow. It could be next week. But that is a breakout measured move target for these bulls. On the hour today, you can see these bears maybe selling that close and that close. They got stopped out. And now, if they sold more, they actually got out break even. Or these bears that sold here actually turn to bulls and they make their money back by buying where they were selling. And so we're probably going to 56.60. That was that high. We broke above it once, we're breaking above it twice. On the 50-minute chart, I have that measured move target. You can see the breakout there as well. The white marked area is the daily session, and the marked area is the overnight price action. So here you can see on the daily range that we had that range there and then broke out of it, tested back exactly to the breakout point. Measured move up is 89.75. And many times when you have a clear measured move breakout target, right before we hit the target, we pull back with a deep pullback. And that is what happened today as well. That gives more bears the hope that we're not going to reach that target and that we're instead going to fall back to the original range. Other bulls will just see it as a test of the measured move target and the pullback, and they'll buy again for the second try to reach that target. And many times on the second try, it gets to that target and even a little bit above it, typically a scalp size. And if we reach 56.90, yes, then it's likely that we're also going to reach the 5,700s. It might even happen today. The daily range is small enough that we can actually extend it all the way to the upside and test 5,700 today. 46, bull bar. We went above 46 and 47 is disappointing, but we haven't gone back into the range. So bulls need to do a better job now, but the bears are not selling. Haven't done enough yet to change this from always and long into anything else. It might become a small pullback bull trend. Again, a couple of bars are needed here to show me if this is indeed a small pullback bull trend or that we're going to reverse back. Still always and long, no need to exit, probably good to just hold long. Can always take partial profits at 56.60 and then wait to see what happens when we go higher. 3.5 minutes before the 15-minute bar closes, and the bears are trying to make bad follow through. They want a close that's lower than the 45 close because then the follow through bar would be a bear bar. I think whatever happens, even if we pull back, we're still going to try again to go higher. So the market is always in long, and I would look to buy more lower. And if that doesn't happen, I would look to buy more higher. 48 is the first pullback since 41. Every bar closed higher than the prior bar, and none of these bars pulled back below a prior bar. So it's the first time that we actually go below a prior bar. Some bears will want to sell below 41. They can't. They will sell below 42. They can't. They sell below 43 and so forth until they find a bar where they can sell below. And they might get a scalp out of it. That's why in a situation like this, it's still a trading range. It's not the best idea in the world to buy below prior bar low. That's too high. Other bulls have bought the 43 close and already taken a scalp, holding their remainder. So you buying below 47, that's buying too high in the range. A lot of bulls will actually do the opposite, and they'll buy, for example, 10 points below 47 low. 47 low is 56, and the low right now is 50. So a lot of bulls will buy 5 points below 47, and other bulls will buy 10 points below 47 if they can. The high of 32 was the breakout point, and it's very likely that we'll test that again, no matter how deep this pullback is going to be. Bad follow through on the 50-minute chart, but probably at least going back to the close of 45, the high of 32, and the bulls are scalping. Some bulls that wanted to buy the 43 close but wanted to see the follow through now have the ability to buy the 43 close, and that's a lot of times what happens. You can see that we're breaking out above a more recent lower high, and then the bulls say, okay, I'm going to buy 44. I'm going to put a limit order to buy 43. I'm even going to put a limit order to buy 42 and 41, and then we'll see what happens, how deep the pullback is going to be. And right now, their limit orders on 41 and 42 are obviously not filled, but they are filled on their 43 close or tick above 43. And that still targets 56.70. What about the open? Well, that's still a potential magnet. The bears are selling above the open because they know that the open is an important price. We tested the open for so many bars that there is a little bit of a magnet there. Consecutive bear bars, so some bulls will exit and look to enter again, but we're still closing above the 43 high, and that will keep a lot of bulls into their longs. I said 48 and 49 are going to be important. If 49 is a third bear bar, then the market has a chance of becoming always in short, dependent on how it looks like. But right now, still always in long. I wouldn't do anything about my long swing. Still think that we can go higher. But if 49 is a bear bar, yeah, then we have the same as here, 3 bear bars in a row. That means something, and chances are then high that we're going to get some sort of a second leg sideways to down. So I said that the bulls were hoping that this was a breakout above 32. With the pullback of 48, it's more likely that the breakout is above 38, right? 48 is testing the 38 high. And so that lowers the measured move target a little bit, because now we're looking at the low of 41 and the high of 38, and that target is 69. Take this away. Let me draw another target here, which is 71.50, and I'm going to write there 20 points above 43 as the target. And then 91.50, obviously 40 points above 43. So these targets, I'm always looking to see what happens at these targets before I make a decision to take profit or not. Or I take partial profit and then see if I also want to take profit on the remainder position. We're going to get deep pullbacks. Even if we go higher, we're going to get deeper pullbacks. You can see 60-minute chart, we had a high 1. Now we have a high 2, but the high 2 is at a worse place than the high 1. That is usually a bad signal and probably going to need another leg down here on the 60-minute chart. All that close, 44. That is right here. increases the chances that a pullback could go as deep as 56.44. So still always in long, but it's a trading range. You can have pullbacks that are more than 50% the size of the legs, and that high of 42 and the open of the day are still magnets for the bears. So means that the market is always in long, but you can experience deep pullbacks, which are a chance to add to the position so that you can scale out at, for example, the 43 close, right? You're now long the 43 close. You're hoping for 69, 71.50, and maybe even 56.90, but maybe that is on a quarter size, and you have another half size with a limit order lying around here that you could deploy more longs, and then you scale out again at the 43 close, and then still run the remainder to 69, 71.50, and 90. If that doesn't happen, 49, 50, 51 creates new highs, then bulls will buy more at those levels because they can trail their stop then to below 48. Right now, we don't have a new high, so 48 is not yet a new high or low. Stop for the bulls is still below 41. 49, high one, after several bars of sideways, probably not going to find a lot of bulls buying above it. In the trading range, a high one is usually not a good bull entry. It usually leads to the second leg sideways to down. 47, 48, first leg. 49 is then the correction, and 50 will be the second leg down. It's already now a second leg down, even if it stays like this, right? It doesn't have to go below 48. It doesn't have to be a correction with two legs. It can just be this bar alone that is sideways, and then not sideways to down. I said 49, that will probably be a bull bar, because 3 bear bars in a row would put the market temporarily, at least, always in short. The bulls wanted to prevent that, and that's why 49, they managed their objective. 49 was a bull bar, and the bears that sold 47, sold 48, they're taking their exit right now. The low of 50 tries to hit the close of 48. It missed it by a tick, so bears that sold to 48 are now stuck. Can they get back to 54.50 and actually get out, break even on their first entry, profitable on their second entry, selling the 49 close? Or will we go above 47, and will these bears have a stop and a loss, and that would trigger probably a leg up that is the same size as their loss, and that would get us to 67 and 69. So bulls are trying real hard now to get above 47. The bears are stuck on the 48 close. If they can get above 47, that would be really good for them. But if we hit 54.50 instead, then the trap didn't work. Still always in long then, though. Right? Bulls are stronger here than the bears. You can see that these bears are trying. They're selling and they're selling and they're selling, trying to get to their original entry. They're deciding right now, am I going to just take a break even, or am I going to get a profit on that scalp? If after several attempts it doesn't work, they will just take a break even at the midpoint, and they were almost there again, and they're failing again. They're probably going to get it still. I think this will hit 54.50. And these little traps happen all the time. It's really interesting to observe them, because if you know that the bears are stuck, the bulls are going to buy, and the bears are going to buy as well, but then above 47. So if you know that there's a trap, then buying here makes a lot of sense, because then you're fueling the move, and the bears are fueling the move as well, and can go higher very quickly. And you can see exactly that the bears have reached their target, 54.50. So they are break even there. Still, hope bulls still on the breakout above 38. Let it move up 69. Can the bears also destroy that party and go back to the 42 high in the open of the day? Right now, it's just a pullback with two legs, and bulls need to do something. They need to get some more consecutive bull bars. Now, a bull bar now would be a high two, right? You had first leg of a correction, and then you had first chance to resume the bull trend. Now you have the second leg of a correction, a new bull bar at around the moving average would be a high two around the moving average. And that is what a lot of bulls would be looking for. Bears are, of course, trying to not create a high two. They did the same here in this sell-off. Bears are hoping that this is just a 50% pullback of this whole bear leg, and that this is leg one, and that this is the start of leg two. Leg one equals leg two, and then we're right at that line that I drew here, the high of yesterday's bar 82. Bulls that bought the 43 close, looking to see if they can scale in 5 points lower. If they bought one tick above 43 at 51.50, 46.50, which is the low of the bar right now, would be 5 points lower. And the high of 42 and the close of 42 are the next targets. I said 44 is also an important number for the bears. Bulls will try to see what the close looks like of 51. Is 51 intimidating? Do they need to buy more and get out at the midpoint? Or is it weak? And does it look exhaustive? Can they buy it and scale into their longs? Close the gap to 42 high. And a lot of buying. Probably it's going to go back to the high of 38, then the high of 32. Unless the bears can give it another push. $42 close is then the target, and of course the low of the day is then the target. Back at the open of the day, right? Has been a magnet all this time. And many times that is sort of the day's structure, right? You have an opening range or you have a trend from the open. That revolves either in a trend. If you have an opening range, you often get a breakout in a trend. If you have an opening trend, you often get a lot of sideways. But then after the first 3 hours or so, then if there has been a lot of movement, the market sort of dies out and just starts going sideways in this range. Usually in the final hours, you can get either resumption from the earlier trend of the day, or you can get a reversal around the midpoint. And today, we're probably going to get a lot more sideways. Still thinking that the range of the day is going to expand. It can expand to the downside, to the upside, or both. The problem in the far distance is that I think that yesterday here at the open, there were bears stuck. And although I don't see it happening today, there is a chance that we're going into 54.70 and back to these bears that were stopped out. Usually in the trading range, the market tests bears that were trapped. So there is a slight chance that this whole thing is going to get a measured move to the downside. At the moment, I still think that the bulls are going to buy 51. We're going to go back to the high, but the deeper this sell-off gets, if 52 is going to be another bear bar, then we have, like I said, 3 bear bars, increases the chances that we're going to get a second leg sideways to down. Bulls will buy the 51 close. They bought the 43 close. They'll buy more the 51 close. They'll decide during the bar what to do. Are we going to exit break even at 47, or am I just going to get a full profit scalp on 51 back to my entry on the 43 close? Bears have not done enough to break the stop of these bulls. The stop of these bulls is still below 41. Bulls buying that 51 close. For the bears, the 51 close was a profit target. That's where they bought as well. It's a trading range, So low in the trading range is the buy zone. 51, if you sold 48, or if you sold 47, or if you sold 50, stop above 47, that's probably already almost 2 times your risk. For sure, if you sold 48, 2 times risk was the low of 51, so it's a profit target for the bears. Now, if the bears are buying, the bulls are certainly buying, because they know that the bears are going to buy, they're going to buy too, and 52 reverses up. Now, did these bulls that bought the 43 close, they bought more at the 51 close, are they going to hold for the 43 close? Right now, you can see that they have decided to exit at the midpoint. Some bulls will still hold for the close of 43 and the high of 32, but they want to see what 52 looks like. And I think 52 is going to be bullish, and we're going to have some follow through to the low of 50 and the close of 43. So that is limit order scalping, right? Where in the trend you sell below a bar. In a limit order market, you buy below a bar. You place not a sell stop order, you place a buy limit order. Limit order trading, all from a bar 32 basically. A deep pullback is still bullish, but the bears have been able to make money. Not good for a full-blown bull trend. So probably going to have to take the 20 points above 43 as a target away. The high of 32, we broke above it once. We'll try to break above it twice, and if it fails on the second time, then usually the market tries to go the other way. Here the same, we tried to break below it once, we tried to break below it twice, the market went the other way. Tried to break below the daily range once, we tried to break below the daily range twice, and then the market went the other way. So this is going to be the second time to break above that prior lower high. If the market stalls here on the second attempt, then that might be a reason for the bears to start shorting. Bulls have a chance though to now be successful. 53, 54, 55 could be strong bull bars, and we break out and we hit these targets anyway. But we'll have to see. So limit order scalping, probably a lot of bulls will say, okay, at the 32 high, which is 53.75, I'm just going to take profit. And I'll buy again if the breakout indeed is successful. 80% of breakouts in trading ranges fail, so the chance is not all that high. The overall context makes it a little bit higher because we have targets above on the breakout on the daily chart. But in general, in an environment like this, we could just go sideways in this range for hours and hours and hours. And betting and hoping for breakouts is a bad idea in those cases, because often after a bar or three, your price is back at your entry point, right? And had you taken scalps, 10-point scalps, 5-point scalps, whatever, then you'd usually be in much higher profit than trying to hold for breakouts that never come. Just a few ticks away here from the 43 high and the 43 close. I do think we'll have to go higher to the 32 high. But some bears are, of course, selling. It's a high two, right? 49 was the high one. This is the second leg of a pullback, and 52 is a high two. Basically, leg one of the pullback, a pullback of the pullback, and a leg two in the pullback. Bears see this as the start of a breakout, and they see all of this bullishness as a pullback. But this is more bullish than this was bearish. Chances are that we're still going at least a little bit higher. A bear breakout right now to the low of 6, the low of the day, that would be a surprise. And surprises often go further than you think is possible. Because everyone would be surprised, the bulls have to take a loss. They often become bears. The bears are surprised by the surprise as well, and they have to find a way to get short. And so if you now get a sudden big bear bar that closes and goes below the the daily range, then that would be a surprise, and that would probably have a lot more legs to the downside. Now, as you hopefully know, price action is the same on any instrument, any time frame that has enough volume. So I usually look a little bit at what other indices have done as well. I know that many of you are probably trading not just the E-mini. So let's take a closer look at what has been happening on, for example, the Dow Jones. Sometimes, but not always, it follows the same directions as the E-mini is following, but not always, right? So, for example, here, bar 6 on the Dow, that didn't create a new low of the day. So it would have never caught out these bulls that bought here. You had a different type of rally because you didn't have a lot of consecutive bull bars here either. But you had a nice little type of top and not a big loss if you were trailing higher lows and in that bull trend. Probably more difficult though to sell below 27, 26 as your stop. So above 26, then sell below 27, you got 2 times your risk. And you can see that we're breaking out with a second leg trap, but consecutive bull bars on the Dow as well. So probably still going higher. The Russell, I have it here, sort of the similar pattern, but this sell-off didn't go as far, right? And so if you take the high and the low, and you divide the whole thing into 3 sections, then price didn't even get back to the lower third. It sort of stalled between halfway and the lower third. So that looks to be strong because the pullback from this didn't go as deep. NASDAQ, that looks much more sideways. Look at how sideways this is going. Basically glued to the open of the day. 20,000, of course, big magnet on the NASDAQ. NASDAQ will try to close above that 20,000 today. This is the Treasury, the 10-year. Big bear trend today. And so probably, so interest rates are rising and tries to build a double bottom, major trend reversal, but very bearish with 5 bear bars. Oil crashed earlier this morning, I think, back to below 60, but had a decent recovery. So we sold off from all this, what was it, all the way from 60 all the way to a double bottom here at 56. And then throughout the day session, we rallied, deep pullback. It's probably now a trading range between 59 and 56. Gold, a lot of sideways price action. This is a typical trading range, right? It races to the bottom, it races back up, it races to the bottom, it races to the top, it races to the bottom, and it's never just going to break out. It's just going to stall at the bottom and then reverse back up. So this is a strong buy zone. This is a strong sell zone. Even when it races like this, it's the top of a trading range. Suddenly the bulls stop buying and the bears start selling. And then that is that. What we have here, Europe, the German index, basically sideways all day and a bear breakout. That is a possibility for today on the mini as well. You can see bear breakout twice the size of the opening range. The opening range so far on the mini is small, so it could triple its range to the downside or to the upside, of course. Bulls reversing back up, consecutive bull bars, reason enough for the bulls to buy again, and on its way back to the 32 high, and see what's there. Second attempt, stop still for everything that you buy here. The stop is below 41. Now, if you buy the 52 close or the 51 close, then you're looking at 63.25, 78.75 as your targets. Many bulls will have looked at 50 and 51 and think, yeah, that's too bearish for me. This is not a bull trend, not a small pullback bull trend. When we get back to the 32 high, I'm going to take my scale in profit. And I'm going to also take a profit on my original entry because I thought we were going to go higher. We didn't. And so when we get back to that entry, I'll be happy to take a break even. And so, yeah, there's For the rest of the day, there's multiple possibilities, right? Our range is still small, and that is suspicious. I still don't think that this is going to stay the range for the day. The open of the day so far has been a magnet for a lot of bars. At some point, that magnet is going to give up. Sometimes it gives up in the last hour and we suddenly raise to the upside or to the downside. Sometimes it's earlier. And so at some point, we've tested it so many times now that at some point that magnet is going to lose and we're suddenly going to break away from the magnet. Yesterday, we had a magnet as well, which was 33.75, and that was the low of March. That was a magnet for a lot of bars as well. And then suddenly, like here, it breaks away from that magnet and it never comes back. So far, the open is important, but at some point, we're going to lose that importance and just start rallying or start selling off. The longer it takes to do anything, the more 50-50 it's going to be. Are we going to go and create a new low of the day, close the gap on the daily chart, or are we going to go and reach that breakout measured move target? Bulls are not doing enough to quickly get to that target, but bears could not even make a new low of the day in this whole sell-off, and so they're not as strong as they can be as well. Looks to me, all in all, that the bulls still have a slightly higher chance of getting to a new high of the day than that the bears have of creating a new low of the day. But anything can change in the matter of 2, 3, 4 bear bars. So trade the chart in front of you, but do keep in mind that I think the daily range is a little bit too small to be sustainable. All right, ladies and gentlemen, with that, I'm going to pass over the presentation to all of our friends, Rose. And Rose is going to be here for an hour 15, and then Brad is going to take us into the close of the day. If you have made it so far, thank you for joining the trading room. I hope you had a good session here. Rose is going to come in and take over. Thank you, everyone. Bye-bye.
Good afternoon, everyone. This is Rose. All right. Well, thank you, Tim Stout, Tim Fairweather, and Al Brooks. So far, it's been a great morning. I'm going to try to hold the next hour and a half before Brad Wolf joins us and closes the day. Okay, so yes, I want to talk about yesterday a little bit because I had targets from yesterday, and this is the Globex chart. Okay, so yesterday I found a setup, which is where I thought the bulls were looking for a good swing because we had some trading range, and then we trapped the bears, and here we are reversing some kind of head and shoulders pattern right there. Yeah, sometimes these patterns are so out of how do I say this? They don't really look like patterns that you would recognize, but pattern's a pattern, and your job is to recognize them. And there you have it. So we have several legs down, and finally we're reversing with some gap bars. That right there is a left shoulder and right shoulder, and we started to make bull flags. And we break out. So I measured a crossover. This is where I use the moving averages and look at the crossover on a 15-minute chart. And I told everyone we're definitely going to go to the 2R, and then 3R we should follow through the next day. So here we are. I actually did call some long. This is what we got yesterday, and then after hours, market continued to go up. And you can see here's the first flag and the second flag. I generally look for about 3 flags, and then the final flag, maybe we could get a 4th flag, but it would fail, and then we would get the reversal. I would look for, in terms of new patterns in maybe head and shoulders that we might be actually forming, or a double top, wedge top, or wedge top, and then double top, lower high. So we do have a spike, pullback, and channel up, if you call this a pullback, and then we have a channel up, or some might say, no, this is the pullback, so we're going to keep channeling up. Maybe so, but I do count wedge top 1, 2, 3 here. And what if we go up and make that double top and then start to come down. We need to trap the bulls. I don't think we have trapped them just yet. Although this looks like a trap because it's the third push up, but this also is a confusion and it's going sideways and up. So bulls are still trying to get back up here. So I think that we're going to try to go up, and somewhere in this gap area, and remember this is 15-minute chart, so I'm going to talk about this on the 5-minute as well. So you have a big up and a big down and a sideways, and it's kind of making higher and low, so we're kind of trying to go upwards. It is possible that we could actually reach this high, 63.50, or this low, 67.75, somewhere in there. Bears would defend this area, and then we would start to come down. Or here's a crazy idea. We keep going. So we go up here, we close the gap, and we try to sell here twice, and we fail, and we continue to go up to my 4-hour target. Now, I don't know if we're gonna be, reaching there, but at this point, we're still bullish, even though market is confused a tad little bit. So I am bullish because this is a trading range, and because this is a pretty strong buy zone, because this is a leg 1 and a pause and a leg 2. So from that low is to this low right here. This is my buy zone, aka demand zone. I'm looking for 2 entries. First entry long. Don't like that, but it is what it is. You could go for it. Generally, I look for some pin bars. They don't need to be bullish or bearish. Better if they're bullish. If they're bearish, you get this bull bar long. I hesitate buying above it, knowing that we're going to have to get back to the bad signal bar, and then I would be looking for another buy signal bar. So to me, this would not be the first entry long because it didn't do anything. So this would be the first entry long, and this actually would be the second entry long. So this would be the 1, this would be the 2, and you could buy above it. Take a little bit of profit there, okay, because it's a bear bar. It may want to come down, but eventually what the market is trying to do is to cross above that is Globex high once again. Now, what if we go there and not able to continue because this turns out to be a bear flag? That's fine. I have a contingency plan for that as well. So say this is your leg, this is your first push, although I will not count it because we did not go above it, so that may not be the first push. So let's do that again. So this is your leg, this is your first push, this is your pullback. So we're in the second leg trying to take out that high. That's fine. So let it rip, go up. Then expect a pullback, could be right from the Globex high, okay? And then we do another push, and that push is could go up there where I said the low of that bull bar and try to close this gap. Now, if the bears allow us to close this gap, what happens is we go up, we come down, and we use the Globex high as support, and then we just rip through it. So I've got a target, swing target there, and then I've got a new target there. So it looks like bulls are still trying. So I have to respect them, okay? And we're also above the key level, which is mid Globex or mid Asia, and then midnight open. So that makes us bullish, okay? And on the 5-minute chart, but I want to talk about the higher time frames very quickly because I want to miss this trade. This is the monthly chart, okay? So I had this trend line, and this was the third push touching, and then we just bounced from there. That right there is your swing. Now we came back down, try to break it, but then we'll start to show up. But I don't like this. This is not all that great of a good signal bar. Yes, it's a weak bear bar, but chances are we look like we're bullish, but we could actually come all the way down to the midpoint of the spin bar and look for buyers. If we do not get any buyers and the bears finally break this trend line, they could close. Remember, this is a monthly bar, so it's going to take a while to form a strong bear body that could create a momentum, and that would be leg 1 pullback, leg 2 coming down. So the pullback and the leg 2 could be the start of same bar, start of we're getting the start of that bar, but we could get the follow through, and then suddenly this month, May, could turn into a bloodbath, and it could become a huge bear bar, taking out most of this lower wick. That becomes the actual break of this trend line, and then we could sell into this area. This is where I would look for buyers again. Now, good news is we don't have a strong bear body, so the bulls are trying to invalidate, but I don't think this is a good buy. I think we're going to have to still come down at least to 33 to 50% of this lower wick. So I don't really trust the bulls this month all that much, even though they're trying to get back up first here and then up here. So I don't really trust them. Okay, that's what I'm trying to say. On the weekly I've been marking these levels, and yesterday I said we're gonna definitely get above this level, which is 56.04, and we bought into that, and then we kept going. And this week is now trying to reach this trend line, okay, which is my projected target for bulls. We could get above it, or we're gonna go up, test this target 56 to 87. That's either 50 or 70, 75. No, I think it's 25. So just mark it as an 87.25. That's how I marked it on my 5-minute chart. It could come down from there, so watch out. And then we would try to break above it. We would go and retest it and break above it one more time, because the actual target is actually 57.72 or further up to 58.38. Now remember, this is a weekly bar, so week is coming to an end tomorrow. So we could go and test this target and then start to pull back to the high of this breakout bar of this range. And then I would look for buyers. If we dip below and back inside this range to next week, I would be looking for buyers once again, maybe underneath this week, which would be, this week. So next week, I would look for, if the bears get serious, I would look for buyers somewhere around here. And that kind of concludes the idea of why this month seems bullish, end up coming down to the midpoint of last month, okay? Just throwing it out there so that you guys can keep an eye on that. But right now we're trying to get up to this level. On the daily, yesterday I again said this right here is target, but we're going to probably get above it, which we closed the bar yesterday above it, and that ended up becoming a inside outside and outside up bar, engulfing bar that is engulfing 1, 2, 3 bars and part of this bar. So say 3.5 bars, right? So that means we're very bullish, and they're going to probably buy to close. That happened after hours last night, 6 p.m. So the buying began early on. So they're in a rush. They're trying to get to somewhere. And that somewhere could be right around here. Now, why is that? Why would that be? Because bulls were buying pretty strong here. 3 bull bars, they expected sideways and up price action, and then this happened, and then this happened. So I don't remember what this was, because I kind of try to forget about those days that with big volatility attacks. It's like blur, you know, in the back of my mind. No, it's not. It was pretty scary trying to trade those days. You know, it's tariff wars and whatnot. Is pretty much every hour we had a volatility attack. And so that kind of had upset the bulls, and they're trying to get back to where they got stuck most likely. Okay, and that's why we're trying to push so hard to get back up there. But I'm sure it's a tight trading range. Okay, so here's a trading range. It's part of the bear flag channel with is up on this, is down on this, up on this, down on this, up on this. Then we get the lower high. Okay, and that's a sell. So if everybody who bought this lower high for some reason didn't think it was a lower high, that it was actually reversing, is trapped. So that's where we're trying to get there. Okay, we could continue to push. We could have been pushed so hard all the way up here to this trend line, which is what I want. But eventually, either from there or here, we're going to start to come down. So we do have a one big push and then down, second leg up. We need to come down, and then we might get the third leg, and then finally we start to reverse all the way down here, and that concludes the idea I had that we might actually come down and test last month's midpoint, or lower wick midpoint, I'll call it what it is, take the entire bar and find its midpoint, and we might actually test it. So if that's the case, again, I don't really trust these bulls, but we still have enough space to go up. Now, as far as yesterday and today, I took all of those targets, and I've been buying this since yesterday, which is great, but I don't hold positions overnight, so I exited. And then this morning I looked at this as, okay, bar one is nice, but where are the sellers? Those sellers got stuck underneath bar one, and then they immediately sold at the upper third of bar one and trying to get a break even with bar two. Possibly they got their break even, but once the bar two closes bullish, every bear is like, nope, we got to get out of this because this might actually go up and test the bar one high. Bar one and two and three overlapping, you get a small trading range here, and most likely upper third or above bar one, you got sellers waiting. We got three inside bars. So what I call this is a inside up failure. So you get a trading range bar and then a follow through trading range bar. So you have a confirmation of a trading range, and we're getting a leg in a trading range only every breakout. Say bar 4 and 5 kind of looks like a bull flag on a 5-minute chart. It's a lot more dominant, or prominent, I should say. Okay, on a maybe 2-minute chart, you would actually see well, let me go to the 1-minute chart. That is not actually all that great. Let's see if it actually looks like what I think it is some kind of a bull flag. Where's that bull flag? You got this. Think of this as a one big bull bar, so it makes the pole of the bull flag, and you got a channel up with 3 pushes. Yeah, this is a kind of bull flag. But what happens to the flags? They might look like getting a breakout, but if you don't get follow through bull bars, most likely it's going to reverse back down. Why? Because any trading range breakouts fail, right? So you're going to have to wait 3 legs before you look for a breakout or down, and 3 legs for bulls. Here is the 3rd leg for bulls. Here is your entire range divided into 2. Look, that's the 50%. Now bulls start to show up. So all that you see here on a 1-minute chart it's a lot more compact on the 5-minute chart. But I see that as okay, it's trying to become a bull flag, and the bull flags fail at the top of a trading range, and the bear flags fail at the bottom of a trading range. So I'm looking at this and it happens to be right before the 10 o'clock. So generally 10 o'clock, I look for double bottoms and double tops. And if you want to learn about this, there's a free, I believe, webinar on the Brooks Trading Course YouTube page, Trading the Open. Al did, I believe it was the Money Show in Orlando a couple of years ago. I'm not sure. One of those shows, Al did a presentation about how to trade the open. You can go and check that out. If you are a trading course, Brooks Trading Course member, then obviously you want to go to the course and get the more detailed information from there. So, so basically, my entire trading method at the open is I don't get scared of the trading ranges. If I see a trading range, I generally look for about 5 or 6 reversals and a swing to set up, or I look for I call it double failure. So I look for double tops and double bottoms, and I don't buy and sell them. I just look to see how they're going to handle the swing. If there's no swing started, then it's going to be reverse and reversal, and then the swing to the other side. So there you go. Right before the 10 o'clock, you got your double top with bar 1 and 5, and then you got your double bottom with bar 2 and 6. So you got a reversal, right? Market sold at the open is reversal 1, reversal 2, reversal 3, reversal 4. Actually, you can call this a reversal because we opened up here and then reversed down. 1, 2, 3, 4, 5. Failure of a failure. Why is it a failure? Failure to break out, failure to break down, failure to break out, and a failure to break down. Double top, double bottom, double top, double bottom. That right there is a failure. A failure is swing. And now I'm doing the same thing I did on the 1-minute chart. Is I have a trading range with a 50%. I'm looking for either a bear bar closing below the 50%, bringing it down here with the one final pullback, everybody sells. I don't have it. Bulls started to close above 50%. That right there, bar 9, is telling me this could be a high 2 and setting up for low 2 failed, and it's turning into a high 2. So just wait for 2 consecutive bull bars closing above the 50%. I actually put a free YouTube video on my YouTube channel. You can learn about this with all sorts of examples, and I would just go along. So you can take the entire trading range, okay, and project it up, and that is your measured move target, and is buy every good looking bull bar. So that was an easy trade. You just had to be a little bit patient to set that up. A lot of people lose their accounts or start the day with a huge loss, okay? And that's because they're not patient enough. They just don't, they want to trade every bar, which is fine. This is what Al Brooks created the course. He wants you to be able to take frequent trades and be able to make your money quickly, right? Because in essence, you can trade any bar, but if you're not advanced or if you haven't practiced enough, you're just going to lose. So a lot of people start the day with a loss because they do not sit and wait and understand what is going on in front of them. So if you watch how to trade the open, you're going to learn a lot. And once you master it, I think it's very easy to make your money the first couple of hours and exit out of the market and have a great day. So we got a really nice, right there is 3 bars up, but it failed because why? Bears needed a second leg down. Market moves in 2s, right? It needs to try something twice before either succeeding or is failing. When they fail, look, first time they tried to sell and the second time they tried to sell and they couldn't. So now it's bulls' turn because bulls try to buy once, so they need to try to buy. They see the bears are failing, it's time for bulls to get in. And they start to buy above bar 9. Fantastic, it's a bull flag and everybody's buying. Strong bar 11, that's about telling you all the bears are exiting, so we should get followed through a couple of legs up. If you buy above 11, you can buy the first pullback, 1, 2, 3, 4 bars, tight bull channel. First first reversal is going to be minor, and there will be buyers waiting. You can see the buyers are buying the close of bar 13. Bar 14 is a fantastic bar. I'm buying again, and I'm not afraid of the bar 15 pulling back. Just like bar 13, I'm sure there will be buyers. If not, I will buy at the lower third of bar 14, and I will look for a quick fix. Didn't have to do that. Bulls are buying. They proved me right. And continuation bar 17, you can buy above that. And then, but in the meantime, count the legs or how many times, right? Here's your pull, flag pull. Here's your pullback. Here's your up and down, up, down. Okay, we should get one more. And then we got one more. Okay, so that's it. So now you get a really good inside bar 23. And you see a bar like that, outside bar followed by 23. If the bears are taking out the outside bull bars low, and you already counted 3 legs up, you need to let it sell at least to the 19 low and possible down to the 15 low. If it starts to close below the moving average, 13 low is my target. They didn't stop there. They kept selling. Why? Why did they sell so much? What's the deal? What's the deal, O'Neill? So that's because we have a tight trading range with 10 bars before the breakout. Tight trading ranges are balance zones. Balance zones, exactly what it says, balance, right? Name. It's a place where the buyers and sellers have same amount of money, same amount of contracts that they're buying and selling, so they're balancing their order sheets, that it goes up, down, and never breaks out. It's a limit order market. Therefore, it is a tight trading range. Therefore, it is a magnet. So I call that actually a house. It's a house with windows and doors that everybody likes to go their home and stay there because that is the safe place. That's where the fair price is. This right here is a good price action. Okay, pay attention to what I'm saying. This right here is a bad price action. Now you're going to say, how is this a bad price action? This is a, you know, some kind of a buy to pullback, or it's a trend. Well, this right here is imbalance. Imbalance created a trend. You can say, okay, fine. It's a good price action because you can see it clearly. But this is a good price action because this is where market is balanced. Therefore, expect a pullback there. So if the market is selling, okay, sell with it. But remember, this is kind of an imbalance, right? Market is doing something so fast, okay, quickly, that it's selling, the close is selling underneath the bars. It's in an urgency, trying to get to somewhere. Where's it trying to go? It's trying to go home, right? It's 5 o'clock, everybody's out to work, everybody goes home. That balance zone is always that home, okay? That's the magnet, pulls the price in. Then it does the same thing, right? It goes sideways. What does Al say in the course? Trends lead into trading range. It needs to balance out, again, what it was imbalanced before. Okay, so hopefully you guys understand this, because if you apply this principle to any market that you're trading, you're going to actually find your direction. Anyway, I love trading ranges more than the trends, believe it or not, because I can get ready because I'm getting a fair price, and I can easily fix, even if I take a bad trade, I can easily fix it. But anyway, so here's your trading range again. And what do I look for trading ranges? I had, we all had actually, we had, I think it was the last year, maybe a year ago. I don't remember. Maybe it was 2022 or 2023. It was the encyclopedia, how to use the encyclopedia slides, or the database. Is entire team actually made presentations, and we all presented that day. I presented on trading days and trading ranges, and these are free. You can go to brookstradingcourse.com and search for encyclopedia keyword in the blog or the search section, and then you're going to find the presentation. Watch it. It's pretty much the entire encyclopedia and the trading course material put together to teach you how to trade the trading ranges. It's very simple. I look for 3 bull legs and 3 bear legs. It could be short like this, and I look to see who's gaining confidence or power within right around the 50% of the trading range. If it's bulls, I look for a breakout and a pullback. Either here, it could pull back all the way here, and then I go for that swing. And then the same thing, if it bears, okay, we have the 1, 2, and 3 bear legs. And if they move under, I look for a pullback and a breakout, but I don't sell it right away. If I do sell, I expect for a pullback again, and then I sell again. So it is actually very simple. Look, leg 1, leg 2, leg 3, okay? Leg 1, leg 2, leg 3, and the bulls get a breakout. Even though breakout lasts for a while, but eventually it reverses back to the midpoint. So this is where you load up again, bunch of contracts, look for really good looking bull bars and buy above them. You will make money, okay? So we really literally moved into some kind of a trading range here. Big up, big down, confusion. But the one thing that market failed to do was to take out that low, okay? So this was basically bears selling here and getting trapped, selling higher. It could be 20 points, 40 points, right? So if you measure from here, possibly, let's see how much they did. So that's about a 20 points they tried to sell. That failed. So they're probably going to wait another 10 points or so. If you measure somewhere from here, that's more than 40 points. I don't measure like that. You can also measure from the close of the bull bar, okay, is because they try to sell above that bull bar to get a break even with bar 8 and 9. You can clearly see it. A bear bar, everybody's selling and then they have to sell above, and then they got the break even, but that's it. No bear bars. Either these bears are going to exit and turn into a bull, okay, buyers, or they're going to wait about 20 to 40. Look, they start to sell around the 20-point area, but no consecutive bars. So they're going to now wait another 10 to 20 points, somewhere around 39, 40 points, and they're going to start to sell. The goal is to get it back to bar is bar 6, okay? It can get closer to the bar 6. If we gotten closer to that bar 6, maybe somewhere here, but we never touch it, that means we have a gap, and then you would buy again. You would look for that high to be tested and then pull back and go again. We had a day like this, and the moving average will go. You could buy at the moving average, underneath the moving average, and you would look for new highs. But we closed that gap, and we actually came down to the bar 6. So every bear who held and sold 20 and 40 points higher, these are strong bears, were able to get a break even. But the one thing the market failed to do, we never moved underneath, we never closed bear bars underneath bar 6. How bearish is this day? It's not at all. It's just a attempt to break even for bears. Now they're exiting out in orderly fashion. We're getting 3 pushes up. But bears still see, some bears still holding, see now the first push and the second push and the third push. They see, or from here, I count, either count from there, I count from here. We got a wedge top, okay? So what do we need? We need a maybe a double top, lower high. If we get a double top with a neckline, we start to break that neckline, I would expect price to come down to here, maybe down to here. That's what I'm looking for. What if we keep pushing? Well, we'll see how that goes. We could, I mean, we're still bullish. Really nice buy signal bar from bar 60 from the moving average. Market is still trying to get up to these levels. There's a target here we left behind, which is this right here. Okay, that's right. This is a weekly. That is right here, 87.25. Yeah, so that's where the market is trying to go. So I would understand, because bulls see a double bottom bull flag. So they've been buying, okay? They know the bears are exiting, so they've been buying anything that closes decent, or anytime they see 2 bull bars closing above the moving average, that's always in long, let's buy. The only problem here is that this strong, tight bear channel, right? The problem here is that look what's happening. Bulls started to buy, but anytime you buy, you always should expect a retest of that channel. Okay, I don't care how strong the bulls are, we're gonna come down and test it. As long as we don't take out that low, then that's it. That's a bear flag failure. Then you start to see bull bars, game over bears, keep buying. Even if it comes down, you got a gap here for 1, down here is a buy zone, keep buying. Okay, buy above the good looking bull bars that close above moving average. So that would be 55. And look for that high to be taken out, and then look for prior highs. If there's a gap here, maybe that bar 26 is the target. And I'm going to mark it right now. Now that I did all these analysis, I can see exactly where they're trying to go. So the first area where the sellers are, okay, it's actually a supply zone, but I'm going to name it a resistance because there's no supply or demand zone teaching in the course. We call them strong buy and sell zones. Here's how I define them. Here's a tip for you. Okay, if there are more than consecutive 3 bars, bear bars, the first doji or a bull bar before those 3 bars marks this strong sell zone. You look for a first sell, you do not sell it. Then you look for a pullback and a second sell signal bar that you can sell. Generally, it can create, and it will, and it should, some kind of a swing trade back to these lows, okay? So that's what I'm going to be looking for. Right now, we're going up to that bar 26. Now, I don't know if that's a bull bar. Yep, it is a bull bar. Okay, perfect. So that's the bar that you're looking for to be tested. But before that bar, we got another 3 consecutive bear move down. So now we may actually go in here, try to sell once, and then start to close above this level. Now you know why we close above that level and go higher, because there's another zone right up there is telling me that market can continue to buy after a brief rejection from here, but you should also expect market going there, and that is I would look for a big swing short down. That's what I'm looking for. What happens to this target? Well, here's what could happen. Sometimes these zones we go like say we go up there and then we're sell, right? And then we go up again and suddenly it's so strong bull move, everybody thinks that we're taking out the high. That can happen. We can take out the high, okay? Because bears could have a wide stop. They want to sell again. What happens is that if there is some kind of a magnet, such as this right here, we tag it and then we come down, close back inside a bear bar, everyone's going to sell underneath. So that means this zone hasn't been violated and it could still start a swing short. So those are the things you're going to look for, okay? But once the bull bars start to close bodies above it, then they're going to start to use it as support, and we could just keep going higher. Then I would look left to see what's there. I don't see anything at the moment. I would look at the higher time frame, see I could see where they're trying to go. Then I know that this is now becomes support. But none of that has happened. I'm just giving you guys what could happen scenario. Right now, I think the market is trying to get to, we already tested 25 low, which is fine, but bears need a second leg here to come down. They're trying to get the after 3 push, a double top, early sell, but I'm sure this area is a much better sell. So market makers are trying to make this as bearish as possible and trying to give you a second entry short a lot earlier so that you end up taking that short and then they trap you and then we go right back up. So I think you need to be patient there because I think bulls are going to try to push it into one of those levels I marked on the chart. I wouldn't sell anything just now. Okay, so anybody bought above bar 60 is a good looking bull bar. These bulls they're in a tiny tight trading range here. They're not stupid. They know that is anybody who sold underneath 56 or the close of 56 into the moving average, probably going to sell again somewhere at the top or the open of bar 59, which is exactly what they're doing right now. Because bulls know that the bears need to sell or try to sell for the second time before giving up. So what they do, they buy above it, and then at the high, they take a little bit of profit. They could be holding a runner, but they know that the bears need a second leg. When do they exit? If the bulls are holding a runner after the scalp with 61, okay, they're going to, if they start to see bear bars taking out the open of this strong bar that they bought, they're going to quickly try to buy at the lower third of this bar that they bought earlier, and then they're going to look for a pullback and they're going to break even, and that would create a double top lower high. Then the bears can come in. Again, these are scenarios what the bears can do and what the bulls look for. How do we exit instead of holding? I don't know that yet. We have not pulled underneath 61, so technically bears haven't really gotten their second leg down. So I still have to wait. Over the years, I have tried so many trading techniques, so many courses, so many trade rooms. I even worked for one. The only way, if you're going to get successful, if you really want to get successful, and you will get successful, okay, is the practice is one thing, but what are you practicing? That's the question. You could be practicing so many different methods, but if you're not truly understanding what these bars are doing, what do they really mean, your practice is going to be, hindsight is going to be great in a replay or whatever you're practicing. When it comes to real trading, you're probably going to be unsuccessful. So you're not going to be doing all that great. So what I would recommend you is to take the course, and once you finish the course, take again, okay? And then go read the books. There are 3 books. In fact, is what I did, and I still do. I go watch the videos, and then I go to the books and find the corresponding chapters, and I read those chapters. There's so much details in those chapters that Al wrote, and it kind of marries the whole dish, okay, before you cook it. So everything tastes better, you know what I mean? So it's just everything marinates better, and you get to see things clearly, and then you just put it to test. Go practice it. But the course is your foundation. Build that foundation by taking the course a couple of times, in fact, and then go take a look at the things that you learn on the charts, whether they're replay charts or live charts, 1, 2, 3, wedge top. Okay, could this be a bear flag? It could be, but how do we sell it, right? Here's a first leg, second leg. Generally, bear flags happen when you have a strong bull bar. Suddenly, bears are trapping the bulls with strong bull bars that no one expected. Take a look at here. Bar 49, pretty strong. Suddenly, they got trapped. When I see a trap like this, notice how bar 50 went above bar 49, okay? So that right there is a trap, and the bears are closing like that. You can actually sell the close of 50 and then sell one tick under. Even if it's close to the moving average, you can take a trade right there. So selling the close gives you obviously better entries, slightly higher than the moving average. And then what you do is you can either measure from there, put your stop there, that's what you could do, or you could just take the entire trading range, that's the breakout, go for the measured move is right there. So that is your flag setup. But because you're selling into a strong bull leg, right, bull's looking for a double bottom with bar 48, totally failed there. When they fail, they get upset. When you're upset, you want a revenge, right? So somebody does you wrong, what are you gonna do? Somebody does you wrong, what are you gonna do? Oh, revenge, baby. I'm taking revenge. I'm taking all sorts of revenge. And that's exactly what they do. Wait for these guys to take their profit, buy. And that bar is a revenge right there. We're buying low, we're blocking you. You're not gonna succeed, you're not gonna get your 2R. This is buyers right here. We're here to revenge us. Why? Where's the revenge? How does that happen? They generally print a nice looking bull bar and they start to buy it because the entire goal is to get back to where they got stuck. And that is bar 49 high. And that's exactly, and this is a major revenge right there. So they're taking control of the market now. And look at what's going on with the bears. Well, they haven't technically gotten their second leg. So we still need to wait for those guys. So I wouldn't, if you're long, you're long. You obviously don't care, right? You know, now these guys are trying to revenge, right? So they're trying to get the second leg because they're stuck underneath 59, okay? So what they do is if you sold underneath 59, okay, when are you gonna sell? Well, you could sell right at the top there. Look, they got an average break even right there. So if I were a bear and I sold somewhere underneath 59, somewhere the close of 59, whatever, generally then I sell the close again, right, on the open, and I get a chance. But this one actually didn't actually tag it just yet. It came so close, but that's a one tick failure. If you sold, maybe this one, look, it actually went up, first came down, bar 61, then went up, got all these sell orders, then closed here. Well, everybody's upset. We need to come down and test it, but this one did. So this bear has actually got their average break even. So this bar may or may not close below that 50%, which is right here. If the bears cannot close and suddenly bulls start to close, best believe we're going up here. Okay, bulls are going to exploit it because they know majority of these bears sold underneath 59 might be already exiting. And that would be the proof if this bar closes, that means this is a target and that's the target for bulls. They're going to exploit that. Okay, this is why you do not want to sell anything. However, sometime at the end of the 1 minute and 20 seconds, if this bar collapses and closes below the 50%, then what you will have here is that the bears trying to take over. That means they're really committed to bring the price back down to the 59 close or low. I don't know what this bar is going to do. Right now it's taking out that bar. Higher probability we're going to reach there. But if it collapses and this becomes a wick, and then suddenly we close down here, or the next bar we close here, bears will try to come back down here. So I'm watching this bar. Bulls are still pushing this. Remember, I said the market makers will make it look like bearish. That's that bar 59. And I said I wouldn't sell it because it probably wants to go up. And that's what the market is trying to do. But I have always my eye on anyone who's stuck here, and that's bears with bar 59. Had they gotten a decent bear bar to actually break even? Well, they scrambled here, but these are the machines, okay? These are the machines who do the buying and selling so quickly and able to exit the first or the second bar or the third bar. What do the retail traders do? Well, they need a bear body. They need a strong bear close or weak bear close, something that closes on its mid to low point, okay, or lower third to sell. Because there is no bar of that, and many bears know that machines already got a break even, they could be exiting out involuntarily or voluntarily. That means we're going to get up here super fast. And that could be the target right there, and further up to here, then I would look for some sell signals here. That means any retail trader stuck underneath 59 couldn't find a bear body to sell. Then they're going to measure from above this bar, okay, about a 10 point, okay, or right here from this bar, I would measure from the bull bar about a 10 point. Oh, look at that, 10 point happens to be the exploitation bull target. And then we wait for those bears market to get there, and we wait for those bears to start selling, okay? They can then bring market back to the bar 59 and minimize their losses. But you see how those bears step aside, and they realize that they weren't quick enough to get the break even with 62. So now they're waiting to see if the bulls can be satisfied, taking a scalp here and another one up here, and then they can sell into that profit taken, and then they will try to bring it back to at least to bar 59. So early bears already started to sell with a limit order right at the 50%, trying to do that right now, okay? But I mean, good luck with that. I wouldn't do that because ATR is, well, here's the thing. ATR is, maybe they are right. The ATR is 5, it was 575, almost 6, but they can also sell around the 575, what happens to be the 50% move up, okay? So I can understand why they decided to sell. They're saying ATR is not even 10 points, so we may not get there, but since it's 5 point, this is a good place for us to take the plunge. Okay, then let's measure it. You're a bear, okay, and you sold right there. Where's your break even now? Right there. And those bears, 59, stuck underneath 59, getting their average break even. You see how I calculate it? By using the ATR value. Now I'm going to look at the Discord and see if everybody is completely lost and heads are spinning. Everyone's lost. Like, what is she talking about? Can you guys hear me? Lost audio? It should work. Fine. Okay, audio is good. So you guys are clear on this? Did you see how I anticipated where to measure how these bears would enter with limit orders as early as it was, okay? So from here, that was the first sell, right? The bar that I sold, because it's a trading range, maybe I can sell again. Those were the machines, but the retail traders couldn't do it. Now, the retail traders need confirmation, something to read upon, right? And that is ATR value. It's telling you market, at that time, it was a 5 point and 3/4. So it's telling you market go 5 3/4, and that happens to be the half hour exploitation. And that is where the first limit orders would be placed to sell quickly. So then I measure from there. And those bears actually minimize their losses, and they did fantastic. So if you can study this on your own, and I'm going to make more videos, and I'll put it out on the Discord, join the Brooks trading course or my Discord. It doesn't matter. We're all just posting both. You really understand these stuck traders, why they're stuck, what would they do to break even? Where would they break even? How do I measure it? What do the machines actually see and how they measure? You figure that out, you pretty much are good, right? You're on your way to a better trader. You become a good trader, but you're going to be on your way to a much better trader, okay? It's actually not an easy task, but once you start to see it, you're going to be filtering out the trades. You're going to know exactly where market is going and why it's going there. Now, I would recommend you, what I just did there is actually explained in the course. And everybody who comes to the trade room, they already know what I'm going to say. So it's pretty much a boredom for them. But let me show you. If you go to the Brooks Trading course, and if you go to the online course, if you don't have it, you can purchase it right here, $399. That's the default course. And then if you really want to learn about the Forex and trade it the same way, then you just spend another $100, that's like $499, and get the Forex course, which is a bundle, okay, of the regular and the Forex. So go to login, go to the course, and if you want to learn how to scale in to fix a trade, it starts with the right here is market cycle, and scroll down to 15G. Okay, watch this. Now everything isn't ticks here, but since these course material was created, volatility increased in the market. When the volatility increases in the market, is now you're getting suddenly, instead of something that is measured with 5 points, now you're getting 10 points, 15, 20 points. So you have to be open to that. Okay, but that basically explains 15G. And then get out of this one and then go to the next one, which is this right here, how to trade a prerequisite. Now scroll down to 30. First, watch the protective stops, but it starts with 35. So 35A, B, C, okay, those 3 videos are super important. First, watch the 15G, and then watch these 3, and you're going to be fantastic. Okay? If you don't have the course, well, I can't help you. Okay? And then if you do have the course, after 60 days, go get the encyclopedia. And then same is slides with a lot more details and examples, also put together in a nice bundle in the Brooks Encyclopedia Slides database. You can also go check out those and see how L enters and exits trades. But those, if you are new to the course, you're going to have to wait 60 days to get access. Okay, that access request is also on the brookstradingcourse.com website. But you're going to have to wait 60 days, okay? Anyway, all right, so you can see how bears sold, they're getting a break even. If they can close below that break even or average break even 50% level with a bear body, then they're going to gun it. They're going to try to come down to the 59 close or the 59 low. So that means is, you know, this is another attempt maybe by market makers to sell this. But the problem here, we already tested, but this is the very first test. Will you sell this? No. This is right now still a break-even event. Is this a good sell signal bar? 64? No. So what does that tell you? It tells you possibly it's going to go up here and retest right here. So we could get wedged up. Maybe this kind of resets everything. And 1, 2, 3 wedged up. We might need a double top there with a better sell signal bar. So would you sell here? If you sell here from underneath this bar 64, 5 to 10 points, buyers are waiting. So by the time you sell it, everybody will be start to buy. And that could be a problem. Right now, the price is trying to get to the 59 low, possibly some parts of 60, lower third of 60 possibly. But if you do sell here, chances are there could be buyers right there. So I think we're going to go right back up again. Can markets start the swing because this is a wedge top and we kind of made 1, 2, 3, maybe the 4th push if you count from here. Either or, we still need a double top to get the second entry short. Okay, I don't want to start swinging this. If I sell right now, chances are they're going to trap me and I will be hurting. Now, when do I know the selling will be super fast? If they want to sell right now, right here, they want to start the swing, without that double top. That's fine. Now, what do I expect? I expect bars to move underneath the moving average, give me some always in short setup. That would be 2 bars and maybe gapping down, bare bodies. Then I would look for the first pull back to the moving average, and then that's where I would sell. Okay. It's all about doing the math. Okay. Math is everything. No matter what you do, okay, math is great. Like, I'll give you an example. And ladies in the webinar, okay, or webcast would know what I mean. I'm not a cake baker. I'm not a baker of any sort. I didn't have that gene, unfortunately. But lately I've been trying. And I baked my very first cake that turned into a bread because I did not measure anything. I just haphazardly throw stuff in there and hope for the best. So that came out to be a disaster. I still made people eat it, but they were not happy. So my second time I used, okay, is I measured everything and I did it the right way it's supposed to be. And it absolutely turned out to be an amazing cake. So trading is the same. No matter what you do, it's the math, okay? It's the numbers. Somebody already did the work, so they're telling you this is the right way to do it. So go take the course. Everything you need is in the course, and you learn how to measure. You learn what the machines are doing and how you can follow their footsteps and do the same thing and measure the same way, and you get a higher probability right before you take that trade. You would know which way it's going to go or where it's going to fail. My ATI setting is 4 bars. I look back, and that's I've heard this from Al long ago. He looks back 4 bars, so it's like 20 minutes, you know, of 5-minute bars. Yeah, so it's 4. You could do 6, but I wouldn't. 4 is fine. You close to me. You could come to me, Bernadette. We can make teas or other things. The people are amazing on Discord. I love the memes that they post. It's funny. Anyway, we have fun. We have fun when we're trading. All right, so what's going on here? If you had a sell order here, maybe right here at the bottom of the zone, you'd be actually filled with a limit order and you'd be selling and making money, right? So this is technically the second leg for bears. It is also the second entry short, but not a good bar, okay? So if you actually measure from the bar 64 low, chances are market is trying to get a 5 points from there. So that's only 225-ish, so that's fine. That's the minimum. That's half the ATR anyway. Half the ATR, it's almost 575, so it's not 225, that's about 250. And if you measure it, is it though? 270, yeah, I would say 250 is, right? So 250, maybe 275, that's what you get. And that's it, look, I did the math and the math checked out. But if we keep going, that means we could get the full ATR, but that would be 5 points, 5 and an extra quarter. So we might actually come down and test it. It's only if we close another, or we just go 1 tick underneath bar 65. What if we make a double bottom, mark a double bottom here and start to go up? Remember, I said I don't want to sell anything here. Even if they do come down, there could be buyers right here, okay? I'd rather to sell, retest of this area with a strong second sell signal bar. So right now, market came down half the ATR, and 225 was exactly 65 low, and actually 275, sorry. That's what the math said that I should count. And now we have a micro double bottom. Now, bears haven't really taken out the 65 low. The moment they take out the 65 low they're going to bring it down to the 525. There's enough there. So that's 6 point. There's 5 point in there. So approximately minimum, it could actually come down to the 525. Okay. So I'm not ready to buy anything, but if I'm looking to buy, I would be trailing my buy stop order above bar. So my buy stop order would be resting above bar 65. Now the bar 66 close, I would have dumped it right on top of bar 66 and I would wait to enter into a trade, swept into a trade with a good looking bull bar. But 66 did take out the 65 low, so it's telling me it's probably going to come down and tag the 5 to 5.25 is area, and that would give also the bears who are stuck at the close and underneath 59 a full break even. And there you go, we're right there. And that is the 21 tick. You'll see it in the course 15G. Go watch it and you'll know. Now, can the bulls show up here? Is maybe, I don't know yet. If the bar closes way below the 59 low, okay, right now it's testing the 59 low, exactly 59, not, okay, yep. So now these bears are actually is breaking even. But what if the bar suddenly closes above the moving average, or suddenly bulls start to buy the close of this bar? Then we would go back up here, okay? But what about the bears? Can they continue to sell? Yeah, they could be holding for a 10 point. They don't need to exit out. They're looking for a confirmation to keep it, to keep the trade open. And that comes with bear bar closing below the 55, 59 low. If the bears get that confirmation, they will sell, okay? They will continue to sell, I should say. They're going to take some profit here because they're fixing their trade, and they could be holding a runner. But the problem here is that the bulls will be scale in at the lower third or the midpoint of this strong bull bar's wick, okay? And that is explained how to scalp or how to enter with limit orders in the Brooks trading course. And I'm going to show you right now is another great series of basically Al goes through every single example of, you go all the way down to is swing and scalp trading, and then is you go right here, okay, scalping. Don't worry about the swinging. If you want to learn the scalping and why there will be buyers at the midpoint of the lower third of this bar 60 lower wick, all your answers are right here. Especially these examples, scalping examples, they are fantastic. And you're going to learn tons. So if I'm able to call why there could be buyers there and why bears can actually exit out of the market, that's because this bar fails to close a bear body somewhere at the 59 low. Then you know bulls will come in super fast. This happens to be the second entry, second leg down for bears if you count from here. First leg down 65 and a pullback, and a second leg down. When the second leg suddenly closes with a strong bull body, that traps the bears still selling, and the bull's coming super fast. Now, where's my stop order? My stop order is resting above bar 66. So what am I looking for is, well, I'm hoping bulls can actually close this bar a lot stronger, maybe a little bit larger body, okay? Then suddenly bulls buy it, and then they go and swept me into that trade. After a brief pullback, I get the second and the third leg back up here. I take a little bit of profit there, and I look for a strong bear body. I could exit and sell that one for a swing. So, and you could see it. Now, granted, it was 525, but ATR was 1.625. I actually saw it. Or say 6. Okay, fine. Then put your buyer there at the 6 point. That's where the buyers are. So you're going to learn all of that in the course. Is if you look, I'm not saying all of this so that you would go buy the course. I heard about Al years ago, and I actually saw some of his videos. I kind of liked it, but for some reason I always put it in the back burner. Is back in 2018, 2019, and I was just trading the tick charts. I was doing fine. I just didn't, care to take another course. I was doing fine. Then I was gifted. Someone actually gave me the course access. It was a Christmas gift, and I got in there and I started watching. I was, oh my gosh, this is fantastic. It actually validated some of the point counting that I do. Okay, and it really helped me especially once I saw the 15G, the course 15G, I was like, oh, that's it. I'm doing the right thing. And I just got very excited from there on. And I kept taking the course. I still go back. Now, I'm not saying that for you to go and buy the course, right? I want all of you, thousands of people here, want to buy it, okay? But only because I want you to be successful. I want you to truly learn how to trade this. Everyone's going to look at this level okay, so now the buy orders are dropped above 67, okay? This is the first entry long and a second entry long now from this is, flag and a double bottom. So the bulls are now resting above is bar 67. So once you take the course and learn it, this right here, you will never call it a chop fest or whatever the fancy word that people use these days. Oh, it's a choppy price action. Oh, it's sideways. It cannot be traded. Oh no, it can be traded, and there are institutions actually trading, and they excel in these conditions. This is tradable only to the person who knows how to trade it, and that's in the course. So go take the course, okay? So now look, is bar 68 did not actually go and test the 67 high. So all the buy orders are still sitting there safely waiting. No one has entered a long trade nor got trapped, okay? So the bear's still trying to get another leg down. They're still trying to get back to the 59, but finally they exit, okay? Bulls are gonna come in and you're into the trade or into the market right above 67 high. People with credit cards. Yeah, do it. Go get it. Go get the course. You'll like it. I mean, I think there's also okay, maybe I shouldn't talk about that. All right, never mind. With the course, let's go back to sometimes I carry it away, and Richard is going to yell at me if I don't shut up in a second. Okay, so where are we? So I'm waiting for now this is the second leg. This is now becoming the second leg or part of the second leg. So the bears are still trying to push this. But is this a good place to truly sell? Or did we get our second sell with the bar 65? Okay, so you have leg one, pull back leg two. Could you have taken this and this would be the first sell and the second sell? Maybe so, I don't know. But this isn't how I find my sell zones. This was the sell zone right there. So here's a leg one, pull back leg two here. So we're still in the leg twos. Could this sell? What do I need? Are we not going to go up here? I'm okay with that. I've never entered that long anyway, above 67, right? I'm still holding a long. I want to add to my runner. I still want to see this area tested again. But if bears have a different idea and they start to gap down from the moving average, I could do two things, okay? If you're still long and holding, you can do two things. Look, you got a huge leg, pull back is another leg up. Also, leg up, pull back, and a second leg up. So basically, here's where the buyers are waiting, right? So here's from here all the way to here. So when the price pulls all the way down there, that's your first buy zone right there. And the second one is right here. That I would not wait for market to come down and test it right there, okay? From this low to that low, 52 low. So I could do two things. If I'm still holding this, which I am, and I don't like these bear bars, and if it does come down here, I'm going to be buying here. As it bounces, I will break even, because that bounce could exit out all of those bulls who now see a wedge top and lower high, right? Head and shoulders, and they're trying to sell it, okay? But that pullback would exit me out before bears sell all the way down here. I talked about it. If bears are still selling, we're not going to go up there. I'm okay. Market can turn around and reverse this. This is a very strong bear body. But bulls are probably stuck up there. Bears see a left shoulder head, right shoulder, and a neckline. Okay. Here is the neckline. That is the break of the neckline. we're going to have to, they're trying to come down into the first buy zone, which is right there. Buyers are in here. This is now a swing. It start to sell and we're start to gap down. So this is where you're going to have to think of, look, is they actually, these bulls bought right there. Look at this bar. They put another buy order. I canceled that order already. I'm not interested in buying anymore with a stop order. I'm interested in buying with a limit order and fixing this trade, okay? And here's the first area where buyers are present. So neckline is broken. Most likely we're going to go right back up to that neckline and retest it. And that's where the bears are going to try to sell. And everybody who's stuck here with their runner, they were hoping that these levels to be tested one more time. They bought right here and they're trying to break even. So when was the last time the bulls bought? Maybe above this bar, okay? They buy somewhere here, or I would say right at the top. Maybe they put another one in the middle or all the way at the low, right? Is they want this to be tested to get a break even. Can they get it? I don't know. We'll see. If they don't, there are more buy orders down there, okay? This, what I call right here, 33%, that is the early bird special. Now that's an early exit, but you have to kind of load up. So if you have one contract, you end up buying three more contracts to get there. So you're kind of desperate and you want to get out of the market before it starts to collapse. Okay, so that's when you load up, and that's around right here you exit. Now this bar may not go there, but the next bar could. The next bar could get there and also tag here, and that would be the average break even for anybody who's still holding, or last time they bought here, as they buy down here again. It's difficult to, or maybe here, right there. Maybe they bought there and they were holding, because this isn't a good bar to buy. So I would measure from there. And everybody who bought here, look, bar eventually, let me get this out of the way, eventually went up to here. It came all the way up, kept testing and testing and testing. Why was it doing that? What's the purpose of testing the same price point over and over? That's because if anybody who last time bought here, they buy again, that's their runner. They're probably exiting right there. But those are machines. What about the retail traders? They're looking for a bull bar to close. They're looking for, if this bar closes bearish, the next bar to close bullish so they can buy, and then this is where they would break even. I don't like to load up. I can, certainly, but I don't need to. I generally do 1-to-2 ratio when I'm trying to fix something. And if I can't fix it, then I need to scale in one more time. But generally with the two scales, the first scale, I have a high rate of fixing anything as long as I enter in the right place and I measure it correctly. I just apply logic. This is a really good bar to buy. So you buy above it, and there it is. I'm already breaking even with that contract. So now I want to see a bull bar actually closing above these average break even. If the bulls, they close bar 68 right there, that means they're actually going to go and test the high of bar 60. Then I don't have to exit here. I kind of start making money once again with that contract. And then they close a bull bar there, and that's it. Then we're going to end up going up right there. So right now the bulls are trying to get the break even, which they got it. So now they're trying to close a bull bar as close as possible to the 60 high to get a full break even without losing anything, and that contract actually ends up making money. Okay, even if it's a one tick, that actually covers their commission, so they lose absolutely nothing. Why is this important? Well, these kind of things are big flaws in hedge fund traders. You're a hedge fund trader, you're constantly exiting out of trades, or your boss gave you money to invest in the market to trap other traders, and you're not able to go back and get that money from the market. So you're kind of scratching, like you're an average trader, okay? And even that commission, that could look bad. At the end of the year, that could affect your bonus check, okay? So you don't want your bonus check to be jeopardized. You don't want that. So you want a flawless rap sheet, right? So that's why measuring is very important. So That's why you don't want to be an average break even. But here, I'm a retail trader. I'll exit whenever I feel danger, okay? And I need to fix that and get out of there. I don't care, you could take my commission. But if I'm saving, okay, I'm only losing $12.50, okay? And I'm saving $500 to $1,000, that's a good day for me. Okay, so that right there is a great representation of how to buy in a buy zone, aka secondary demand zone, and then look for a strong bounce that will give you a break even. But now this bar 69 looks very promising. Okay, so anybody who wanted to buy, what would they do with their buy stop order? Okay, they dropped it right above that bar. Now they're looking for, okay, we got to get in now and we got to get up here. This time we're going to be pulled into this trade because bears already made a leg one, pull back leg two here. Okay, so now most likely is we're going to get above 69 and we're going to get those buyers into the trade, and then we're probably going to go higher, and this time we could test the bar 60 high. So everybody's waiting, drop their buy stop orders above 69, waiting to enter the market right here, right now. And they're hoping for price to go up. They're hoping this is the second try by bears and they're failing. No one has entered a trade because bar 70 did not go above. Oh, wait a minute. This is, what time is this? I'm supposed to be done with my session. I carried away. Give me a second. I know it's posted on their support. Sorry, I can carry it away because I have so much fun explaining the price action. I'm supposed to be done right now. I'm so sorry, Brad. I've taken 2 minutes off of his time, so I apologize for that. I'm wrapping this up. Thank you so much for joining, everybody. I really appreciate all of you being here. If you want more of this price action, you want to learn. I mean, I could only show you a few of my tricks, but you know, if you join the trade room tomorrow, or you know, for the month of May, you get more of us. Definitely 3 hours each, so you got plenty of time to ask questions and interact with us in regular webinar hours. Okay, so I'll see you guys tomorrow. Bye, everybody. And here comes Brad Wolf. Don't go anywhere. Hello, everyone. This is Rose again. I'm back. Because I think Brad is having a technical difficulty. So I'm going to wait for Brad to come on the webinar and tell me that he's ready. Okay, hold on. All right, he'll let me know. And then until then, we can keep reading the price action. All right. Where were we? All right, so stop order bulls entered above bar 69. They are hoping to make money, at least half the ATR. That would be 3 points and a quarter. So from above where they entered 69, measure 3 points. You should bank that very quickly, or you should expect price to try to get above bar 60 high. Okay, so either or, that should be your scalp. That's only 150. I would expect 225 or 3 points since ATR is now 650. It could be a lot more than that. So 650, 325 maybe. So we should get that 325. If ATR goes down, you're going to have to adjust your expectations. So is bulls entered above 69. They want another bull bar. They want one more bull bar. They see a double bottom bull flag, and they want to keep going higher. So this is where you are long. This is where you're hoping at least to get some kind of a scalp. Now ATR is down now, so your expectations should be 225, and then one time the ATR 5 point. Either or, we should tag that 225. So that's what I'm waiting for. And I got it. All right, so entering above 69 was lucrative. And we got our half the ATR. That's the initial scalp. Now what you could do two things. You could take your money and go away and come back tomorrow. or you can scalp and leave a runner and see if you can get the full ATR. And that would be 5.5 points. Take out 2 ticks, that would be 5 points roughly. That's my math. That's 1 time the ATR. Can we get it? They're still scalping. But look where we're testing. Did we just test the 60 high? So was I right? Yes. But it's not about being right. It's about getting money off the market. So you should be, I said 2 things. I'm going to calculate the ATR value and scalp it. But really the goal was actually getting back up there. And we just got it. Look, we just tested it. So that's good news. But I want more from this. Now the question is, will I get it? Right? So how would I know? I have 2 bull bars. A 3rd bull bar would be even fantastic for bulls to get follow through. The only problem here for bulls is this bar right here, 68. It's a very strong bear bar. Bears are like, oh, not so fast. We're actually trapped underneath bar 68. It's time for us to sell into your scalp, your profit taking. Remember, we went up there, we did the math, and that was quick profit taking, right? So many bears were stuck underneath 68, sold. That's why that bar came down very fast. If those bears are exiting out and this bar closes bullish, best believe I'm going to get that 5 point. And it might be even a 6 point. Now the ATR is 6, so you just add another 1 point above it. So it's possible that we could go and test 56.64. What if they close a bear body? What would happen? Hold on, I'm watching. Brad is having a hard time with the go to webinar. It's not allowing him to get in. I wonder why. I have nothing to do with that, Brad. I really didn't sabotage it just so I could stay longer. It was me. So I'm still waiting, looking for bulls to close the bar bullish. He's trying. He'll be here soon. Hold on. What if it closes bearish and then comes down and close the body right below 68 close and 68 low? Then many bulls will exit, or they're going to start to buy because their stop is here, and then they're going to try to fix their trade. So that's why you get this back and forth, back and forth. How do I know this is going to go up, even further up to the high of 64? 2 things. First, this bar needs to close bullish. 3 bull bars, that could put us into always in long. Well, we are already always in long, but in this micro setup. And then second, if I start to see bulls actually not only get that 5 to 6 point, okay, 56.63 to 56.64, and in the meantime, they start to make the bears nervous by, this is left shoulder, by trying to close a bull bar above the left shoulder, then you best believe we're going to not only test that high, we're going to go up here. We might even go all the way up there. So we now have the 3rd bull bar here, which is good, but I need more from bulls, okay? This is kind of mediocre price action here, but still doing what it's supposed to do, so I just don't have to worry about exiting. I just don't want to see a bear bar closing strong, or neither a surprise bear bar. So I want bulls to keep pushing this. So is still 5 point is the target. We should be getting there since you entered. Okay, this is where the ATR comes in and shines. How do we get there? How do I start? I start to get nervous. Why is ATR is set to be 4? It's 4 bars. So if I entered above 69, I'm counting about 4 bars, and approximately 4 or the 5th bar, I'm expecting this target to be tested. If the bulls cannot manage in about 4 to 5 bars reaching that target, there's something wrong with this price action. This is where I need to start thinking, these bears are trying to block me. They are totally now allowing me to get up to that 5 point, and we have spent after this bar, 1, 2, already 3, 4 or the 5th bar, I'm not able to get there. Maybe I need to wrap this trade up because suddenly I could start to see exhausted bulls and then suddenly bears coming in the market, okay? Because just like here, where was that? Where was that? 3 bars up and failure. 1, 2, 3, 4 bars up, and we could suddenly get a failure. So everybody is now watching this bar and the next one. This is third bar, and the next bar to finish the objective, deliver the results. Okay, so you do not exit out of this trade. You wait, because higher probability you're going to get there. Would have been better if the bulls actually closed above bar 60 high. They failed with 71. They tested, but they never closed the bar, so that makes it a little bit higher, difficult. Bulls are trying to break out from the open and the high of 68 to deliver the objective. So I'm going to give them one more bar after bar 72 to finish the job. Okay? I really wasn't sabotaging Brad. I'm laughing because people are posting very funny memes on the Discord. If you're not familiar with Discord, now is the time to get an account and hop on there because it's really fun. It's for Brad. Anyway, I'm sure he'll come in soon. I'm still in this trade and I entered above 69. I really want that 5 point at the minimum, or 525, because ATR is 565, so roll it down to 550. I mean, it could even go a couple of, I'll do the 525 because that's a regular scalp anyway, 21 ticks, as Al would call. So we should bank that. Okay, and we will bank it. It was me. I was messing with everybody's settings so I could get a longer time to, say what I have to say. No, they're going to fix it soon. They're actually contacting the GoToWebinar. I really want that target. But that's not really the only target. I'm looking for a price to get back up here. But let's get that target now, and then we think about the rest later. It's all about making money and actually keep it in our accounts, right? Not in the market. And that's the fourth bar. Ooh, suki suki. I got my target. So who scalped right there? And check that profit taken right there. So I calculated that. And if you can do the same, you're golden. You'll do great. But remember, you're still, why is this happening? Well, that's profit taking. You don't need to worry about it. It's just a couple of points of profit taking. But when does it get even more dangerous for bears? When bulls start to close above the left shoulder. You got a head and shoulders pattern. Okay? When we start, actually not, that is the worst drawing ever. Okay, here we go. So you got this, right? So technically this is a sell. Okay. Once we start to close above it, this is now invalidated. Look for that to be tested, and then take this trading range and project it up. That would be your measured move. So now you want to see bulls keep closing bull bars and take out the 64.75 and take out the 64.75. I am very happy that you're making money there. Excellent. One. That's what it is, 525. And it was delivered with 4 bars. Now, can the bulls give us more than that? Oh yeah, they could. They just need to keep closing bull bars. What if they close a very strong bear body? That means we have actually an official right shoulder. Then we could actually start to sell, right? But this is I don't care about this anymore. Get rid of that. I forgot to remove it. Sorry about that. So waiting for Waiting for bulls to close a bull body and keep going higher. Remember what I said is I said market makers will try to make this bearish enough for everyone to sell, and then they're going to trap them and start to bring price back up here. So when you know, okay, because I went through this so many times, okay, same price action over and over. So once I know they start to buy at the demand zone, the goal is to get to that prior high, okay? So can we get there? That's the question. I want to see. I'm making money, but I want more follow through from bulls. Now, I will know once they start to take out that left shoulder with bull closes, then I know we're definitely going to make, probably going to even go up there and make a new high, okay? So what happens is that this bar right here and that bar, 65, especially 68. What do we call these bars? If you see bears are getting trapped underneath, who places that bar there? So I'm asking to my trade room members, they know me. We have an inside joke. Who placed bar 68 there? There's somebody we know. Jenny, yes, thank you. Who's Jenny? It's a make-believe person who works for is the X capital of billions. Well, she's a, think of it, hedge fund manager or anybody who works for institutions. They're giving a budget or certain amount of dollars to place trap bars. So what this means is the bulls are investing in to bar 68 only to trap the bears, entice them to sell it so they can trap it, and then they go up. That's why they're market makers. That's why they move the market any direction they want with fake bars, okay? But the one thing about this fake bar is that these bulls have not yet showed up strong enough, okay? So maybe we need to come down and claim this money that these people, well, not us, but watch them claim their money that they put in the market and then go up. We'll see. If we start to close bear bodies strongly below the open of strong bull bodies, then that's it. We could actually start to finally sell, and this would become that swing. But I'm not sold yet, so I'm still waiting for market to try to go up. If they don't go up, then we have a beautiful bear flag that I would like to take advantage of. But right now you're in a trading range, so your job is to scalp, and we kind of scalped it. When do I exit? I start to see bear bars closing below moving average, I'm done. I won't even let that hit my stop. I'd be exiting out because I've done everything in my power to keep in this trade, and it failed. So I know now is the time to wrap everything up and start to change hats from bull to bear, okay? But I need this bar to close very bearish. This could be that the market, this woman, Jenny, a super trader, comes down, still trying to make it look like bearish, only to come back and take the money that she put in the market. And as everybody who doesn't wait for body to close starts to sell, she traps them as well. And then suddenly market goes up. I've seen this happen over and over and over. And as you watch and look at the market the way that I'm looking at, you'll start to see all of that as well. Okay, so this is what the bulls see this as a double bottom bull flag. They're just trying to stay above the moving average. They actually look, she came down, brought the market down. She's taking all that money. Now that bar closes bullish, we're going to go up. Not only to here, we might even test up here. But really, the target is actually right here. So I want to see if the bulls can actually swing all the way up and make a new high today. And that's what I want to see. That's it. That was exactly what Elle explained in the course. It's also in the free trading range course that I talked about. on the Brooks trading course, right? What was it again? Perverse logic. Yeah, that's it. Kaylin got it. Thank you, Kaylin, for reminding me. So who's going to win here? Are we going to sell? Is this a wedge top, lower high, trend reversal back down, and we're going to make a new low? We're going to get to the low of yesterday, which is right there. It is possible we could very well do that, but I need to see commitment. Okay, is either bulls are going to trap one more time, okay, or bears are going to finally look 1, 2, 3, 4 bar up, failure, and they're going to close a strong bear body. Then they can sell that close and then finally move underneath 69. Come all the way down here, probably some buyers would show up there. Remember, this is also a strong buy zone. We could also get a big swing from there. If this isn't a good place, because it's kind of in the middle of a trading range, it's never a good place to open any trade in the middle of the range. You either go up and sell from here, or you come down and buy from here. This right here is so unpredictable. This is the kind of price action you get. So you're pretty much limited to scalping, which you got a great representation of how to do that. So now, if market wants to commit to sell, fine by me. I'll exit as soon as this bar closes, and I expect price to come down here, and then this is where I'm going to be looking to buy. Okay. Let me see how Brad is doing. Oh, still no luck. It is interesting. They're not. I really have nothing to do with this. I don't know why this is happening. I am so sorry, Brad. And you guys really need to hear him because he's really good at reading these bars. Not sure. It's a triangle. We're right at the apex of the triangle. Right there. I'll take that high. And then here. When does this get very bearish is when bears break this, but there could be buyers again. This is a buy zone, this is a buy zone, but I'm done with this trade. I am committed to my plan, and I don't care if they buy again. But I said if this bar closes below the moving average, a strong bear bar, I'm pretty much done. I will exit out of this trade because it could quickly sell to this trend line and then further down to here. I don't want to be in a losing trade and then try to scale in here, which could also go all the way down to this is high of yesterday. Low of yesterday is somewhere down here. That's way, way down, which is right here. So that we could actually even pull all the way down here and try to close this gap. Sometimes what it does is comes down very close and never closes the gap, and then the swing bulls show up. So I don't want to be in, you see, I'm glad I exited out of this trade with 74 because we're coming closer to the end of day. And that means a lot can happen. We could also close around the moving average. I'm going to offer one more thing to Brad here. Interesting. Can't seem to get in. All right, okay. Okay, I'll keep going then. There's nothing wrong with the way that you highlighted that channel. It seems fine. It's looks like a bear flag. Bear's getting the lower high set up right now, but remember, we have a one big trading range here. Sometimes we sell and then suddenly bulls show up and then we start to buy with urgency at the end of the day. There's not much time is left right here, okay? So be careful. Bulls also want the second entry long. As early as that trend line or underneath the trend line, we could see bulls starting to come back in one more time because this was the first entry long. They didn't really get there quite the second entry. So that's one of the reasons why also we're pulling down. But these bears stuck underneath is bar 68. They pretty much fixed their positions. Now that could be that institutions that put their money in here to trap the bears coming to get their money, and then suddenly we could start to see bulls. We're right at the apex of the triangle. I still don't know. It is the worst place you want to take a trade. You either take the trades from the trend lines or from the trading range low or highs, but never in the apex of the triangle. Oh yeah, we could. We have not tested this area nor that area successfully. All right, bar 76, here's a problem. Up until bar 75, market has been going sideways with 4 or 5 bars. This makes it very difficult to structure a trade. What happens with the 76 close, institutions start to come in and market imbalance numbers will be announced. Now what happens is that we could suddenly go up here as you start to buy, it could start to come down here. Suddenly it comes down here as you start to sell, it goes up. And this is the problem. When price goes sideways, 4 or 5 bars into the bar 75, it's a trading range. It's not, just let it go, don't do anything. At least look for a confirmation and then buy if it breaks out. But unfortunately, if it looks like it's breaking out, suddenly it goes up here and they could sell and you could get trapped. If it starts to sell, suddenly you sell and then they buy, you get trapped once again. So this is why is L tells the traders, this is not a good setup. And this is also covered in the course, how to trade the certain times of the day. So it's the opening, the midday, and the end of day, how to trade the end of day. This is all covered in there in the course or in the books. So I would recommend you to go check out the videos. They're so easy to watch with great examples. So I would definitely take that, I would watch that before you try to trade anything at the end of the day, because it's very trappy, especially when it goes sideways. Well, we get a really nice double bottom bull flag or wedge bottom bull flag, 1, 2, 3, bar 60, 69, and 75. Now bulls are getting some kind of imbalance. Look, we have a first leg and a second leg and a third leg for bears. First leg and a first leg and a second leg and a third leg for bulls. So what did I say? Before we break out from any trading range, you need to count 3 legs for each side. Let me get rid of these so it's not cluttered. So here's my tight trading range. I'm excluding the wicks, okay? So bulls are trying to close above the 50%. It could go up and suddenly comes back down to the 50%. The bulls show up again, we'll go, okay? Or if you buy right now this bar, that's okay. That's the second entry long, okay? Look, we made a new low. That's first entry. Came down, that's second entry. Bulls are trying to swing it up. So I did say we're probably going to get up there, and we are doing. So what is this now? This was institutions coming and getting their money that they threw into the market to trap the bears trying to sell. Now they're reversing the market. So this lady, Jenny, is going to get a fat Christmas check at the end of the year, I guarantee you. So let's go. But anybody bought above 75 or at the low of the trading range, scalping up here, they also know as soon as this bar closes, bears could sell it and come down and test the 50% of this bull gap bar. It's a leg in a trading range. It could fail. But if it closes above, okay, look for still a pullback and the bulls can buy it. We could even make a new high. This is my target anyway. So this is my measured move target. This is my 2R. This is, well, that target. And then we could even get the 3R if we wanted to. That would give us the new high before the close. Are we going to get it? I don't know. It's sideways. Too many bars sideways. If it's 20 bars, we're definitely going to get the breakout. If it's 40 bars, the breakout becomes 50-50. It could go any direction if it's 40 bars sideways. But we have, what is it? 56, 66, 76. We have only 20 bars here sideways. And if the bulls are closing strong bull bars, that means we're going to break out to the upside, which is great because this is 1, 2, this is the third leg. We might get a pullback. If the bars start to close below the 50% and breaking out, then that's obviously bears are going to swing this down. But now, here we are. We haven't properly tested this, so we're probably going to go there. So that's the first breakout. It's coming back to the 50%, which I said it would happen. Okay. Now bulls need to hold the bears right there and then close the bar above the 50% if they want to go up here. When do the bears sell? I warned you about this. If they close below right here, the first pullback, they will sell and swing it down, I'm afraid. So bulls are not able to contain. See, I warned you about this. I warned you about bar 76 closing. If you buy it, you have to scalp up here. So you can exit out with safely. You can sacrifice your runner if you're still holding. And now look, they just reversed it. I talked about this. It's very dangerous when it goes sideways more than 5 bars into bar 75. It lowers your probability to break out to the upside. It looks like it's going to break out. You have to scalp there and it goes the other side. So here's what could happen. It's coming down, right? It's go up and then start to sell, or it's just going to keep selling because it's now imbalance. So if you sell right here, they could also trap you. They may need to go right back up to the moving average. This is why I do not trust this. So if you sell this, if you sold it somewhere up here, you need to take some profit here and expect another pullback. Because we're back into this buy zone. There could be buyers here. And if you do sell right here, they could trap you. I wouldn't do anything. There's not much time left. I don't think there's a lag. I'm checking everything. I have trading view on my mobile, another laptop. Everything seems okay. Wow, this is imbalance. All right, we got that measured move. We might actually get the 2R now. This is fantastic for bears, but I wasn't in it. I didn't take the trade. So, but if I weren't talking, I would have definitely taken this trade. I've seen this happen many times. I wanted these bulls, but this is no more. Not today anyway. So now you can also do, look, you don't have to exclude the wicks, but then what? Where's the measured move? So we didn't even get to the half R, which is half reward. If this is your 1R, that's half R. We didn't even get there. So now what? That's not the way to measure, especially if the wicks are large and it's a tight trading range. Just exclude them. Find the highest body close and the lowest body close. That's going to give you a much accurate measurement. Okay, now if they close the body below the red line, they're going to gun it for this target. But there waits the bulls. I warned you about this bounce. It could bounce and get to the breakout point. This is how they trap you. There's not much time to swing this to anywhere. So this is still a buy zone. Remember, I said this buy zone is so big, you can divide it into like 3 sections or 2 sections. Buy order, which they got, and their swing failed with 2 legs. Another buy order activated, they made money. Okay, if they close the body below this red line, they're going to come down to here and here most likely, and then reverse. Or that's it. This is a measured move, overshot, and then it's going to try to go back to the moving average and close near it. We'll see. This bar still has 53 seconds. Let me see how Brad is doing. Bulls couldn't control the bears right at the midpoint. But you kind of get the feeling though, right? It's not the feeling, the signs are there. This bar never closed bullish above the trading range. So is that a true breakout? If it were to close bull with a bull body, then pull back, then they would have controlled that midpoint and then we would have gone up. So this ended up becoming a typical end of day, 5 or more bars into bar 75 going sideways. Any breakouts will be faded. Okay, and that I warned you about that, and they did it. So now, look, they closed bar 77 below the 1R, and here comes the 2R. At this point, I think they could get the 3R, but now we're in the lower buy zone. Who's here? Knock, knock. Who's here? Bulls are here. They could show up suddenly, so be careful, okay? Can market make a new low? Go and test these lows and make a new low? There's no time left. There's no point, right? So if you actually sold this, I would recommend you to take profit and not look back. Don't worry about the rest of the R's, right? Rewards. You reached an important area, okay? And there's no time, 4 minutes left. Look, if you take a lot of profit and just leave a runner for the 3R, be my guest, but there's no time left, okay? So it's kind of, it could suddenly trap you and reverse back to the moving average halfway at least. And you don't want to be stuck in that and give back all that you made. Take a lot of profit, leave a runner, see if we can get that 3R. But that's about it, okay? I'm going to start the end of review because I don't think Brad is going to be able to make it. And frankly, he shouldn't even bother. I mean, if you guys are, you know, you'll be, I mean, we posted the May schedule on Discord. Let me show you, those of you, hold on. You're going to get sessions with Brad in the month of May. So if you join today or tomorrow, you got Brad tomorrow for 4 hours, in fact, like 3.5 hours. He'll probably have a lunch here and there. And then Brad comes in again with Al Brooks, and then more Brad throughout the week. So this is the May schedule. I would definitely join. And sorry about this. We have sometimes technical difficulties, but we fill in for each other, so you never get a, you know, anyone not actually showing up. So looks like they're gonna get the 3R, and as soon as they got it, I'm just gonna clean up the chart and start talking about how I took some trades today. All right, I think this is good enough. So let me clean this up. It's almost there. So that is about 28.25. They're about to tag it. So swing up didn't work, but they tried very much. So this ended up becoming a bear flag. Now here's another sign. Look at the strong bar 76. So if the bears are able to trap the bulls there and then taking out the 76 lows, I would exit out of any long trade and start selling right away. That's violated right there. And in fact, look what they've done. You put your stop there, you start to count, and that is your 1, 2, 3R right there. So can they keep pushing and close this gap before 5 p.m.? Technically, there's still time. They could, but who's going to trade it? Not me. But you could see that's a 3R right there. So they could still sell, but there could be news coming up. I think this week is, I don't have any earnings scheduled after the close. There might be something scheduled that could actually help us close this gap. This is very significant price move, but you can clearly see the bear flag, okay? Another way, it's very simple. You don't need to do any of these analysis. You simply sit back and wait for this trend line to be broken. And what you do is you sell the close, you sell one tick under, and you put a sell order. If it indeed goes up, then you can enter also there and you sell. That is your bear flag expansion down. Okay, but that's pretty much it. Okay, so market could go to the 50% of the SPAR or starts to go right back up to the moving average. I don't know what would cause that. You need some kind of a catalyst for this to reverse. It could also go sideways and have another flag and continue to sell and close this gap. Either or. It could actually pull all, oh, it's the Amazon. Okay, thank you. Apple and Amazon. be careful. Is if bulls are stuck here, they could suddenly buy. We could go right back up again. But I think something like this would create another leg or two down. I think the market would end up coming down here. This is actually a good support. Is we could end up coming down and testing this support, but I would not trade this. I did say we would test the midpoint of the bar. We went a little bit further up. Now they're trying to sell because nobody wanted to sell low. It could still get a leg or two down, but this is now news. It could suddenly reverse. It could come down. This is nice support. We could close this gap and reach here, but I am not trading this. Okay, so let this do its thing, and I'm going to start the end of day review. All right. Yesterday we had a bullish close, and it was pretty nice breakout at the end of the day with 1, 2, 3, 4, 5, 6, 7, 8 bars. It's not quite a full hour, but it's still long. It's a long enough time to say that the end of the day yesterday was a bullish close. Therefore, you should be looking for a 50% probability to go up. Okay, at the open price to actually continue buying. Okay, now problem here is that we didn't have all that great of a trend to begin with. It was only 8 bars, so we got a little bit of trading range price action at the open. It's normal. You got the leg here, okay, and pullback. You got another leg here, so this is your pullback before we get the third leg. So technically, I count legs there, okay. So, but even if we go sideways, bears are trapped. The low 1, low 2 failed from the highs. High 1, high 2 is succeeding. So that is failure of a failure is swing. First reversal down, bar 1. Bulls immediately below that bar is bears sold above bar 1. So that's second reversal up. And then the third reversal down as the bears sell and they get a break even, but they cannot get any follow through. So that means that tiny little trading range buyers are present underneath. They're trying to keep the gap open to the moving average. So that means I lost count. That was 1, 2, 3. Yeah, that was the third. Now we're looking at the fourth reversal with bar 7. With the close of bar 6 and the open of bar 7, the machines always look at this as a possible news and catalyst, and suddenly volatility comes in the market. What I generally do when I'm trading news, here's a little bit of tip for you. Now the Brad is not here, and I'll give you some tip to go by. Okay, is when you're trading news, here's the thing. Find your news bar, which is bar 7. Mark the high, mark the low, okay? Look to see if we are actually, look, stops are here. We'll start to buy above it. Find the midpoint. If we're staying above the midpoint and then taking out the news bar's high, you can keep your stop there and go for a 1R, go for a 2R, and then get that, okay? So here's what I would do, right? So I'm measuring that. Your stop can go under 6. I'm only measuring the bar, okay? So this is my 1R, but you should be actually measuring from the close if you want the 2R, okay? Or if you measure the entire, now I'm not going to enter 1 tick above is bar 7 because it's got a doji. That's why measuring that way is not going to help you. Because look, we had to move down with a couple of bars, and somewhere around the close of 7, bulls were entering, okay? Or you could say, hey, I'm going to enter above bar 9 with the stop underneath bar 6, okay? That means I'm still going for that 2R. I still can't get it. Again, bar closes are a lot better representation of measurement, and that's what it gives me conservative targets. But I tend to 99% of the time get these targets if I'm conservative, where I enter, where I'm measuring from. But anyway, I'm going to get back to that a little bit. Anyway, so you have is bar 7, the high and the low, right? This is where the stop is. If the 50% is not being taken out, then most likely it's going to go break out from that end. And it did. And eventually we will come back down to bar 7. but it may take a couple of hours to do that. Once we break out from the news bars high, chances are we're going to go higher. All right, so that's exactly what happened. Bulls are buying with the second entry long. You have a small flag here, 7, 8, 9. You can buy above 9 with the and then you would go long. Is not a good bar. What happens to flags? What is not good bar? That's bar 10. What happens to flags that everybody's buying and no one's taking profit? That's a big problem. Institutions, when they're doing a flag trade, okay, maybe like this, double bottom, they mark that, and then they expect price to go there. They only buy partial, okay? They only enter the market with partial contracts. They take profit right there. They expect a pullback. If the pullback is weak, only testing the 50%, and we start to get breakouts, this is where they enter the full contract size, and then they go for a measured move, okay? So that's where you take profit. If you continue to see above the measured move bull bars, then you go for a 2R target. So now you're getting a micro version of that with a 7, the pole of the flag, the trading range with 8 and 9, and look what the bar 10 did. It went up and then came down and closed somewhere low. But it's so shallow that, and it closed bullish, chances are we're going to break out. Now we get the breakout. This is fantastic. So if you actually take the whole thing, that's your 1R. We got a little bit more, okay, that's fine, but you know, you made money there. Now we turn into a small pullback bull trend. Pullbacks are only 1 bar bearish. How do I know this is a small pullback bull trend? I see consecutive bull bars breaking out of some kind of a trading range, and then suddenly I see a beautiful gap bar. After that, it followed through, and in the first bear bar, I stop and I look at that bear bar. If that bear bar is not getting continuation bar or 2, and the bulls are start to buy the close of that pullback bar 13, chances are this is now setting up to become a small pullback bull trend, and you can actually buy the pullback bars, buy above the bars, is, you know, buy any reason, buy, and I look for 3 or 4 pullback bars like that before I look for reversal, or I count bars. How do I know swing is coming to an end or exhaustion? Is I should start to look for reversals. When do I do that? Well, I actually taught this, I think it was, when was it? Was it Monday? Was it Friday? One of these, I think it was in March. Yeah, it was in March. I had a whole session dedicated to that training. So if you want to go purchase the March recordings, you learn how I look at the swings. I count. So I look for about 6 bars up. If the bulls are closing above a specific bar, I'm not going to talk about it. I want you to join the live sessions and learn there. Then I count a certain amount of bars, okay? I'll give you a hint. I look for 1 or 2 hours, okay? Then you can figure out how many bars that is, okay? That's your homework. Oh, what the heck? I'll just tell you. So I look for 6 bars, and then if I see bars closing above, okay, the 6 bar, I then look for 12 to 16 bars continuation, up to 20 to 24 bars max, okay? Then I start to look for reversal. Well, let's count, shall we? Swing starts here. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16. Oh, look at that. Is that a coincidence? It's not. Because if you go and actually do this exercise on many, many charts, you will come to the conclusion that I am actually not making up stuff. And this is actually true. Because it's the common, look, machines are stupid, okay? Somebody very smart programmed them, okay? So that smart person is telling these machines to look at a certain amount of points or bars to determine something. Did the market move 12 to 16 bars? Yes. Should we take profit? Yes. Did the market close? Do you see a very strong close inside bar or a bear body taking out more than 80% of the bull body at the top of a trading trend? Yes, that bar is 23. Did that bar get another buy? Okay, so that's a checkbox, checkbox. So 2 checkboxes already checked. Now, did the bears get a follow-through bar? Yes, that's the end of the trend. Exit, sell the other way as early as possible. If you sell underneath 23, that's your 40% probability entering with a very tiny risk, and you're looking for a big reward, okay? However, is 40% probability means also is you don't know if you're going to get a big reward. But one thing that you're getting is a tiny little bit of risk, okay? So if your risk is small, you should be at least getting a 2R from this move. So if you sell as early as bar 23 and put your stop above that, you should go for a 2R, and you got it. And then they closed below the 2R, ended up getting 3R, 4R, and 5R. So the smart machines counted the bars and counted about 16 bar swing up, decided that this is the end of the swing. But that's not the only check. There are not only 3, there's also the 4th checkbox to determine that the trend comes to an end and it's no longer going to go up. What is that? Everybody comes to the trade room knows that because they have taken the course and they know what L says. When the bear bars start to close, open and below of very strong bull bars in a small pullback bull trend, that's when the scale tips to the bear side. And that's when the bulls start to take profit rapidly. That creates bear bars. Where is that bull bar? Let's hunt. That one. That one. That's not all that great, but that one is. It's also breakout bar 21. So you start to see bears actually taking out the open of 21 and low. Well, I'm not sure over there. Let me delete all of this first. Let's do a little. Bars are too small. Oh, they couldn't look. So this is still bullish, but 2 bear bars. No, everyone's going to start to exit. Now everything gets very, very bearish as we take out a very strong bull bar, bar 18. Look at that bar 25. This trend is over. If you're still holding this, wanting to actually buy and fix it, you're going to be, they're going to trap you even more because 3 bear bars means sideways and more legs to down. What you need to do is just exit. Just exit out, okay, before they take away your funds, okay? So you see this? This is death. Done. Everybody died. Everybody go home. Or just go the other way. Now, anybody entering, okay, at the close or below this bull bar, entering with a 60%. It's far from the prior high, so your risk is far. So now, instead of looking for a 2R, you should be looking for a 1R. So if you sold here, you put your stop there, that's your target. If the bears are still closing, take some profit there, actually a lot of profit, but then hold a runner to the 2R. Now, bears bring the market to 2R, but at the meantime, count legs. Leg 1, pause. Leg 2, pause. And leg 3. But now, look, we're going sideways. They're taking profit. Just wrap it up. Just exit, because it's probably going to go into sideways for at least a 6 or 10 bars. And it's a waste of time sitting there and waiting. And bulls can actually try to buy low and try to resume the trend back up, which creates a trading range. But you already know that this is a trading range, right? Every good thing has to come to an end some point, right? So what goes down must come up. You got a big up, you got a big down. So it's already telling you it's going to go sideways and up probably. Now, since we're in a trading range, why would it go sideways and up? Well, it's a trading range. Trading ranges have this something called midpoint. That midpoint is where the fair price is. And in fact, anybody who's buying here will probably going to take some profit here. So probably price is going to get there. Anybody stuck up here, they buy at this low and then they get a break even there. That makes this area is an 80% probability of buy low and take profit here and be done, okay? But what about the 60% probability of bulls? Where are they bulls? Those bulls were up here, maybe up here. Look, we got very close to it, but we never reached. So that 60% probability was done. But they got the 80%, okay? But how do they oh, wait, let me calculate. Maybe I'm wrong there. If you bought maybe the last strong bull bar right there and then trap there, what does L say? How do you re-enter and scale in? Forget about the trading range. It is important, but what do you look for? You look for at least 2 or 3 times bull scaling in. I would say 2. It's in the presentations. That's the 35 A, B, C videos I want you to watch. And there's also a free video. If you go to the brookstradingcourse.com, in the search box, type London, like the city. And then look at the blog post, the very first one. It says London Symposium, webinars, the Giants by Tom Hugard. It was a big seminar that he did. Watch L's presentation. You will then learn L saying, if we have bulls are trapped there, they will not buy again until they start to see strong bull bars. Let me get rid of this for a minute. So if you are a bear, if you are a bull and you see this sell the close stop order market are you going to buy these bars? Heck no. You're not even going to touch them with a 10-foot foot pole. You're not going to do anything. You're just going to let them rip. And then you're going to start to look at strong bull bars. But be ready. If you buy the very first bull bar, bar 32, and you enter long, okay, hold on. Let me make this a little bit more prominent. Enter long, chances are they're going to trap you, come back and test the bar at 30 lows because it's a tight bear channel. It only pushed 2 times. This is chances are this is a pullback to sell again with another leg. So you have to give yourself a second chance to enter with a really good looking bull bar. Good looking bull bars should not have upper wicks like bar 36. That's not a good looking bull bar. It is okay. It closed on its upper third level, but it's not all that great, is it? Because this is leg 1, pullback. Leg 2, pullback. Leg 3, probably a minor pullback. It will probably going to come down. And then you look for something else. So this is your high 1. And there it is. That bar is bar 43. If you are a bull, and the last time you bought here and you're trapped and you did not have any chance to buy again, you buy the close or 1 tick above that bar. Now expand this up. Your stop is somewhere down here, okay? What are you going to do? Where do you break even? Where is your 80% probability to break even? And where's your 60% probability to break even? That's your 80% right there. So anybody who scaled in down here get a high probability of breaking even, exiting out of the market, maybe making a little bit along the way, but that's all you're getting. We are not going to go. They try to get the 60%, which is market coming back up to the bar they got trapped, and then that would be a full break even. They never got it. And in the meantime, 1, 2, 3, or 1 underscore 2, underscore 1 undershoot 2 and overshoot 3 wedge, and then you got 1, 2, 3 another. So you got 2 consecutive wedges or nested wedges, whatever you call it. It is a wedge. Okay, so and there are 2 of them. So that means these bulls are exhausted. They're trying and trying and trying, and they can't seem to get to their 60%. You got to some point exit out, and we saw that. They failed, right? We fixed the trade. We made that 5 point from above 69, but we just couldn't do anymore. You're done. It's keep coming back to the 68 low. So now it's 20 bars plus, and bulls are not able to go get a breakout from the top. So that means it's going to go get a breakout from the bottom. So if you watch the presentation, that's great. You're going to learn, great deal. Anyway, so now I see a wedge top and double top lower high. This is now setting up to be a bear flag, isn't it? And the market sells and gets the bear flag breakout to the downside. And in fact, remember I said we have a really nice support here. It's something called mother bar, weekly mother bar. Okay, is upper trap, and that was that upper trap. We came back down to the upper trap. So is market collapsed, closed the gap. So when a gap closes, it can bounce, but When a gap closes like that, that's a bad news for bulls. Bounce could be weak, and then we could continue to sell tomorrow. I think after hours, we're going to go up a little bit, and then it's going to keep selling with a couple of legs after 6 p.m. So but there are buyers here. So watch this. From here to all the way to here, we could sell after 6 p.m. However, buyer is going to be right here. So if you like to trade after hours, look for this to go up a little bit, come back down, look for 2 good-looking bull bars. Don't buy the first one. Look for a wedge bottom. That's a bear flag. And then look for a pullback all the way up to these levels, at least. Okay, that could put us into a trading range after hours. I don't trade the after hours. But anyway, so let's talk about the limit order stop orders. You got a lot of limit orders here. Bar 1 and 2 overlapping, that's a limit order market. You should be looking for several reversals before market sets up a double top and a double bottom, and then gives you a Walmart trade. Here's your first double top, first double bottom. Okay, this is a limit order market. That is a bet against market. That means anything good looking should not be buying or selling. You should betting against that bar. Okay, that's what it means, limit order market. So very good looking bar 1. You can already see that it's a limit order market because bulls are betting against bear bars like 1 that close on its low. They're buying it. Okay, we already knew that. Oh, there's a really nice bar here, bull bar 6. Oh, let me buy that bar. They're going to bet against it. They're going to trap you right above it. And that's exactly what happened. It's not even all that great, but it closed on its side. That makes it a bet against market. So they sell it. You're trapped. Now you're going to you can get out of it, but how do you get out of it? You learn your lesson. You read the bars to the left. 4 bars is enough to figure out what kind of conditions you're in. Market is already telling you, look, conditions are set up. This is a limit order market. Do not buy good-looking bars. It's a trap. Do not sell good-looking bear bars. It's a trap. Okay. So here's bar 7. Are you gonna sell this bar? Sell the close or 1 tick under? Haven't you learned your lesson? They're gonna bet against it. Oh look, this bar actually gapped up. So they're buying it. Buying is pretty strong of a very strong bear bar. It's telling you something, right? That the bears are trapped. So the bulls now are gonna buy and keep going. Now we take out. We have a double top, double bottom. We have an expanding triangle with the apex of the triangle. Bulls are able to get above and close above it. This is a done deal for bulls. They're now getting a breakout, especially above the trend line. They start to close. You can look for a continuation. They kind of formed somewhat of, it is a small bull. It was looking like a parabolic first, but it turned into a small pullback bull trend. But some would say, no, this is actually a minor parabolic wedge. And I would not disagree with that. We actually have slides in the encyclopedia talks about the minor parabolic wedges and how to trade them. All right, so if you want to get a little bit of refresh, go to the encyclopedia slides database and start studying the parts. Anyway, so now trend ends is after hour and a half or so, right? 16 bars, and is around 11:30. That's the end of the second hour. If you count from the first bar, but the trend started here, that ended up becoming like 12 to 16 bars. All right, so now we have market is reversing. That's great. You entered, and maybe you even entered with 25 close or 1 tick below 26. There's enough distance, the moving average, to sell and expect at least a second leg down. You're looking to see is if the bulls are going to hold this area, that are we going to bounce at the moving average? Why would that be? Because if you look left, there is a gap bar. And that means there could be buyers right here. The bears actually close that gap. If the bears are closing that gap, that means they're pretty strong. They could sell with another leg, come down and test these lows. And that would put us into a trading range. Big up, big down, confusion. So now stop order bears, we're going into a limit order market. Again, same thing. You have learned your lesson. Look for signs. Look for clues. Are we in a trading range? Trading range is a limit order market. So therefore, it's a bet against market. Oh, let me see the signs. Oh, look, excellent bar, 32. Let's buy it. You put a buy order, well, lucky you, you didn't get swept into the trade. You can cancel it as you see bears selling. That means there's something going on there. This isn't a stop order trend for bulls just yet, okay? That means bears are going to sell. Okay, bears are selling a good-looking bull bar. Now bulls will try to buy it, right? So we come down and test this area. Probably buyers are right here, several legs down. So good job, bears, right? So now I'm looking for good-looking bear bars gapping from the moving average that I can buy. That is bar 35. We even trapped the bears underneath bar 35. 36 went down, grabbed everybody's orders because there were bears selling, trapped those sellers, closed a strong bull bar. Okay, it's probably going to get a follow through to a key price level, which is moving average. It is fine. This is also kind of like a leg one pullback, failed leg two. So therefore, which I'm going to talk about more tomorrow, where the micro sell and buy zones. Here's a representation of that. This is a micro sell zone. When price gets there, it sells once. Price gets there, generally it swings with the second sell. But this one did not. There's no sell signal. In fact, they actually broke above the resistance. Therefore, bulls are buying. However, look, another sell, another good-looking bar. We're still in the trading range. They're buying. Now, good-looking bull bar. Some try to sell it, but no one's selling. So here's another, but they're going to sell it because it's supposed to sell. It was supposed to be selling, right? And it didn't. If it gets a follow through, that's okay. But you should always say, it was supposed to sell. Why didn't it sell? What should I do? Well, look left, right? So why is it going there? Because bears close this gap. A lot of the bulls actually blindly bought there, okay? They're not happy that their gap is closed. So what they're doing is they're trying to get back to where they were. They probably bought here. They were expecting this. So now they brought the market there where it's supposed to go, approximately. Then the bears sell. So what I'm trying to say is, when a bar is supposed to sell, that you think that you're in a limit order market, but it doesn't. Count for a couple of bars. I generally count about 4 bars, okay? And after that 4 bars, I look for bulls taking profit and bears selling and reversing it back down where it was supposed to be selling, which was the close of 43. And that's exactly what it did. And it came down and closed that gap, okay? We're still in a trading range. Bears are able to close the gap, but they're not able to take out the gap bars open and low. It isn't all that bearish. So we're still in a trading range. Bears sold, but they can't seem to move it down. So now, same thing, limit order market. I'm going to continue. Machines will do same thing over and over until they truly see, okay, limit order market comes to an end and the stop order market begins, okay? So you have a bear bar gapping down from the moving average. Same thing. What are you going to do? Most likely there are buyers waiting to buy the close of bar 51, and they did. That is a fantastic bar, but I'm hesitating to buy it because I'm going against a tight bull bear channel. But that bear channel is only 2 bars, okay? So I want to see bulls actually try to close that gap, and most likely that's what's going to happen, right? But I want to buy with a second entry long with a much better bull bar. Now, where's that bar? That bar happens to be bar 55, okay? This is also a small head and shoulders, left shoulder, inverse head, and inverse right shoulder. So we did not take out the left shoulder lows, so that means bears are not able to invalidate this inverse head and shoulders to get a bear flag right from there. So the chances are we're going to go up to that level. We might even go to that bar right there, which I said when I got onto the stream. So what can you do? Can you buy above 52? You can start to buy if you like. You can put the stop right here. Or you can wait for a much better good-looking bar, 55, that is closing above the moving average. I would buy above this bar. And then, but my only problem with bar 55, less than half of its body is above the moving average. It's not all that great. It's going to give you some move, but you should wait for a bar like this one, okay? Or like bar 52, but closing most of its body above the moving average. Like this bar, 44, okay? This bar It was fantastic. If you buy above it, only about 1/3 of its body is above the moving average. The rest is underneath. Even if you get this, you're going to end up coming down either to the moving average or slightly underneath before bulls show up. This is no different. It goes up somewhat, but you should always expect it to come down. Then it gives you a better bar like this. Oh yeah, just go long. Go long is buy above it, take a little bit of profit at the highs, and then look for two-legged moves to the moving average and look for more buy signals. Don't like 69. It's a really good bar, but only, I don't know, a couple of, like 5% of that bar is above the moving average and closed. So what do you mean? What does that mean? If you buy that bar, it probably is going to come back and retest that bar. And it's exactly what it did. It did it here, it did it here, it did it here. Okay? And I'm seeing one thing that is not happening, that the bulls are not getting a really good breakout. If this setup is not a good inverse head and shoulders, after the 3 times the bulls tried to print those good looking bars and yet they cannot get a breakout or a stop order market, maybe this is coming to an end and I need to wrap this up. And look at this beautiful bar, and they denied the bulls from starting a breakout. When this happens, you're done. Exit out of your long, revert to being a bearish or seller, and then go for it. Like you can even measure as early as right there. That would be your 1R, 2R, 3R, 4R, and you got the 5R. I'm going to talk about the setup that I use. It's very, very simple tomorrow. I'm not going to talk about it right now because it's already 4:30 p.m. I just want to wrap this up. And but if you want to join the live webinars this month, I'm going to show you guys very easy way to buy and sell with high probability 1R or 2R rewards. This is actually recorded, I think, a couple of days ago. You can also purchase the March month of March archived sessions, and you can watch from there if you're interested, or just show up tomorrow and we'll go from there. Anyway, that's it. And then you have really nice breakout from this trading range. Go for a measured move 2R. They can get to 3R because this isn't all that great of a setup. You can also put your stop above 62 and measure from there, or measure the gap from there, right? So go for a 2R, and that's your measured move, and you get the 2R. That's a bonus. That's fantastic, right? So I included this gap and put the entry there, but you're really entering from below the 77, but you should be measuring that way. That's safer. It's a lot more accurate, okay? And the market turned into stop order market. It was a late in the day stop order market, but we kind of expected, if this is a wedge bear flag, bulls are really pushing this and not able to get that breakout, I think we should be looking for a lower high and exit out. So I warned you there. They could trap you above that bull bar, which they did. They didn't disappoint, and then you're done. I didn't trade this. I should have. If I weren't talking, I would have traded this, but I can't do everything. Sometimes presenters, we miss out on is good trades that we call, and we watch it like the train passing the green pastures, and we just miss out on it. But that's part of the job. As long as you guys get to trade it, that's all that matters. Anyway, I am done with my session, everyone. So I know you guys have a lot of questions. We can go over those questions tomorrow. Since this is a free session, I'm not going to hold you guys too long. And I cannot take questions, unfortunately, on GoToMeeting webinar. It's not even here. Apparently, we're doing a webcast to get more people in. So the question is not part of it's not a function, the question box. So that's not going to work. I could take 1 or 2 questions from Discord if you post it pretty quickly. I'm not going to scroll up and down. So I'll take the first question that is posted. Otherwise, I'll end the session and I'll see you guys tomorrow, because we do Q&A sessions at the end of the day, and you can bring your questions there as well. I'm very sorry. Brad is absolutely very, very sorry about this situation. He was really looking forward to joining and showing you guys a lot of great price action reading, but Unfortunately, we had to test out this new function to get more people in the webcast. So it's something that we'll figure this out with the vendor, but so just we apologize for that. Okay, looks like okay. So there's a question here. Is okay. How can you anticipate sharp reversals from tight channels like we saw early in the day? You just count. You look to see is okay. I actually talked about, where were you, Ken? Ken, where were you when I was explaining all of that? All right, I'll do that very quickly. Did you fall asleep or something? All right, so this is some kind of a small pullback bull trend or some kind of a parabolic. So you're counting legs regardless, right? So is maybe leg 1 pullback, leg 2, well, leg 2 pullback, and leg 3. Leg 3 is also 3 legs up. So I'm not doing this the right way, but here, leg 1 pullback is leg 2 pullback. The whole thing is leg 3. Now, first pullback, second pullback, and third. So you got a nested wedge there. So that's one way. And then you look for good sell signal bars, and confirmation is you can sell underneath. Bulls will start to exit from below 23, or other bulls will buy below 23 and try to break even. And if the break-even bar 24 closes on its low, then they will all exit in orderly fashion, and then everyone will start to sell bar 24. So 2 consecutive bear bars closing on their lows after 3 pushes or 2 nested wedges, okay, you can actually exit and sell. What you want to see is especially in a small pullback bull trend, you want to see at least 12 to 16 bars, okay, going up in that trend. Or if it's a very steady, okay, relentless trend by every pullback, it could last about 20 to 24. Sometimes trending days, it could even go up to 40 bars. I'm not joking, but those are extremely rare. So you get about 16 bars, okay? So what you want to do is find the most best looking, okay, bull bar that closed on the side, the strongest bull bar. Mark its low, and if the bears are closing below it, this trend is caputo. It's done. Finito. Bye-bye. Toodles. Goodbye. Done. Exit. So your latest exit should be bar 25. You're done. And we got a bear flag there. It's an implied flag. It happens very quickly. I call it a 2 or 3 bar bear flag or bull flag. In this case, it's a bear flag. You get a couple of bear bars, so that's indication of a bearish pressure down. And then you get a good-looking bear bar that's actually like impulsive. Now, 25 is not that impulsive, but the body is big and it closed below its midpoint. And then the next bar is a very weak bar, and immediately they start to sell. That is a bear flag. Okay, you should expect follow-through selling, and you get it. You can even sell the confirmation bar 27. Some will hesitate selling because they're selling right at the EMA, but this is still a bear flag. Probably it wants to go and test the midpoint of that gap bar. And if the bear's actually taking out that gap bar, well, if you haven't exited up here, I mean, you're going to have to exit here with some kind of a loss, okay? Or hold it and then look for good-looking bull bars in the trading range, buy it, and try to break even. You could do that, but only if you can handle that kind of a hold. I wouldn't. Once you start to see how market can reverse, okay, you never hold your long. You learn to exit. Even if it's a midpoint, you exit. You exit at the EMA, you just exit. There are no bull bars there either. So it's probably going to come down the size of this leg projected down. It could actually test these lows, and that's exactly what it did. So that's how you do it. Now go on to the some charts, historical charts, and go check those out. You'll see it. You'll see that how it happens all the time. Okay, try to count the bars. Try to mark those strong bars in the trend and see if the bears are able to take out those bars. So then the bullish pressure is no longer there, and the bear pressure starts to set up. Okay. All right. Where do you sign up for the webinar tomorrow? Ken just posted the link right underneath there. Gina, you're so cute. Well, thank you. I did my best here. Try to make Brad proud because his end of day reviews are insanely great. I can only be, I don't think I can. I guess we'll all do the same thing. We all trade the same way, but I'm kind of filling in for him. But tomorrow, I think it's tomorrow, he'll do the end of day. He'll point out all the limit orders and stop orders. So you'll get a really good training there. So don't miss tomorrow. But hopefully I did my best and you guys learned something. That's all I care. So I will see you guys tomorrow. Thank you for joining. And we are very glad that you all did. And we appreciate your time. See you guys in May in the Brooks Trading room. Bye, everybody.